Okay, gang. Well, good morning. Good morning. Can everybody see and hear me okay? Fantastic. Super. And a fine good morning to you as well. Well, let's go ahead and get right into it. Yeah, it's great to see all of you. I'm glad you guys could be back with us this morning. I've got a security team outside now. Not really. I just have my son keeping an eye on the front yard and the sides and that just to make sure. The good news is that the cable has been rerun, but it hasn't been buried. So if somebody hits that cable at this point, they're something else. So because now it's just sitting on the ground waiting to be reburied. So as long as we can get through today, we're good. So what we're going to do, let's go ahead and get right into it this morning. Of course, we're going to go ahead and hit the swing trading. This has been much anticipated. There's a lot to go ahead and go through, so we're going to be, hitting that pretty hard today. And we're just going to kind of go till we get done. Probably take a couple breaks along the way, especially in light of the fact that my student family group behind me here, we went into the evening last night, so I wanted to make sure we keep our voice. So. Let's go ahead and see how we do there. So first of all, we're just to go ahead and have a reminder here. First thing, of course, the video at a future date when you get it. It's for your personal use, for you to look at, at home. Anything, the video, the materials, anything that you end up receiving in the future there, for your personal benefit, but not to be distributed out on the internet. Please be respectful of that. And I'll let you pause the video and just kind of read this one for yourself at a future time here. Then, of course, just remember, trading, of course, investing for that matter. We've all seen, in 2008 time frame, a lot of people's 401ks became 201 and 101ks just through regular investing practices, and many of you had said you've lost 6 digits, and a couple of you even 7 digits in your investment activities. So clearly, even investing, trading, everything has risk. So make sure you understand those risks and make sure you're working with money that you can afford to lose. Don't trade with money you can't afford to lose. And, of course, consult a registered financial representative before you do anything with your investment or trading portfolio alike. I'm not a registered financial representative, of course, and don't hold myself out to be one. And, of course, nothing here is an offer. We're going to be looking at lots of different instruments today, looking at lots of different examples for you to learn from, but I'm not going to telling you to buy or sell any of these. Okay, so take the time, pause this, read it, verbatim as well, but I want to hit some highlights there for you. The highlights reel. Okay, so what we're going to go ahead and do today is we're going to hit the course outline, identifying candidates in futures, equities, and ETFs, process of analysis, dealing with gaps and other increased risk exposures, crossover strategies, and opportunities between swing and intraday trading. Then we're going to talk about several different setups. And the note, Pedro, what happened? Pedro's asking what happened. Well, I said we're going to hold questions to the end today as well, but I'll take this one question. We just went ahead and my internet cable got cut. They dug up the ground Friday and cut me right in the middle of my presentation. So we're doing the presentation today, so we get the whole thing through. Okay, and so we're going to go through different setups here and then look at several different examples to pull it together. At the end of each one of the individual sections, I'll take questions, and then we'll have like a little additional Q&A at the end there. Okay? All right. So, excuse me. So with that said, before we get started, I just want to make sure one more time everybody can see and hear me okay, right? What you should be seeing now is a slide that says identifying candidates in futures, equities, and ETFs with some blue print on it. Excellent. Okay, great. Okay, so the basically here the uh, thing that we're going to start out with now is do you have any tips for finding good opportunities? What I did was I tried to merge your questions with thoughts that I wanted to share, and we're going to kind of go through those different things. So the first thing is that it's all about the range and the trend. If an instrument doesn't have a trend to it, and I'm looking for a multi-day swing trade, that to me is a higher risk, lower probability type trade, okay? And so I'm looking to see if there's a trend, and you're going to see that theme throughout the presentation here. Now, are there overnight trades that can be taken? Yes, there are. So we'll look at a couple of things relating to overnight, but for true multi-day swing trading, I'm looking for range of motion and trend. You know, if we're having a bunch of doji stars or real tight days reflected in the instrument that we're looking to trade, and there's no trend, that to me is just not the kind of place that I'm going to go ahead and seek opportunities. Now, let's talk about a couple places that I will look for opportunities, and then we'll kind of pull them up so you can see them. First of all, stocks in the news. Okay, this is one that you know, what's the flavor of the day out there on Market Watch, Investor Business Daily, your favorite chat source, but basically instruments that are out there in the news. Okay, now I should mention that any of these things that I'm talking about here, including the ones that were coming up, top earnings surprises, 52-week highs, favorite highlighted ones in our videos, I don't go ahead and immediately start to want to trade these instruments. What I do is I go ahead and focus on putting them on a watch list, and then wait till a buy or sell setup will go ahead and take place in them. I don't go ahead though and immediately go into them. A lot of times by the time that hits the news wires that something's interesting, for instance, Apple Computer runs up for several weeks or months prior to their earnings report, then all of a sudden it gets blasted all over the news. Hey, you know, Apple went ahead and by the way, that sneeze you heard, gang, in the background there, that was one of our student family members. We got our private mentoring students here this week as well, so you'll hear some noise in the background perhaps occasionally as questions and different things go ahead and get asked from behind us. So. And from all of us over here to all of you, fine good morning there. Yeah, and clapping. You might hear clapping. You never know what you'll hear back here. That's for sure. You might hear some Lady Gaga or some other wild and crazy thing. One of the people sitting behind me is actually a comedian, so we might have to do some stand-up comedy back here. So you just never know what's going to go ahead and happen here. So but getting back to this now, the top earnings surprises. Okay. 52-week highs and lows, and then again, things that you hear me, John, and Hubert talk about in the videos, those are all different sources there of opportunity. Now let's take a look at where we can find some of those opportunities on our websites, okay, the websites that we're talking about here. So give me just a moment. I'll pull up a browser and we'll take a look there. Now, what I have here first, should show up on your screen in just a moment, is marketwatch.com. Now, I'm not endorsing any individual one place here, but I do want you to understand that here's a couple of opportunities. I want to try to find some free opportunities for you to find some of this data, okay? And so basically, as we look here, go to marketwatch.com, and what you can do is go down to the scanners, go over here to the right, markets, okay? When you click on markets, then you see you can go down here to market screener, okay? After you click on market screener, there you get a list of like 52-week highs by percent price gain, 52-week lows, multiple different avenues here. And again, by the time they hit this list, in my opinion, for the short term, they're no longer something that I want to trade today. What I do, though, is put them on a list for watching because often when something hits a 52-week high, it'll ultimately make more 52-week highs. And so what I'm looking to do is, if it hits that list, kind of go back and watch it, see if it pulls back to my rising support, see if that becomes an opportunity for an entry there. And of course, same thing with 52-week lows, they often go lower. Now, just as a matter of requirements, I won't touch anything under $5. Historically, with this type of activity, I usually focused on $5 to $20, $5 to $25 was kind of that range there, which was kind of the same thing I was looking at for intraday trades as well. These days, though, it seems like a lot of people are focusing on, I mean, as we flash forward several years now, a lot of people are focused on $50, $60, $70 stocks, which is great. They get more range of motion, but it's going to cost you a lot more money to afford them. So part of that will be personal preference, but I personally definitely would not touch anything under $5. That's me. So plus there's also then from a margin requirement perspective, and short and that there's other issues at the $5 mark. So just understand that if you go to marketwatch.com, let's kind of review that one more time. You get to the front page, you go over here to the right where it says markets. Let me just kind of highlight that. Okay, right here. So you click on markets. Then you go ahead and go right down over here to where it says market screener. Okay, and there, then you can click that and get some things for free. Okay, now another opportunity is Investor Business Daily, and their website. The first one here again was marketwatch.com. The second one is investors.com. That's going to be the Investor Business Daily. So let's pull that up. All right, and so here's what that's going to go ahead and look like. So basically, you look at this here, and this is the front page. What you can do is go to stock research, okay, and then you can go ahead and scroll down here under stock research and go over to Screen Center. Now, once you get there, and again, of course, they've got pay-for services, as you can imagine, but I've been watching this for a little while, and I've actually seen some very, what I consider to be good candidates that have popped up actually on the screen here a few times on the screener. So, in fact, one of them I actually put in the as an example as part of what we're going to be looking at here today. So I think here, you can get different things. You can go search it by a couple of their different tools. I personally like things like price and volume, so that I can take a look here and see how much it is. Am I even interested in playing with a $143 per share stock? Okay, no, maybe not. Well, how about Gilead Sciences, 37.84 or 82? Okay, that might be a little bit more to my liking. So look at something like that, see if there's a reason why the volume's been dropping off, and see if that's of interest to me. So there's a couple things there, and then of course there's different tools over here as well on like tech leaders and that. Get your get some different ideas here. And again, this is going to go ahead and they've got the paid for version of this, but I'm just going ahead and showing you the free version of it, because I found you could perfectly get some of the high flyers of the day just off of their free side. Okay, so again, just going ahead and posting that. One comment, and I talked about that with the group here just yesterday, is if you can combine fundamentals, okay, here's a real important point. If you can, combine fundamental analysis with a technical entry, in my opinion, that's, a great opportunity. The problem is, and I'll bet you many of you have seen this in the past, where you did a bunch of fundamental analysis on an instrument, but yet that instrument still stayed down or sideways, potentially for several months or years, before it finally became what we consider to be a higher probability trade, higher probability entry. So if you can have that great list of fundamental trading opportunities, okay, or investment opportunities, and combine it with a technical entry, that's a better deal, because then you got then you're basically a techno fundamentalist, and you're effectively playing with the technical traders and the fundamental traders. So that's a great thing that you can do. So again, this tool here can help you identify that. And of course, some of these names, I think a lot of you will recognize a lot of these names here. So again, another free tool that you can go ahead and get some ideas off of there. Okay, and then on top of that, just to recap what we said before, John, Hubert, myself, you all have the free versions of our newsletters. And so listen in for kind of what's being talked about, the different instruments that are being talked about, mentioned. You know, you'll hear about Apple and Baidu and different things like that. Then you can determine, well, wait, that one's too rich for my blood, or nope, that one makes sense. Let's go ahead and go take a look at that one. I like the cost of that one. You know, per share, you know, or per contract, whatever the case may be. So the that's another source. The other thing you see here, top EPS surprises. What happens is several of you have different charting packages where it will actually pull up kind of a leaders board. And so in my case, let me just go ahead and pull that up. What you do is I pull up eSignal here in this case. I believe TradeStation and Thinkorswim have something similar to this, where you can pull this up and then go up to like research, and then here you can see things like top earnings per share surprises, okay, and get different symbols of the day that are you know, applicable. This is of course a lot more useful during the right in the heart of earnings seasons, and so there's just different things here that analysts pick by industry. So different ways to go ahead and look at this. You flip over to T's and technology services. Okay, so now are these potentially some opportunities? So in other words, basically look at your favorite charting package, and especially if you're already paying for it, or like I said, possibly like Thinkorswim might have some of those services for free. Take a look and see what it offers, because all you're trying to do is develop a list of 20 or so different instruments. Now, when I of course went to the extreme, as I do with many things. Was used to look at hundreds of instruments a night, trying to find just the right trade for the next day. Well, the good news is, of course, with your swing trading, you can be a little bit slower, more steady, more measured, and try to find your favorite 10 to 20 instruments and just look at those nightly or look at those weekly. Personally, I would still say look at them nightly, especially if it's only 10 or 20, because of the fact that you can, you want to find those entries, because just like an intraday trade, timing, you can be right on the trade and wrong on your entry, right? So from that perspective, we really want to go ahead and what's what I'm looking for? Make sure that we get those entries. We're going to talk a lot about those setups and entries today. Okay. Now, let me just go ahead and flip this back, make sure you guys can see the screen. The next question here. So that's a couple of different sources there. The next question is swing trading for retirement accounts. Should you use ETFs or individual stocks? Now, I'm not sure. I think this might be about where we got cut off last week. So let's cross our fingers, right? The everybody's laughing behind me. From my perspective, a lot of it depends on your risk appetite and your aversion to risk. For instance, is an ETF on the market is likely to lose 50% of its value as an individual stock in overnight trade? Well, could it happen? Sure, it could happen. But what's the probability of an ETF in the U.S. market index, for instance, ETF, going ahead and losing, basically going from Dow 10,000 to Dow 5,000, when you wake up the next morning? What's the likelihood of that versus your favorite biotech stock that's trading at $50, and then all of a sudden they get an FDA consent decree, or they go ahead and they get denied a patent for their wonder drug, which was basically their primary source of income or their primary hope for the future, and then all of a sudden that $50 stock becomes a $30, $25 stock overnight. Okay, so and of course that's a lot more common. So individual equity risk is probably higher than ETF risk pound for pound. Again, just consult that your registered financial representative, discuss that as part of your retirement account and retirement planning. But just my personal opinion is that if I'm more risk adverse and I'm not into rapid wealth accumulation and don't mind taking more risks. For instance, if you're in your 20s or 30s, you might be a little bit more pro-risk versus if you're in your 60s, 70s, and you want to settle down and make sure that money's around for the future, but you're still willing to dabble in the markets a little bit. ETFs might be a better choice. So consult your registered financial representative on that, but hopefully that makes sense that as we're just looking and comparing the two against each other, the ETFs versus individual stocks, I would personally say that individual stocks are more risky. Plus, there's analyst upgrades, downgrades, lots of different things that kind of take place in there. So can you trade around your core position? Yes, you can. Okay, you can trade around your core position, but there's some caveats to that. Okay, first of all, you might need a separate account because you want to make sure your positions aren't offsetting each other. Let's say you have a 2,000 contracts of Microsoft, or 2,000 shares, excuse me, of Microsoft, and all of a sudden you want to short, you're long, and for the long term, and all of a sudden you want to short some. You may have to have a separate account so that all of a sudden if you sell 100 shares, it doesn't go ahead and just close out your position and leave you with 1,900 shares. So that's the first thing. But second of all, the psychological aspect. Let's say right now you're watching the financial markets and you're all of a sudden saying, wow, boy, it looks like Microsoft's going to take a bath. Well, you're like, maybe I'll short it. And then all of a sudden you short it, you make a little bit of money on it, but you've got this long-term position. Then what can happen there is the caveat you have to understand, you may actually go ahead and spook yourself out of your long-term position. Or vice versa, if you may be in a short-term short that's struggling a little bit, and you're like, well, wait, I am long, geez, maybe this thing's just going to go up against me, maybe I better get out, and suddenly the reasons why you originally got the trade tend to fade away, and your permanent position, your investment position, can affect how you trade your intraday position, the one you're trading with, and around the core position, or vice versa, you start making some money on the short side, and you start thinking, geez, I wonder if I should just sell my core position here. Boy, maybe I'm going to lose a bunch of money on this, and you start losing sight of what your investment goal was from a bigger picture perspective. So yes, you can trade around your core position. You may need another account to do it, but also, more importantly, the psychological aspects of how the two are going to work with each other, that's a different story. It's one thing when you're working at Goldman Sachs and you can have two different departments, one that might be long-term investing, Apple, and then another department that's, there to short the thing relentlessly every opportunity they get to take advantage of some short-term dips, but there's no vested interest between those two different parties per se. As far as the groups are different and they don't care, there's just an absence of deference. Whereas it's your individual long-term retirement fund or investment opportunity, you're going to tend to care more about your individual position more, and it can have more of a direct effect on you. So I hope that goes ahead and makes sense. All right. Let's go ahead and move to the second slide on this discussion, then we'll take some questions and answers. Should you worry about dividends with swing trades? Not in my opinion. I have heard of some people in the past that try to time ownership of an equity to dividend payouts, but from my perspective, no. That's not what the purpose of taking the trade was, for. It was to ride the individual wave up or down in the individual equity. I in no way, shape, or form have ever given any deference to when a dividend payout's taking place, when I would need to buy it by to get paid a dividend. You know, dividend investing, that's that's a different kind of beast. That's compared to what we consider to be 2 to 5 day or multi-week holding for swing trades. So from my perspective, no, I personally have never worried about dividend payouts in relation to my trades. Are there specific indexes, ETFs, or others that you particularly like for trades, or you just primarily do swings in the futures? Here again, the primary criteria here is the range potential and the trend make me like or dislike an instrument. Those are some of the primary things that make me like or dislike. Now, from a risk management perspective, then we have to move into a whole different category of discussion, which is, here again, how leveraged is the instrument? Many of you have heard me talk about, like, with the futures contracts there being highly leveraged, I personally don't sleep very comfortably when I have highly leveraged instruments sitting out there overnight. I tend to get up and kind of monitor them. Yeah, you can set stops and go to bed like a baby, and some people, do. They're able to sleep like a baby. For me, I'm the kind of guy, as you guys know, I will literally put hundreds and hundreds and hundreds and hundreds of contracts on an intraday trade. The funny part is, you get me a handful of contracts, give me a 5-lot out there in a highly leveraged futures instrument, and for a swing position, and suddenly I'm like wanting to go ahead and watch the screen quite regularly. So I find it personally disruptive to focus on highly leveraged instruments. Now, are there things the way you can offset that? Sure, you can look at opening up a spot Forex account, for instance, and try to trade fractional lots. You can go ahead and trade one contract or 2 contracts, whatever your comfort zone is, in like a regular standard leveraged futures instrument. Or you can look at something that's less leveraged, and perhaps that will go ahead and help you as well. So there's 2 different things that make me like or dislike something. First is that range potential and trend. Then there's the risk appetite from a leverage perspective. Okay, leverage is, of course, the epitome of that double-edged sword. You can make lots of money or lose lots of money. All right, so, and of course, most people focus on how much they can make. So, of course, I want to sit there and remind you of how much you can lose. Any thoughts you may have on using options in swing trading would greatly be appreciated. Well, my friend Mel is here today. Basically, Mel, I think he's come up and done presentations on options in the past on my behalf. He's a great long-term friend of our family here, and I think the way Mel basically looks at my work with these trending markets, or when the markets are trending, and using my work for identification purposes for his options trading, he wants to get a feel for what I'm thinking about from my, from the underlying perspective. For instance, do I think gold is going to go up the next several days or down the next several days? Do the charts, remember here just 2 or 3 weeks ago, every day I'm like, look, this thing looks great, from a longer term perspective, but on intraday trading perspective, I'm concerned about big pullbacks, but on the big picture, this looks awesome. Okay, well, so what Mel can do with something like that is then put on an options trade to his liking, reflecting the fact that he thinks that gold is going to continue to rally for the next few days. So basically, I look at the underlying instrument, and then the options traders amongst us can determine which type of tool and technique they would like to use to go ahead and trade with the options accordingly. Okay, so I hope that goes ahead and makes sense there. And yeah, Mel is saying exactly. And he says he does it all the time with the options. He says exactly. So the and by the way, on a separate note, for options trading, Mel's saying that you do need to go ahead and consider dividends sometimes. So that's on the options side. So I hope that gives you a couple ideas from the options perspective, that what you can do is take these swing trading ideas and look at the underlying instrument, and then apply your favorite tool and technique from an options perspective. And that's really what Mel is. I think it's fair to say that Mel doesn't take very much, if hardly ever, any of my futures trades. I think he's focused on my work for his options trading. He's my big options, one of my biggest option traders. He's actually done presentations here for us before we did the big merger. So hopefully he'll be able to come up and do another one of those soon, so you can hear from a another real trader's perspective how that all ties together. So with that being said, that's a couple of ideas for for identifying different instruments. Here's a list of some instruments. We're going to actually be looking at a number of these today. Here's some different instruments you can look into. This is, we have, of course, futures instruments at the top here, individual equities kind of in the middle here, and then lots of different ETF types down below here. So this is a list of different opportunities and instruments that you can go ahead and consider. Okay, so you can certainly pause this at a future date, write them down, or if you get the printout from me, you'll just have access to these. Okay. Now, with that being said, I think what we're going to do is, real quickly, before we go to the process of analysis, I want to pause the, no, Jay, that's not the same Mel, totally different Mel. So what I'd like to do, any questions on the identifying the instruments section there before we go ahead and move on. And again, let's keep the questions focused only to identifying potential candidates. Okay, we'll cover lots of other things and other subjects, and then maybe have a free-for-all Q&A at the end. But for right now, let's just go ahead and keep it focused to that. All right. You know what, Dr. Chris? That's a personal preference. A leveraged ETF, I guess it'd have to depend. The question is, for a retirement account, would you trade a leveraged ETF? And I'll say this, from my long-term investment type work, I'm focused actually on some individual equities. Actually, in my case, I'm still young. Plus, I have a great deal of confidence in my trading ability. And actually, to be quite honest, and this is going to be maybe a shocker, but from my perspective, I feel that my real wealth building has actually been coming from the trading side, not the swing trading investment side. A lot of the investments that I have, like the long-term investment work that I have, is basically sitting there at more or less break even, which I guess break even, considering the last 3 or 4 years of markets where a lot of people have, like we said, watched their 401ks become 201 and 101ks. I guess I'm not doing too bad from the long-term perspective, but that means that then really, I mean, you guys have seen some of the kind of days that we've had even recently, $23,000 weeks, $14,000, trades in a day, different things like that. My trading has really kind of improved very nicely since I started doing a lot more trailing of my trades since like the middle of July there, after the one big loss. So it's been really nice to kind of get all that right back on track and kick butt there. So from my perspective, a leveraged ETF is not necessarily a bad thing. It really depends how old you are, your aversion to risk, how much of a percentage of your portfolio are you putting into that, how much will that affect your retirement horizon if that leveraged ETF goes to heck in a handbasket. You know what I'm saying? Does that make sense? So I would not be completely adverse to that, but I tell you what, get back to me in another 5 or 10 years as I get a little bit older. Then I might not be quite as interested as in that. Fred, from my perspective, the higher, it depends on your perspective from a risk appetite. How important is the beta? I assume you're referring to the risk beta. The higher the beta, the more the or the higher. The higher the beta, the higher the risk. I think is what you're referring to. From my perspective, you're going to go ahead and get more range. See, it depends what you're looking for. And I'm assuming most people are going to be looking for swing trades as short-term income generators, not all of a sudden turning your swing trade into an investment. Okay, that's no better. If you take a trade for the purpose of a swing trade and suddenly you turn it into an investment, well, that's really no better than an intraday trader saying, well, you know, I thought it was going to go down, but it went up today. I'm just going to hold it because I think it's going to go down in a couple of days, and turning an intraday trade into a you know, a swing trade. Okay, so keep your time horizons in check there. And the reason why that's important then is, are you looking to go ahead and actually make money and get range and volatility off of the instrument you're trading? If so, then more risk, more beta would be appropriate. Okay, so from that perspective, yeah, that would be you know, more range, more movement is a good thing. Because why is that? Well, if an instrument is trading sideways, it's kind of hard to make a lot of money with it. So let's hope that answers that question. So yeah, beta. If I'm looking for volatility and range and motion, you know, I'm perfectly fine with that. Again, the underlying assumption here is we're talking about, you know, just a few week hold versus to maximize some short-term gains, which is what swing trading is, versus a long-term investment. And so let's see. Well, what do I look for as far as range is concerned? Frankly, something that's going to make me money. For instance, if an instrument, if a $100 a share stock moves 10 cents a day up or down, that's probably not going to be as appealing as a $100 stock that moves, you know, $5 a day. Okay, so having, you know, range of motion there is what's really kind of important to me. Okay, so let's see here. IRAs aside, is there any reason to use a separate account for swing trading with equities and intraday futures trades? A separate account. Use a separate account for swing trading with equities. The only reason to separate accounts, Don, would be to isolate your trading strategies and be more specific. For instance, I have multiple accounts here now. I've got the one account which is for my small lot trading, and then I've got one account which is for my big lot trading. Now, what other people do is they say, well, I've got one account for systems trading. I've got one account for my discretionary trading. I've got one that's using this super secret sauce trading system setup. So they'll break their different types of trading strategies into different accounts, and then they can measure the performance of that account rather than having to split up the results of that account and sit there and basically say to themselves, well, okay, I went ahead and I lost $5,000 on this account, and then they got to split up and say, well, okay, but really $4,999 of that was because of this systems trading, and only $1 of that loss was because of, whatever. You see where I'm coming from? And so here you can just make it a lot more clean rather than having to worry about which thing caused which loss. If it's all a separate account, you can say, okay, well, system trading is not working right now, but discretionary trading is going ahead and working, whatever the case may be. So setting up different accounts could be used for that purpose. Okay. And you're very welcome, Don. And then as far as I'm not using Dr. Crest, the average true range, to determine the viability of a candidate. I'm eyeballing it. Okay, you can try to put science behind it there, but frankly, I'm looking at the chart and kind of asking myself, okay, that stock is a $100 stock and it's moving 20 cents a day. Do I feel like tying up, tens of thousands of dollars of my money is going to be worth fighting for a handful of 20-cent days or so? Does that make sense to me? Or do I feel like, wow, okay, it looks like we're going ahead and, I'm eyeballing this and saying, wow, it moves like $5 a day. Now it might make more sense for me to go ahead and be willing to play with it because, even if I'm only right for a day or two, and then I have to go ahead and pull out of the trade, I have an opportunity to make $5 or $10 per share. It makes more sense. So I'm really looking at it and just saying to myself, I'm looking at the range, eyeballing it there, and saying, do I feel I can make enough money versus the risk and tying up my capital? Keep in mind, gang, as many of you have found out the hard way, when you do these swing trades or investments, you're tying up capital, right? And you could be sitting on dead money. And that's why the trend is so important to me. I want that thing to either start working or move on, because if you're sitting on debt, then that's money it's tied up, not allowing you to go ahead and do anything and capture any of the movement from more of an intraday short-term basis. Like I said, I was sharing with the group here yesterday how I've got a long-term investment, which, hey, I guess I should be happy that it's break even. Considering how a lot of people, like I said, literally have watched their 401ks just implode, their investment accounts and that implode. And so, from my perspective, but it's still dead money. Well, I could repatriate those funds right back into my account and have that much bigger of an account to work with for my, intraday trading. Does that make sense? So you got to make sure that if you're putting that money out there, it's going to go ahead and ideally you want your money working for you, right? Or you don't want it exposed to the market. That's the ideal situation. Either it's working for you, or you're sitting on the sidelines in cash. If you're in longer-term investments or you're in multi-week swing trades, then you're tying up capital, and you want to make sure that, especially with those swing trades, where you're just trying to capture short-term moves, that a swing trade doesn't suddenly become a dead-in-the-water trade that you start sitting on for several months. Okay, does that make sense to everybody? So if I get into a swing trade, I'm going to want to see that thing work. If it's not working, then I'd rather repatriate those funds to be able to use for other purposes. Okay, whether it's even just cash to avoid the risk and taking up the mental energy. How many of you have ever been sitting in a swing trade for several weeks and watching it day after day after day? Like, come on, just come back. This is ridiculous. I'm tired of dealing with this. If it just goes ahead and comes back, I'll scratch it. It's the same kind of thing as an intraday trade when you get into a situation like that, except that the difference being that this is now going to be potentially a multi-week event. Then you got to worry about gap ups, gap downs, worldly market events against your position. It can be very taxing mentally. Okay. Well, really, it's kind of like a day trade, Lee. The question is, how long do you usually wait for it to take off? If you've done your work properly here, it should take off within a day or so. If your timing is well and you're in a trend, if you bought a pullback bar, it should go ahead. The next bar should be a resumption, unless you have a situation where you get like 2 pullback bars and then the resumption. So really, within a day or so, it should start working. Okay. So if you've done your timing well. All right. So let's go ahead and move on here then. And you're welcome. And go ahead and talk about the process of analysis. Okay. So new section here. Let's go ahead and talk about the different aspects here. So process of analysis. What is the basic analysis technique prior to placing trades? Well, what I'm doing is, first of all, looking at the market as a whole directionally. Okay. So first of all, and this goes back to even my equity trading intraday analysis. Okay, so I want to make sure you know that this process of analysis really applies both just from an intraday perspective and a swing trade perspective. If I'm looking to go long an individual equity today, or I'm looking to go short, I'd like to see the market as a whole ideally support that position. Why? Because the whole throw the baby out with the bathwater concept versus like rising tides lift all ships. So in other words, if I'm looking for a good long side setup and I have the market showing me good bias to the long side, then I have a higher probability that that long is going to become an even better long. Does that make sense, gang? So and at the same time, if I'm looking for a short and the market is very bearish, and I'm looking for an individual instrument to take a short, I'd like to see then, because now I got a good double negative going there. I've got the individual instrument showing a sell-off opportunity, and I got the overall market coming down. It's more likely I'm going to see more bearish in that individual instrument. So looking at the market as a whole directionally is going to be very important to me. So then trying to identify candidates that are tracking with that. So just even like going back to the 90s, looking at my individual equities, I would look at hundreds of equities a night, but first I would start, and remember that's how I got into futures trading. If you any of you that remember the story there, I went ahead and would look at the overall market, okay, and sit there and say, I think tomorrow the market's going to go up, or I think tomorrow the market's going to go down based on my analysis. Then what I would try to do is find candidates that would tie to that market bias, okay? And so basically, so first I started with where do I think the market's going to go, and then I would look for candidates that would tie to that direction, okay? All right, had to get a little drink of water there. We were with the mentoring last night. We were here kind of late, so I want to make sure we keep that voice intact for you, and don't want to sound raspy later. So the focus heavily on weekly and daily charts. So basically, for the swing trading side of things, what you're going to see, let me just move these over real quick. I have my regular trading charts up, so I want to put these here. These are the charts you're going to go ahead and get pretty comfortable with and pretty familiar with as we're looking at the swing trading side of things now. All right, so give me just a moment. Let me configure them for you. They're sitting on another screen, so I'm kind of moving them over. All right. So what you see here is what I'm primarily looking at from a swing trading perspective, okay? And this should be fairly familiar to you in some ways, which is the daily and the weekly charts. Any of you that have ever asked me to look at markets for you on a swing basis, you've always seen me pull up those two sets of charts. I'll look at the daily, and then I'll go ahead and I'll look at the weekly, okay? Now, the one key difference that's going to be there that you'll notice is that we've made sure that the stochastics are back on there, okay? And we're going to be talking a lot about these stochastics, okay? Because one of the reasons they were in the original level 1 and level 2 indicators you had was because there's different tools and techniques you can use to use them both on an intraday and end of day basis. But I actually went back to, like I said, for the purpose of my book, pulled out some great information, and of course I've been testing it here recently, as I had mentioned, and it's working as well as it did back when I took the notes years and years and years ago. So now that's why I'm like, okay, I'm going to put that back out there for people publicly, and show you kind of what I'm doing with that. So, and like I said, so I'm using that on my intraday basis, not just end-of-day basis, but it will become important on an end-of-day basis as well. We're going to talk about those setups. So, and then of course you're familiar with my trending and multi-time frame analysis tools, and everything else you see on the screen is pretty standard there. So the so this is what it looks like from a process of analysis perspective, is the weekly charts and the daily charts. Okay, so let's go ahead and get this back up. The presentation there. Just want to show that to you for a moment. All right, and so what we're going to do is we'll just kind of hold questions to the end there, which actually I think we'll get through this section fairly quickly, and then I can answer questions for you again. Okay, so process of analysis again. So far we've got looking at the market as a whole, trying to identify candidates that are tracking the market. Then I look at the daily and the weekly charts, okay? And then what I'm doing is assessing the gap risk, okay? Well, what do I mean by that? Some stocks, some instruments just tend to gap a lot. Okay, and so basically the what you have to understand is that if something's gapping a lot, that potentially increases your risk. I mean, if it's a proven gapper and you're not comfortable with gaps, or it's likely to gap past your stop on a trade that you're in, then you have to ask yourself, is that the kind of trading that I'm really looking for this particular instrument or for this particular trade? Am I willing to absorb that kind of risk? So if I look back at an instrument, because any equity instrument certainly has the ability to gap, so it closes tonight at $100 a share. Tomorrow it could open up at theoretically whatever, $10 a share. Any instrument has that potential gap ability. Like for instance, especially equities, at least the futures markets, kind of trade overnight. But even the futures markets, they close at a particular time and then they open for trading again. There's a small time, even in the currencies, and that very small time frame, that a gap can ensue. And in the currencies, we've seen one or two cases in the, well, I think about like the Japanese yen back several months ago. That one gapped up hundreds of points, right, and then spiked from there. So the gap risks are pretty much everywhere. The question is, how do you mitigate those risks as much as possible? Well, we'll talk more about that in a little bit, but right now from a process of analysis perspective is I'm just kind of going down a checklist of, do I even want to look at this stock at all, or this whatever the instrument is? One thing to look at is, man, does this thing gap a lot? As I go back in history, am I seeing like in the last 4 months worth of charts, this thing's gone ahead and gapped several times a month? It's just a frequent gapper. Do I feel comfortable with that? So that's something to go ahead and take a look at, because I know gaps have to be, they should be, in my opinion, a major concern for a trader, a multi-week trader. And so then the other thing is, does the trend and the present setup, which we're going to talk about several setups, fit my desired holding period? Okay, so again, I don't need as much of a trend per se in a 1 to 3 day chart if I'm using certain types of setups. Okay, but at the same time, if I'm going to hold for a week or more, or 3 or more weeks, then certainly I'd like to see more trend. So does the trend and the present setup that I'm looking at using for that trend justify me going ahead and taking that trade? So these are basically the elements. So for all of you that have asked me in the past to go ahead and analyze individual equities for you, you notice most of this is stuff that you've already heard about and talked about and seen before. The only one that is not really necessarily there is the frequent gapper thing. That's about the only thing that would be fairly new to you. But most of the stuff that when I look at things for you guys in these cases is pretty much standard. Okay. So is there a question on kind of that process there? It's pretty straightforward, I know, but that's just it. People can make it as complicated, like trading, right? You can make trading as complicated as you want to. So yeah, Michael B. Ultimately, it should be. I need to talk with Johnny Hubert about that, but ultimately, if possible, the presentation will be available. Jim, what about ETFs in relation to gapping? I mean, ETFs can gap as well. Let's go ahead and just pull this up real quick. Let's pull up the chart, and let's kind of slide on down. Okay, here we got the UUP. Okay, so you see that right there, Jim. Even on the UUP, this is the dollar. Let's pull this back so you can see it. Seems like it's trying to get the title screen to come up there, but it does not appear. So this is a dollar ETF. It's not coming up right now, but you can see here this is an ETF, and this is gapping. Okay, you can pull up a couple of the other ETFs here, and you see that they have gap exposure as well. So ETFs do gap as well. Does everybody understand that? ETFs can and do gap as well. Okay? All right. You betcha. Okay, so with that said, let's go ahead. What is the blue and red indicator below price? That would be the, I believe what you're referring to here is this down here. That's the Hoffman trend indicator. Okay, it's not a squeeze, not a C wave. You know, that's why I actually try to change the way it looks actually a little bit so it didn't look quite as much like those, because it's not those. So it's one of my tools here. All right. So let's go ahead and move on then back into the presentation, because there's going to be lots of things to discuss. And so let's go ahead and talk about what we just were kind of focusing on for a moment there, dealing with gaps and increased risk exposures. Okay, so new section here. And basically what you'll see here is gap ups, downs, and bigger margin requirements, etc., may inflict pain if it goes against me. This was a student-related question. There's a couple questions in here from different students, so I kind of tied them together. How do you protect yourself from gaps due to news? What's the best way to ensure you won't end up like Victor Niederhofer? Example, going to sleep rich and waking up broke. You know what? Great questions, and something that I wish more people would think about before they go ahead and take trades. Unless you're hedged in some way, you've managed your exposure, you're exposed. It's basically, if you're in a naked position, you're just long Apple, or you're short Microsoft, whatever the case may be, you're in a position and it's just a one-way position and you don't have anything offsetting it. You're very exposed. There are lots of different techniques you can use to go ahead and hedge. For instance, long Microsoft, short Apple, or you can go long the individual equity and perhaps put some puts out there, on some options. There's lots of different techniques you can use to hedge. But if you're in a naked position, you're basically exposed. Okay, so then dealing with that risk and increased exposure, really what we're talking about there then is, to mitigate some of that risk, considering avoiding more highly leveraged instruments, more volatile instruments, and limit the account exposure in terms of percent risk on any given trade. Now, like in the Victor Niederhofer situation, that was a pretty big trade he had on the currency markets, right? So there was a high level of exposure, all right? So, from your perspective, and actually the funny part is the question's coming up down below, basically having a percent of your account that, if decimated, will not affect your overall ability to retire, and affect your retirement time horizon would be something that I think you should consider and consult the registered financial representative on. So there's two different things there for all of you that ask similar questions to that. Considering hedging, or considering avoiding highly leveraged instruments, and or looking to limit your exposure in terms of the percent that you're going to risk on any given trade. Those are some ways to help mitigate the risk, with the gaps in that. And like I said, in the volatile markets we're in, it's a very real issue that people have to contend with. Okay, people always think about, wow, well, look how much that gapped up, and if I were long on that trade, I would have woke up this morning with this much money in my pocket. Here again, it's just that human nature, that human tendency to go ahead and think about how much we're going to make on an individual trade versus how much those can gap against us. So I encourage you to go ahead and think about that. David, you're absolutely welcome. It was great talking to you the other day. So obviously stops need to be wider. I use 2 times the average true range. What do you suggest? Well, first of all, that comment that was made, my first thought was, be careful with wide and too wide versus your anticipated profits. So, for instance, here's the question I'm asking, and I don't want the person who asked this, because I know who the person is that asked this, and I like the person who asked this. Even if I didn't like it, it's okay. It's a great question, but the the thing is to think about that, gang. When you look at this, I see, I use 2 times the average daily true range. Well, these days on some of these instruments, that could easily be 100 or 200 ticks. Does that make sense? Let's say on some of your favorite stock index futures, that could easily be 100, 200 ticks these days, right? So if you use 2 times that, here's the question. So let's say it is just 100 ticks. Well, now that means you're going ahead and using a 200 tick stop. Here's the question. Are you actually going for a 200 tick or more profit? See? So in other words, is that risk that much wider that so that's why I wanted everybody to kind of think about that. Well, stops need to be wider, obviously. Okay, and so that's why I'm like, well, be careful with obvious, because then there's wide versus too wide versus your anticipated profit target. Okay, so what you have to ask yourself in the end is, as you're doing your analysis and you're sitting there thinking, wow, I think I'm going to go long Apple Computer here, because I think that I'm going to go ahead and be able to make $10 in the next a couple of days, but you're going to risk $40. The question is, and of course any potential gaps and market volatility and so on and so forth, does that make sense to you? And only you can answer that. Everybody out there can answer that. But it's the same thing on intraday basis. People will go ahead and focus on the risk versus reward. We're all like minutely trained to go and focus on risk reward, probably too much so almost in some ways on an intraday basis. But on an end of day basis, it's like, well, I've got to have a lot wider stops. And then the question is, are your stops so wide versus your profit target that a few losers are going to blow you out of your your profit loss won't add up. You know what I'm saying? So, and so that's something I want everybody to think about. So hopefully that makes sense when you're putting it out there. If 2 times daily average true range, is somewhat commensurate with also the same type of profit target, then that might make a little bit more sense, especially if you have a high probability setup, right, gang? If you have a high probability setup that wins a lot, then this might make sense, okay? Because if you're, some trades are going to have bigger drawdown potentials, no doubt about that. But if you're winning more than you're losing and ultimately making more money, okay, I kind of think of it in terms of like Hubert's good night gold trade, right? So he may lose 3, 4, 5 times in a row, and that may appear very disheartening as you're watching yourself lose 1,800, 2,400, whatever the case may be. But when he does win, typically he's finding that he can still offset all those losses with one winner. Okay, so the key is, though, he has to stick with that. In every single trade to make sure the probabilities work out. Well, if you lose on 2, 3, 4, 5 swing trades, will you stick with your plan? And first of all, does your plan have the justification, the merit to be a high enough percentage of profitability and winning in the first place to allow for that kind of behavior? Okay. So, and then the final question here is 1 to 2% of account size reasonable to risk on a swing trade, and is it too conservative, assuming this is an IRA account? Well, first of all, just forgetting that, and by the way, we got another question. It's just on the board or the other slide, so I want to hit that one too. But just on this one here, is 1 to 2% of account size reasonable to risk on a swing trade? Is it too conservative? And my comment is, can you really ever be too conservative? I mean, about the most conservative you can be is not taking a trade, right? And for many people, not taking a trade is the best trade they've ever made. You know what I'm saying? So I hope that hits home with a couple people. And so the question is, only risking 1 to 2%. I can't find any reason or justification to knock somebody who says, look, I only want to risk 1 to 2% of my account on an individual trade. So forget what kind of account it is, IRA, regardless of the kind of account it is. How could I sit here and be so arrogant as to knock anybody for only wanting to risk 1 or 2%? I actually salute them, because in many ways I see too many people being too cavalier with their finances and betting the farm, okay, going for the big kill. And we've talked just recently here, for like one student who bet the farm big on silver and wound up having to go back and work at a second job, a second career for a while, and is out of trading because he bet the farm on some big swing trade exposures, hoping to get rich quick, right? And again, that person, you guys all know, I love that person dearly here. He's a great guy, and I spent a lot of time with him on a personal level, and so it's disappointing to see him make that trade. But the point being is that for all of you who are sitting there thinking, gosh, maybe I'm being too conservative with a small account risk, I actually, salute you. That's my opinion, that if you're trying to manage your risk and keep your risk, yeah, your winners won't be super huge, but you know what? Your losses won't be necessarily super huge as well, all things being equal. So that's, again, I would say consult your financial representative on that, your registered financial representative. But from my perspective, I don't think you can be too conservative. Bet the farm and then work on the farm. And you know what, Jack? There's some truth to that, though. I mean, right? I mean, if you go ahead and if you sit there and try to take too much risk and you're wrong on your bet, bad things can happen fast. Okay? So let's move on to the other question about this. Rules of thumb on stops: if there's a gap move in a stock and it goes against you and you have a stop on, the trader usually gets a bad fill due to the rush of stop orders, which initially drives the stock or options price down initially, only to rebound back when the backlog of stop orders are filled at a lower price than the stop value. So the question is, in this situation, where there is a gap against you, do you recommend pulling the stop, i.e. canceling it, and riding out the first volatile 30 minutes of trading until 10 a.m. and then close out if the stock is moving further against you? Now, there's a lot of factors that go into that. A couple of the key ones. Let me, if I can take everyone back here to the 90s and tell you what I used to see. And for those of you, how many of you actually were equity trading back in the 90s, particularly the last from 95 to 2000? How many of you were trading equities back then? Okay. Few old dogs here. And good morning to all of you there. Linda, Dave, John, Mel, Larry, Stuart, Mike. Okay, the screen's kind of flying by here. Hey, I'm throwing myself in that category, right? So I was here too. I just wasn't old. Yeah, the guys behind me like that. So, for those of you that joined in late this morning, just I've got my own what do you call that? Audience applause group back in the background. What do you call it? Yeah. Yeah, so if you guys heard that, I've got my own cheering gallery back here today with our student family that's here, our 5 mentoring students. So great. So I can go back in time for a lot of you. And what happened at that time was, if you recall, the way things were basically working was this: you would go ahead And am I showing them applause signs at certain times? No, I'm not. They'll just go spontaneously whenever they feel like it, I suppose. Um, but take you back to that time. What happened was every day on CNBC, you had your favorite commentators from the brokerage firms going ahead and sitting there saying, well, look, equities are way overvalued. This whole thing is ridiculous. This whole these price earnings ratios are way out of whack. These tech stocks are in for a big fall. Yada yada yada. Okay, over and over and over again, we heard this story why you shouldn't buy these tech stocks as they were going to the moon. Right, $10 stocks were becoming $100 and $200 stocks. Right. Well, so going back to that time, here's basically how that worked every morning. Your favorite commentators would come out from these brokerage firms and say how these things are way overvalued, and it was ridiculous, and just sell these things. So every morning the market would go ahead and gap down, and remember all of the what would happen is a lot of your favorite high flyer equities would gap down several dollars. Nasty, ugly gaps in the morning. So the overall trend is up, and you'd have these ugly gaps down. Well, guess what happened? For all of you that remember at that time, those would usually be the lows of the day, right there at the open. And if you just bought the open and sold shortly before the close each day, there was an opportunity to make some pretty good money. And so basically, monkey could make a monkey could make money then. Yeah. Well, I mean, basically, all you had to do is go into the market in the morning when it's a gap down, buy your shares, and then that afternoon sell them before the close. But that opening range was usually the low of the day, spiking everybody and spooking everybody out of their trades. And so there's a couple things that went into that. First of all, there was a good solid trend in the background. And second of all, the gaps were usually deep enough then that it went ahead and made sense to consider being a buyer of the short-term dip. Now, if you don't have a good quality trend in the background, or the gap is kind of weak and tame and muted, then what could happen is, especially if there's no trend in the background, a gap that gaps down a small percentage that doesn't gap down that much, it could go ahead and actually slowly keep going against you throughout the day. So there's two kind of factors there. The deeper the gap, the more likely I would be to consider possibly looking for a short-term retracement. But a lot of that depends on what the support to the trade is in the background. If the market's sideways, and the markets and your individual equity is your trend is basically more or less flat. So let's say you're Swiss cheesing back and forth. If you're Swiss cheesing back and forth on your individual equity, or the market is kind of Swiss cheesing back and forth, I'm going to be a lot less excited about going ahead and playing that gap, fade, if you will, and trying to hold on to it longer. So bottom line is and let's put it in these terms too. We talk about gap trades, we talk about gaps fills, frequently around here. There's a lot of rules around gap trading, isn't there? And even then, with all the rules, a lot of people still struggle to go ahead and make them consistently profitable. So with all that being said, if what you expected to have happen in the market doesn't, then maybe you just need to go ahead and pull the trigger and take your medicine and take the stop. But the one mitigating factor there would be the quality of the trend in the background. If the quality of the trend is good in the background, so it has this overreaction to the downside off the open within a high quality trend, maybe then it makes sense to go ahead and give it a little bit more time to see if it rebounds. Just don't turn that type of strategic waiting period into a hoping and wishing period. Because then, like we're talking this question about waiting the first 30 minutes and then close it out if it keeps moving against you. Well, what happens in the real world, if you recall, like when trades are go-with trades, it'll slowly move down, slowly move down, slowly move down, and you'll sit there and think, well, there's not a lot of intensity to the the sell side there, so I think I'm going to hold on to this long a little bit longer. I was going to kill it at 10 o'clock Eastern, but you know what? I'm going to give it to 11 o'clock Eastern now because it's only slowly moving down my way. Well, as we know, that slow move in many cases is what we call a what kind of trade again, gang? Exactly. Group back behind me got it here. The go-with trade. All right. And so, in other words, that slow, steady, consistent price action moving in towards your area may be actually a very, very bad thing. Okay. So just make sure if you're going to have this rule or this plan to give it 30 minutes in a strong trend, see if it retraces, and if it doesn't within your 30 minutes, you got to stick with your rule because, like in my case, the times I lose money are when I break my rules. I make money when I stick to my rules. Okay, it's just that simple. So if you break your rule here, you run the high risk of losing money. Okay, so that's a way to kind of split the baby with the bathwater. You've got a couple of things to think about there. The quality of the trend is the biggest. Okay, if you got a good strong trend in the background there, it gives you a little bit more flexibility. But at some point, you still got to be willing to pull that trade just because, well, the last two times you took the stop out and then it came back your way. Well, guess what? Time number 3 may just keep going and going and going. And you're living for the past when the two that came back, and you're hoping that it's going to come back the third time, and it may never come back that third time, and then you turn a small loss into a big loss. Does that make sense? Okay. That's right, Dilip. And of course, as you know, when I follow that rule, good things happen, and when I don't, bad things happen. Rule number 1, if the trade is taken incorrectly or does not behave as expected, it gets cut, regardless of it if it is a loss. Okay, so that is definitely one of the high on the list type rules for my trading, and when I stick to that, things work out pretty darn well, and when I start breaking that, bad things can happen. Okay, so any other questions on dealing with the gaps and or the increased risk exposure from the perspective there? Risk to reward, here again, just like intraday risk to reward for swing trading versus intraday trading, it's really the exact same thing, Dr. Chris, as intraday trading. You can have a reward that's maybe half as much as your risk. So let's say you're going for 10 ticks but risking 20. Well, wait a minute, that doesn't sound right. Well, yeah, it does. If you get yourself a real high probability trade, if you've got a trade that works far more than it doesn't, then you can have displaced risk reward. Everybody is very holy when it goes ahead and that's right. So there's no changes in the rules. Exactly, Dr. Chris. People get very holy, and on chat boards they talk about these risk rewards, but it's a lot of times these are written by people that can't trade their way out of a wet paper bag. So the thing is, though, part of it goes and depends, and Dr. Chris is saying right. So no changes in the rules. The rules really are the same way. The only thing I want to try to remind people to keep in check there, though, is that whole concept from the last slide about the 2 times the average true range. That could easily these days go ahead and basically be hundreds of ticks. So the question is, are you going for hundreds of ticks in profit, or are you going for, let's say, 20 ticks or 50 ticks in profit, but you're risking 200 ticks then, based on the little example I'm giving here? Well, you better be right a lot if you're going to go ahead and do that, to make only 20 or 50 ticks, versus risking 200 ticks. So that's where it came back to this conversation about be careful of being wide versus too wide, because 2 times the average daily range these days in the current volatile market can be really ugly. Okay. You know what, Jim, that question here, let's see, I guess I'll answer that question about how important is volume in considering which instruments to be traded. Basically, the more volume, the better. Certainly, if something trades less than 200 to 500,000 shares a day, it's kind of like, what am I doing with it? It's just kind of like trading like the dollar versus the euro, Jim. I don't trade the dollar because the dollar is way too thin, but I'll trade the euro because it's much thicker in activity. So volume still applies. If I'm looking at whether I'm looking to get 100 shares of a equity versus 1,000 shares of an equity, but if there's only 50. Kind of focusing on from an equity perspective, and there's plenty of markets that are moving these days that got plenty of equities that have that kind of volume plus. So it's not like, oh gosh, I just took out 95% of my opportunities. So all right, so let's go ahead, and you're very welcome, Jim. Let's go ahead then and move on to the next one here. All right, and this is an important one. This is talking about crossover strategies and opportunities between swing trading and intraday trading. Now, this question actually came from what I consider to be a misnomer, but I do want to point out something else while we're on this topic of crossover strategies and opportunities between swing trading and intraday trading. Many, if not all, of the things that we're talking about here apply to intraday trading as well as end-of-day trading. Okay, so like the setups and the techniques we're going to be talking about today, go ahead and do have crossover application. Okay, so I want to make sure that you understand that. So, but now this question actually came out of what I consider again to be a misnomer or potentially an incorrect statement. So let me just share with you my thoughts on this. The statement is, day trading is for income, but real wealth building is with swing trading. Now, from my perspective, this statement can be misleading at a minimum. Great wealth has also been lost, and so I really kind of I guess it's amazing how people can be so narrow-minded in their focus because they conveniently forget how many people in their longer-term investment and trading activities, their longer-term stuff, have lost hundreds of thousands, if not millions of dollars, quote-unquote, wealth building. So that's an open question. And gang behind me, you can answer as well. How many of you have lost lots of perfectly good money swing trading and or wealth building? Okay, I've got, looks like I got all 5. Yep, okay, I've got all 5 hands up behind me. All right, and several of you here as well. So, yeah, buy and hold killed me when I was with the brokers doing it for sure. Yeah, I remember that. I didn't want to say the person's name, but I remember you were telling me about that. So interesting that a lot of the ladies here were quote-unquote man enough to go ahead and answer. So thank you, ladies, for your honesty there. I know several ladies answered, and a couple of the guys, and then all 5 guys behind me answered, so thank you very much. Bottom line is, Absolutely. So, the whole, everybody here, I think one of the problems is that, first of all, it's an old adage in part, and second of all, everybody thinks, we all want to be the next own the next Microsoft, right? But that's the exception, not the rule. And one of the many variables that people consider is the possibility of sitting on dead money for weeks, months, or years. Like I said, I've got one of my long-term investments that's been sitting there now for, well, several years, which again, technically, I guess comparatively speaking to most people, theoretically, I made money, theoretically compared to them, because they lost money on a lot of their investments. Mine was hold. But you know what? Frankly, as far as I'm concerned, because the time value of money, I lost money. Does that make sense? So even though I didn't truly lose money, I've actually made money because I got some pretty good dips back in the early 2000s. I got some pretty good dips, so I am up on the trade in all fairness. But when I look at it, just has the stuff spiked up and continued to go up, up, up? No. It basically went up after that big dip and now has been sitting there the last several years. It survived the 2008 time frame very well, which is all wonderful, but it hasn't continued to progress. So the point being is, if I've taken that money and just gone in and done it with my trading, I'd probably have made by now a lot more money with that same money with the trading. So the so my thought is, for those of you that think day trading is just only for a buck or two, but you're going to make your millions off your swing trading and investment activities, is it possible to make your millions off your swing trading and long-term investment opportunities? Sure. If you catch the next Microsoft in particular, you can be that janitor story. The janitors at Microsoft retire with millions in their pockets, right? If you're lucky enough to catch that kind of instrument. But in this volatility, this market volatility these days, there's a real opportunity that 2-3 weeks after you buy an instrument, you could be right where you bought it, or even below, right? So just something to go ahead and something to think about there. And well, that's a good point too, Monty. I guess it's worthwhile bringing up. Most of you here are familiar with the story of the Apple guy who went ahead and shorted Apple at $150 a share. I believe it was $150, right? It's a well-known story that Hubert and John have talked about here several times. And this person is short, we're up there just, shy of $300. And so this is a situation where this poor soul is at a catastrophic loss situation in his long-term wealth building account. And so most of you are familiar with that situation if you've been here more than a few months. So, for those of you that aren't familiar, there's a student that went ahead and, it's not a student in my room, let me be clear, but a student of Johnny Hubert's or something. I'm not even sure if he is a client, actually. I'm not really sure if that was ever the case or if he was like on free newsletters or what it was, but needless to say, he went short Apple at like $150 a share. And of course, Apple's obviously way beyond that now. And so, just an example that a lot of us who follow that story for months can relate to, that you can lose lots of money wealth building. Okay, so everybody talks about your true wealth building is from swing trading. I gotta cry foul on that. You know what I'm saying? So, and I think about like right now, some of these big trades that I've put on here in the last several weeks, and compare that to the money I'm making on my quote-unquote wealth building stuff, and I'm definitely making more on my intraday stuff. So just a thought there. Yeah, thanks. Thanks, Walter. Appreciate that. Yeah, so I don't even think that it was a person who heard of Johnny Huber at the time. I wasn't in the picture, fortunately, at the time, and so he started calling Johnny Hubert, and I know they had to get to the point where they couldn't even take the phone calls anymore. It just got to be a daily, sad but crazy event. So the bottom line is that that's right. For every person that's owned Microsoft, there's probably somebody out there who's owned GM or Nortel, and the list goes on. Um, you know, Enron, and so on and so forth. So the point with all this is, don't sit there and talk yourself into the fact that you can't make viable money with day trading, and don't talk yourself into that you're going to make your millions with your swing trading. That's really kind of a key theme that I'm trying to share here. I personally am pretty much the inverse of this, is what I feel like. Okay, that's my personal opinion. That that for the long term, my wealth building is going to come from my trading and not my swing or long-term investments. Dollar for dollar, pound for pound. I think in the end, and I guess time will tell, and I'll be happy to update you in 10 or 15 years here where we're at. But pound for pound, dollar for dollar, I think that it's all going to prove out to be that the short-term stuff. The old days of buying and holding, it's just not the same environment anymore. Basically, yeah, that's right, Jim. In part, it's really your personality, the type, and the style that will make the right choice for you. But one thing's for sure. The old days, back in the 20s and the 30s, you got a job back, earlier in the century, earlier in the last century. You got a job and you basically stayed with it, right? I mean, that was more so you were upwardly mobile within your same company, but you stayed to the but you stayed with the same company and tried to upwardly advance in it. These days, these kids, they come out of college, and their first thing is, okay, well, I only plan on being there for about 6 months. Then I'll jump over to this company, get a promotion to supervisor. Then I'll leave that company in 6 months or a year and go ahead and become, a junior partner at this company. Then I'll leave that one a year or two after that, and then I'll be a senior partner at this firm. You know what I'm saying? These days, I don't see the kids going ahead and the mentality of the average worker being out there, and see if anybody agrees with me on this, but this is my perception, what I see in talking to lots of people all over the world. It doesn't seem like people are loyal and dedicated and slave to the same company anymore. They're basically like, look, how much can I get out of this company, and then quit, and then jump over and to the next company and get my next big promotion, and so on and so forth. Basically, it's like that's not their thinking, to stay with the same company, and they're just looking to go ahead and whether it's outwardly spoken or whatever, exactly. Loyalty is a two-way relationship, exactly, Robert M. And so what's happened is companies have proven that your loyalty will not necessarily be rewarded. And so basically people these days are like, well, screw you. I'm going to give you a taste of your own medicine. I'm going to jump over to this other company, and they're going to go and pay me $10,000 more, right? And so it's a two-way street. Absolutely. These companies these days treat people disposably, and the kids do as well. But the point with this whole conversation is, what this has to do with trading and investing in that, is that what's happened over the years is that there's no loyalty to companies anymore from a working at them perspective. Well, guess what? There's not much loyalty anymore from an investment perspective. The old days of working for Enron, growing old there, having your 401k and all your investments and all your money tied up in Enron, you know what? They're gone. People are like, look, I got to diversify. I got to go ahead and get some of my money out of this company I work for, because God forbid I go ahead and I lose my job and this company goes under and all my wealth was in it. Okay, so there's more of a turnover in that sense. But then in addition to that, then what happens is the whole information age. Back in the 30s, 40s, 50s, it sometimes took weeks for your broker to get back to you on an event, okay? Some big event happened to your stock, if you were lucky to hear from your broker, you wouldn't necessarily hear from your broker for weeks because the information age, well, there wasn't much of it, okay? Computers weren't around. It wasn't the way we communicate. These days, a lot of you get your information before your broker even knows. You guys get your information very fast, okay? And you have your cell phones, you have automated alerts to your phones, to your computers. Our chart services can be set up to flash up alerts. And so, the point is that the whole information process, what used to take weeks, months, or years to go ahead and get information, doesn't have to. The whole investment cycle, which used to go ahead and take weeks, months, and years to fulfill itself, can basically go ahead and be fulfilled, effectively, quote unquote, overnight. So stocks can rise and fall very fast, and the whole market cycle is much more nimble for many of these instruments these days. Rather than, well, okay, I'm going to go ahead and buy Microsoft here, and then 50 years from now, I'm going to go ahead and sell it up here. More and more people are sitting there thinking, okay, I'm not going to worry about 50 years. I'm not, I don't even know if I'm worried about 50 weeks. What's going to go on? I think I'm going to flip this thing in the next 3 to 6 months. How can I prove that? Well, how many of you that have had second careers have gone ahead and been told by your 401k fund or so that you are no longer allowed to do more than 3 trades or 4 trades a year without penalty or some number? You know what I'm saying? Okay. So yeah, so exactly. See, you're being told if you trade more than 4 times or X number of times, whatever it may be, and that you're going to be given a penalty and so on and so forth. So more and more the funds are saying, shoot, these people are flipping in and out of these things. We need to stop that. Okay, but what that is, if it's proof, that's indicative of the fact that more and more people are handling their own funds proactively, and they're not waiting and just buying and holding like a bunch of blind idiots to go ahead and they're going ahead and saying, look, you know what, I think that the short-term run on this might be over. I want out of this, and I want to move over to this. Okay? More and more of you have woken up and are saying, look, my broker is no better than I am. I can throw a dart at the wall and do better than him or her sometimes. So, or you've realized over the years in watching CNBC and that some of these people don't necessarily have your best interest at heart. So you've taken your own responsibility for these things. Well, guess what? Then that means you're going to be more proactive, okay? And I still think it's good to consult registered financial representatives. They don't have to necessarily be your broker. They, there's other places they can be, accountants and other different, people out there. Plus, you can shop around. You've got the right and the ability to shop around as much as possible for your private funds. If you're with a company, well, unfortunately, then you're kind of slave to the lowest bidder for service fees, unfortunately, it seems these days. But I hope a lot of this is making sense. So the whole investment cycle can rise and fall very fast these days, and so what that means is the whole buy and hold concept for many people isn't the same as it was 30, 40, 50 years ago. Between technology and people, exactly, Don says, I think the crash of '08 changed a lot of people's mentality. I know this was the case for me, and no doubt about it. I have more than ever in my entire life, I've got more 60 and 70-year-old plus people in this room. And I've even got one 84-year-old retired Air Force pilot from the Marine Corps. And the point is that I've got lots of people that have said, that's it, I'm done. These people keep sticking it to me. Mel says, just for the record, I'm not yet 60. Thank you, Mel, for that clarification. what is that, 59 and 11 months? What are you trying to say there? That's all right. Trish will keep you young forever. She's awesome. And so the point being is that between technology, the ability for you to get access to information in a timely and affordable manner, people are much more proactive. And so that's what and so what I'm seeing is the ability to make money or lose money is just as great in, lose money in true wealth building mode is just as great as losing money in day trading, and the opportunity to make money in day trading is just as great as it is from a wealth building perspective. That's my opinion, and I kind of wanted to share my thought on that. And and also just as a reminder that a lot of the things we're about to talk about in the upcoming sections are going to have a lot of crossover applicability. Okay, so is there any question on that? If not, what we're going to do is move on to the setup section and start getting into some actual setups here shortly. So is there any questions I can answer on that? Okay. Theory points out something interesting here. Theory just says, I believe the companies will rise and fall quickly, more quickly than before. Look at MSF. I'm not sure if that's Microsoft. It took 25 years to get there. Google 7 years, and Facebook 3 years. Okay. Nice discussion. Good insight. Okay. Okay. Great. Well, what we're going to do then is we'll go ahead and, yeah, Ronald, they ultimately will be. That's the plan. And so let's go ahead then and move on to the setup section, okay? And the, let's see if, I don't know if maybe I should give everybody a quick break, or you guys want a break, or do you want to keep on plowing? I'll give it to you guys. Say break or go, break or go. Okay, well that, oh, okay, well it's, okay, so about 50 people are saying, 50-60% are saying break. Let's just do a real quick break here then. Let's go ahead and come back at 10:50. 10:50, so 8 minutes. Take a real quick break here because we've got a lot of stuff here to go through for the next several hours on setups. So let's take a quick break, recap or recoup, and then we'll get right back into it. Okay. So I will be back here in about 8 minutes or so, gang. All right, gang, we're going to go ahead and get started. Before I do, I just want to make sure you guys can see and hear me okay again. All right, great. Well, good. Thank you for those nice compliments. I appreciate it. So let's get into some of the fun stuff here and talk about setup. So first, let's answer a couple of questions about those, and then we're going to go ahead and move on. Thanks, Bob. I appreciate that. And so let's go ahead and look at this. First of all, what are the times it would be high probability to go ahead and swing trade? Hey, Caesar, nice to see you too. My Brazilian friend is back. That's great. Good. I'm glad to have you here, Caesar. Thanks so much. So, gang, again, the high probability times to trade to swing trade are in trending markets. Okay, trending markets. Now, seasonal considerations. Look, the way I feel about this is, frankly, no. Seasonality, has it had its place in the past? Yes. But you know what? This is no different in some ways from my perspective as, well, let's see. The Bears won the Super Bowl. Well, it has been a long time, right? The Bears won the Super Bowl, so the market's going to go up, okay? And the reason why I lump that into the same category, and that may seem a little strange at first, but let's think about this for a minute. Correlations, because really that's what we're talking about here, isn't it? Correlations, seasonal considerations, and then the market being correlated to a certain time or place or event, right? Well, it's really the same thing. So for me, I don't have seasonal considerations, and I suspect this will be a rather controversial discussion because of the fact, but you want my honest opinion, and so I'm going to give it to you. Correlations come and go. Seasonality, there are times where there can be an expectation, for instance, that the retailers will run up in advance of Christmas, but then, or Thanksgiving, but will then sell off after the numbers are reported, right? But do the retails run up do all the retailers run up every year over year, leading into November? Do the retailers run up every year over year, into Thanksgiving or Christmas? I'm sorry. So that's a question to the group. Yeah, the answer is no. They don't consistently run every time. Now, but from a seasonality perspective, overall, would I sit there and say, well, you know what? They usually run up in advance of the holidays, and then it's kind of the buy the rumor, sell the fact. Yeah, I would say as an overall. So could you consider that a seasonal consideration? Okay, thanks, Peggy. And could I go ahead and say there's a seasonal consideration there? Perhaps. But here's the thing, though. If there's a seasonal consideration, would I rather bank on it being a seasonal consideration, or would I rather bank on the chart saying, I've got a trend, and I'm going to go ahead and trade the trend based on a setup? So do I want to say I should buy retailer X because the market should be going up this time of year? Or do I want to go ahead and say, look, it's great, it's a retailer, so I'm going to keep an eye on it around the month of October, November, and if it happens to give me a great trend that I can take a trade off of, perfect. If not, I don't care what the seasonal consideration is. In the end, price action trumps seasonality. Exactly, Jim M. Okay, and Don said the same thing. So that's exactly right, gang, and that's what it boils down to. So is it nice to have a seasonality consideration perhaps in the back of your head? Well, maybe, but in the end, it means very little to me. Okay, it means very little to me if I don't have this. So in the end, am I going to go ahead and go out and buy 20 books and try to find out what all the seasonal considerations are out there? Or am I just going to watch charts and see, what's moving, what's trending, and what's giving me the highest probability trade? Because in the end, I don't care if what should be happening in this case, seasonally speaking, I care what is happening. So if that chart's sideways and it's Swiss cheesing back and forth through that trend, am I going to take that trade? Absolutely not. Okay. Yes, that would be more appropriate. That would be more appropriate to say that they're more of a way to find potential candidates. But will I take a setup? Will I take a trade because, oh, this is a candidate that should fall into a seasonal consideration? No. I have no setups based on seasonal considerations. Okay, I have setups based on, strategic entries based on trends and price action. Okay, so there's a difference there. Okay, so but some people, well, have you all heard the old adage, "Sell in May and go away"? How many of you have heard that before? Yeah, exactly. Sell in May and go away. Okay, well, if you, yeah, I mean, sure. So obviously, most of you have. Well, George, you're over in India, so it's more of, I think, a U.S. expression, so it's completely understandable. But for what a stupid saying. But so a lot of you have heard that. Okay, so but the bottom line is, if you did that, okay, so sell in May and go away, man. Uh, um, that's not really true, is it? But that's a seasonality, if you will, that people have put on the markets over the years, and it's not even necessarily a true adage these days. So, there's some seasonality factors that may make sense, okay? Um, like a retailer running up before Christmas or Thanksgiving, and others. But as a rule, what I'm saying is I just don't care. It's great. It might be another way to find potential opportunities, but in the end, the setups are going to be based on what's really happening, not, oh, I'm going to take this entry because September 1st, or let's call it October 15th. October 15th, people should be thinking about buying Halloween stuff, and then they're going to be thinking about shopping for Thanksgiving and stuff. So I'm going to go buy the retailer blindly today because of a seasonal consideration. No. If that chart is not there, if the chart doesn't go ahead and give me the same meaning, so basically we're not going ahead and giving the same information in the chart, forget it. Okay? That's what I wanted to go ahead and kind of focus on there. Now, if we are swing trading, then we should also have a trend and can also do speed line continuation trades. Oh, you better believe it. So whoever had asked that question, that is absolutely true. We're going to be talking about those in a few minutes. When buying on a retracement, should you buy at the 50% bounce on the daily charts, or rather wait until the price has moved up beyond the point that it retraced from originally? And a lot of that really depends on the quality of the trend. If the market is going, like for instance, in some cases, what I'm looking for is a trend to actually resume. In fact, let's go ahead and just find an example here. Let's see, I'm on the, gotta get the charts up here. Let's, give me just a moment here, gang. I'm just going to pull up a chart here. Pull up Apple. Okay, so here's an example of what we're talking about. This is Apple, okay, and so basically Apple has gone ahead and what I'm looking for is right here, this area right here. So Apple had a run up, and then it had a retracement, okay, not a bad retracement here. So the question is, well, after it runs from, let's say, here to here, am I willing to buy a retracement there? Well, based on the quality of the trend, okay, on multiple time frames, the daily and the weekly both being strong, that may make sense. Okay, but the thing is here that what you have to understand is that sometimes if the trends aren't that quality, or you've run up too far, the distance between your initial entry and the backups are too far away, sometimes it makes sense for the trend to go ahead and resume. SLC stands for speed line continuation trades. Speed line continuation trades. Okay, we're going to learn about those in a few minutes. So basically here, in this case, you can either buy on a pullback, or you wait for the trend to resume and the speed lines to get back in sync with the direction of the trend. So in other words, rather than trying to quote-unquote catch the falling knife, wait till actually the strength resumes and pull up. Now, but if you've got a good solid trend in the background, which, like I said, look at my indicators, going ape nuts here. And actually, you're going to learn about like the hockey sticks in a little bit here with the stochastics. So you've got this in the backdrop here, a nice bullish theme in the backdrop. Then it's going to make more sense to consider possibly buying a pullback on the 50%. So both answers can go ahead and be correct. And so that's what I wanted to kind of point out there. So let's go ahead and get back here. So the answer is it really depends on the quality of the trend and your risk appetite. Sometimes it makes sense for the charts to actually get back into the direction of their trend rather than trying to catch the falling knife. But if you've got a good daily, in this case daily, and a good weekly trend in place, buying those 50% pullbacks and that can make a lot more sense. Now, on an intraday basis, what would this be the equivalent to? It would be the equivalent of the 5-minute and the 15-minute charts. And in fact, that's what I do with this screen, and the gang here saw that. This chart is a 5-minute, this chart is a 15-minute chart, and I'm kind of looking at the same thing, on an intraday basis, okay? So again, the same concept can be used intraday or end of day to determine that quality of trend or whether you want to just take a trend resumption trade, okay? So that's the first thing there. Now, on a swing position, would you recommend looking at it during the day or leaving it alone until the end of the day? Typically, like when I was looking at those kind of trades, I really focused on the open and the close. Okay, what was happening near the open? Gap up, gap down. Do I want to lock in some profit, take some risk off the table? But most of the time, my trades would get put on for like an overnight type holding position, would get put on at the close of the day. Just like I do now on an intraday basis, what do I do? When do I usually take my trades? Do I take them at the close of a bar or in the middle of the bar? Unless they're a pullback trade, which it's a 3 or 5 period, moving average trade where it's pulling down to the moving average and hitting in the middle of the bar. Otherwise, if it's not a situation like that, then what I'm doing is actually taking my trades at the end of the bar, okay, like my key reversals, for instance, which we're going to talk about in a little bit. So basically, usually at the open of the session and the end of the session is when I look at. Beyond that, in the middle of the day, you're kind of setting your stops and going. Otherwise, if you're going to sit there, seriously, if you're going to sit there in the middle of the day and watch your swing trades, aren't you really just a glorified intraday day trader then? So theoretically your swing trades are meant to be designed a little bit differently, perhaps a lifestyle difference. Trying to put some of those on early in the morning, end of day, and then enjoy the middle of your day if you're doing those. So I don't really fool with a swing trade in the middle of the sessions. All right. And would you leg in on a daily chart, like an example speed line continuation trade, then the 20-period moving average, then the 30-minute for a 5 period, for a full position? The short answer is yes. So it's no different than my intraday trades for my wealth building trades, which is in my big account. So in other words, am I willing to add into the position in the direction of a strong trend? Okay. The short answer is yeah. I mean, it's the same exact concept. Am I looking at taking an entry? So in my wealth building account, am I willing to add in enter at the speed lines, add in at the 20-period moving average, perhaps even add in some more at the 35 period if I got the right kind of trend? Sure. Unless I make that trade a fill or kill kind of work or kill kind of situation right from the beginning. So if I say, look, the speed lines on this daily chart are at like $100 a share, but the 20-period moving average isn't down to like $80 a share. It's like $20. I like the trend. I think this thing is strong, but you know what? This thing has either got to work here. I'm going to go long at $100, and if it drops below 95, I'm just going to kill it. Okay, that kind of situation. So unless I set it as a work or kill, then yeah, I mean, if I've got a really strong trend. So part of it depends, are you a small swing trader account or a big swing trader account? Okay, just like a small intraday trader account versus a big intraday trader account. Okay, so the do you use your moving average, exponential moving averages similar to day trading, price swing trades on a move back to 1820? Absolutely. Like I said, these are very interchangeable, as you'll see as we go into the actual setups here in a little bit. Do you use price regression channel for planning swing trades? I personally do not, but there's nothing wrong with it. I have no issue with anybody that does. It won't take anything away from anybody that does. I just personally do not use them. Okay, so I just want to say there's nothing wrong with them from my perspective. There's a lot of things I can say there's a lot of stuff wrong with. I can't say that there's stuff wrong with price regression channels. I just don't personally use them. Okay. How to use your price action principles like the whoosh with daily charts? Well, it's not so much the whoosh that I'm looking for. It's more of the overall price action on a daily chart. What I'm looking for is the ideal swing trade long, for instance, is a nice slow bleed up at a 45-degree angle. Okay, so nice, slow, consistent, steady, bar after bar growth. You know, when we get to the situation, in fact, let me just show you a great example of that. Something we've all looked at just recently, and I've talked about. Okay, so let me show that to you. Right here, you'll see the Swissy. Okay, the Swiss franc here. We talked about this over and over and over again. Okay, didn't we? Look at that. It's beautiful from a nice, slow, steady increase. Gorgeous trend, gorgeous trend, gorgeous trend. Nice, slow, steady, 45-degree angle type stuff. That's great. Okay, that's what I'm looking for. Nice, slow, steady, consistent. That's just a beautiful chart right there, getting everything in alignment. Okay, and then, of course, like in this, there is also a lot of what my stochastic spikes as well, which we'll talk about in just a little bit here. But the point is, beautiful trends here, and but what happens is, and if you remember, gang, I went ahead and I shorted this trade up here, okay, because then it's like, okay, look, you go from this to this, then as far as I'm concerned, it's game over. Okay, so I'm looking for, from a swing trade perspective, and even frankly an intraday perspective. Again, speed line continuation trades, nice, beautiful, nice trend, 45-degree angle, slowly bleeding up, slowly bleeding up, slowly bleeding up, slowly bleeding up. What do I call slowly bleeding up? What is that price action? Slowly bleeding, slowly bleeding, slowly bleeding. What kind of trade do I call that? The go-with trade. Exactly. Or stair-stepping, grinding. I'll accept any of those answers because you understand the concept there. Exactly. But basically, it's a go-with type trade. So, but once this kind of thing happens, then for my consideration, that is a big, fat, huge sign to get out. Okay, or in my case, because I was intraday trading, I shorted, right, and made some good money there. So let's go ahead and go back then to the presentation there and look at that again, armed with that information. How to use your price action principles. The focus of the question was on the whoosh, but actually I say no. It's not the whoosh that I'm focused on. It's the slow grind at 45-degree angle wins the race. Okay? So I've got a lot of different trade setups that I want to go ahead and talk about today. And what I'm going to do is go ahead and talk about each one of these. I'm going to show 3 examples of each of these, what they look like on a chart. And then we're going to look at a whole bunch of examples of a lot of these concepts together. Okay. Was there any question, though, on the setups that, with what we just covered here first? Any question about these things before we move on to the setups there? Okay, and you guys have done a great job of holding questions to the end, so I appreciate that. That should make for a nice, easy, clean video for us to be able to cut into the different pieces for the menus and everything. So, good stuff. All right, so let's go ahead and get right into this. And what we're going to be looking at is some speed line continuation trades, trend continuation trades. And again, so now you can see kind of the abbreviations for those of you that are new to the student family there. SLCs, or stand for speed line continuations. TC20s, a lot of people ask what that means. That's a trend continuation off the 20-period exponential moving average type trade. TKRs, trading key reversals, another one of my tools. And sure, George. And then the fish hooks, crooked fingers, and stochastic spikes. Okay, so we're going to be talking about different things here. All right, speed line continuation trades. So again, just a reminder, what we're going to do is I'm going to talk with you about this, some basic factors, then we're going to look at 3 charts with examples, and then we're going to go to the next one, look at 3 charts with examples. We're going to get through all 6 of these, and then we're going to go look at a whole bunch of more examples with lots of these combined together. Okay, so what is the speed line continuation trade? It's a continuation trade off of the 3 to 5 period speed lines. Okay, so those are the little short-term lines that I use on my charts, and of course the calculation for those is right down here. So typically I label those conservative, aggressive trades. Just because of the fact that scaling may be required on those. But we're going to talk about how I really use those, by today's standards, and how you can determine your risk as we're looking at those. So we'll take a look at that. When do I use these? I use them in a trending environment. Okay. How do I calculate them? Well, it's the 3-period and the 5-period simple moving averages, and I use the high, low, and close divided by 3. Now, some people get confused on this. They think it's the high-low close divided by 3 for the 3, and high-low close divided by 5 for the 5. It's actually high-low close divided by 3 for both. It's just that one's a 3-period and one's a 5-period. Okay. Where's my entry? Well, there's actually several different types of entries on these. The ones we're going to actually be focusing on today are going to be the 3 and the 5-period based on the risk. Okay, and give me 1 second. All right, and so I apologize, Lisa, kind of froggy stuff in my throat. This guy's wild and crazy behind me last night, losing my voice already. And so where's my exit? What I will look to do is trail up the profit or to the next support or resistance level. And I'm just going to tell you right now that like since my last personal loss there, which was in July, I've been doing a lot of trailing. And I found that I'm just pound for pound, dollar for dollar, in my opinion, making a lot more money, doing the trailing. And hopefully I get to talk with you a little bit about that today. But if not, obviously when we get back to the live trading room tomorrow, we could continue that conversation. So basically trailing my exit, or just taking the full profit into the next support or resistance level if I feel there may not be a room to grow. Where's my stop? Basically a close through the 20-period moving average. I'm also going to show you some different ways to bring the cost basis down to scratch out of a trade there as well. Key points to remember: know your backup plan and any scale ins or stop outs that you're going to do before the trade is executed. And for a small contract trader, it's very important to understand the distance from the speed lines to the 20-period exponential moving average. I focus on that daily in the live trading room, so hopefully most of you know exactly what I'm referring to there. But that distance, you know, how far is it away? Is it 20 ticks, 30 ticks, 40 ticks? Yes, Dr. John, right up here, you can see SLC stands for speed line continuation trade. Speed line continuation. Okay? And so let's go ahead and take a look at some examples of these moving averages here, or these speed line continuation trades. All right. So basically, in this particular case, speed line continuations, the key is in the backdrop, I'm looking for my key features here, like the Hoffman trend and the momentum time frame analysis there, okay, the multi-time frame analysis, the MTFs, to go ahead and be pushing up. Then from there, what I'm looking for is I'm trying to get an alignment in place here. Notice that the 3 is above the 5, is above the 18, is above the 20, okay? And so here, the 3 is above the 5, is above the 18, is the 20. So I like this area right here. And so what I'm looking to do is buy pullbacks to either the 3-period or the 5-period moving average. Well, what's the difference between the 3-period or the 5-period moving average? The difference between the 3-period and 5-period is how much risk appetite. Because you can see if I buy at the 3, it may go and pull down to the 5. Okay, well the 5-period is going to be a lot closer to that 20-period moving average than the 3 in some cases, especially if the market's been moving up for quite a while. So in many cases they're very close with each other, but sometimes they can be, you know, 10, 15, 20 ticks away from each other. So I may say, you know what, instead of going and buying at the 3-period because this thing's been running up and running up and running up, I'm going to wait till it pulls back closer to the 5-period. Okay, and we can see in a case like this example right over here, that would have been actually a much better entry and left me, because instead of going and buying here and having profit up to this area, buying down here would have actually given me a wider profit opportunity. So it's basically your risk appetite, because in part there, what you're trying to gauge too is what's the distance from the fast speed line to the 20 versus the slow speed line to the 20. So what you've actually seen me do in the room is sometimes I say, look, it's just too far away. It's like the price right now is 30, 40 ticks away from the 20-period moving average, gang. So I'm going to go ahead and actually wait till it gets down here to the slow speed line to put my entry in. Okay, so you've seen me actually do that in the room. So the key is here, what I'm looking for, a couple of the key elements. I'd like to see the 3, in this case, if I'm going long, 3 above the 5, you know, and that be above the 18 and the 20, and then have the multi-time frame analysis and trend indicators in place. Okay, let's look at another example there. Okay, so here's another example right here. And so you see here, I got the alignment down below, which is awesome. Okay, the here I've got the alignment. I've got the 3 above the 5, above the 18 and the 20 here, which is what I'm looking for. So pullbacks to the 3-period or the 5-period moving average are where I'm looking to take my entries. Okay, so right now I'm just showing the entries on this. Okay, so pull back to the 3 and the 5-period, getting these in place. All right, so here's an example as well. And then here's an example. Okay, and by the way, why did I point this out right here? Because what I'm going to do, gang, through this process, anybody can go ahead and cherry pick results of like the trades that go ahead and worked perfectly, crystal clean, perfect, right? But in the real world, they're not so picture perfect, are they? Okay. And so basically, what I'm trying to do is make sure I'm showing you dirty examples and clean examples, okay? And so I'm not cherry picking. I'm actually just trying to put all the examples on the screen and highlight them for you. And what we'll do is at the end of this, then I'll take some questions. Now, from an exit perspective, there's two ways to go ahead and handle this. Okay, one is just wait until you get a close below the 20-period moving average. Or two, what I like to do is I like to determine what is the, and we're doing a lot of that behind the scenes here the next several days in the room, or in our private mentoring here amongst other things, is showing how I like to go ahead and determine what the distance is from here to here at the 20, and then bring my cost basis down. So if I take an entry up here in this area right here, so what I like to do, take the speed line trades, take the speed line trades, take the speed line trades, trail them up, trail them up, trail them up, but eventually one of those trades is not going to work. What's going to happen is it's going to pull back to the 20-period moving average. So what I'm looking to do on my last one is go ahead and add into the position down below, okay, to bring my cost basis down to that 20-period moving average and then scratch the trade. That's what I like to do. Okay, that's a key way I like to handle it. So basically, I'm trying to make money, make money, make money, make money, and then on the last one, scratch. Okay, so that's what I like to do. Now, some people, though, if they don't want to add in and they just need a simple stop structure in place, they're not going to add in. Then what they're going to want to look to do is take the trades, take the trades, take the trades, and then they can do one of two things: either stop out after a close below the speed lines. Like the close below the slow speed line, just take a stop out, or they can consider doing what I do, which is adding in down here to bring my cost basis down and then try to scratch the trade, or three, wait till it has to close below the 20-period moving average and take the stop on the last one. So there's three different ways to look for stop out opportunities, either like below the speed lines, bring the cost basis down to stop out right near the 20, or go ahead and take a stop down below. I personally prefer the second option, which is bring my cost basis down and scratch the last one. So my focus tries to be make money, make money, make money, and then scratch the last one. Okay? So that's the thing there. Now let's go ahead and look at another example of this. All right, so here's one more example, and then I'll go ahead and I'll take questions. So here you see I've got everything in alignment. Can everybody see that? This is the weekly chart, and then here is the daily chart. I've got everything in alignment here, and so I'm looking for, if I'm looking to go long, looking for the 3 above the 5, above the 18 and the 20 here. Okay, that's where I'm looking to take those longs. All right. Now, what do I mean by scratch the trade? I mean exactly what I'm going ahead and saying there, Tom. I'm talking about going ahead and bringing my cost basis down there so that when it gets a little small bump off of the 20-period moving average, because what's going to happen, especially if I've done my job and I've identified the higher quality candidates, like in a situation like this, where we've got a beautiful senior uptrend on the weekly, we got a beautiful senior uptrend on the daily, that first touch of the 20-period moving average should go ahead and bounce. And so what I'm doing is putting an order in down here and looking for it to go ahead and bounce. Okay, if it doesn't bounce, I just put my stop 5 ticks or so below where I expected it to bounce. Not a big deal. So exactly, I go ahead and I just put the extra contracts in there to bring my cost basis down to where it should bounce off of. Okay, it's a very straightforward concept. If you don't like it, don't do it. Just go ahead then and take a straightforward stop out, up above. It's pretty straightforward. You can either stop out below the slow speed line, you can wait till it goes to the 20-period moving average, or you can go ahead and close down below there. Okay? Good question. Why do I scratch it off the 20-period versus converting it to a TC20? Nick, basically it's the psychology of the matter. These were trades based on the TC20. So what's supposed to happen, Nick, and I focus very heavily, you've been with me for a while, what I focus on is what's supposed to be happening, right? And what's supposed to be happening is it's supposed to be bouncing off of the speed lines. It's bouncing, bouncing, bouncing. And if it stops bouncing off of them, then I'm looking for an exit strategy. Well, the exit strategy I'm most comfortable with is going ahead and this is me personally, and if somebody doesn't like it, that's okay, because all they've got to do is say, well, look, if it goes ahead and it closes below the slow speed line, I'm out. I'm done. Okay, no, that's fine. No worries. Or if somebody wants to use something more finite, but try to give it room to run, well, I'll wait till it closes below the 20-period moving average. But like I said, what I like to do, if I've done a good job of identifying my trend with my indicators in that, then what should happen is the first virgin touch in a senior uptrend of the 20-period moving average, what should happen is it should bounce. So I just want to bring my cost basis down, though, and my intent is to scratch that trade, not turn that what was winning trades into a potential loser by going ahead and getting cute with this one. So it's a methodology I use. Now, does that mean you can't go ahead and do that and suddenly say, well, I'm going to double dip. I'm going to go ahead and make money, 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 and then I'm going to go ahead and double dip and turn this into a TC20. Can you do that? Well, you can, but I found for me personally with my psychology, I don't like, now here's another situation. If I was not doing speed line continuation trades, if I had not done them and that this was basically turning into a failed speed line continuation trade, if this was just meant to go ahead and be an initial entry on a speed line continuation, or sorry, a TC20 trade, that's a different story. But then I'm taking the trade for a different reason. I'm taking it as an initial entry off here because I like what I see versus, well, what I was doing failed. So it's my mindset, okay? My mindset says what I was doing is no longer working. So on the last one, I just want to find the most graceful exit strategy possible. And so I want to go ahead and actually just cut the last one. So my goal is try to make money, make money, make money, make money, scratch. Okay? Can you guys go ahead and try to make money on the last one? You can, but don't turn a winner into a loser, and have win, 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 and then you add in here, and then you keep letting it go against you. Now you've just lost everything you gained back here. So, for me, that's just trying to double dip. And bears make money, bulls make money, and pigs get slaughtered. Don't be a pig. So just a couple of key thoughts, for you to think of there. David R., it's both. What I said was these entries are based on either the 3-period or the 5-period, right? Remember what we said back there? Let's go back to what we had. Where is my entry? At the 3-period or the 5-period. Okay. So let's see here. Jay, that's just what we've been talking about. So, gang, did everybody hear what we're talking about here on the exit strategy? Is what we just talked about extensively here just a moment ago. So there's 3 different types of exit strategies here from a stop strategy perspective, which is take the loss, either take a loss if it closes below, okay, the slow speed line, or do like the second option, which I mentioned, which I like, which is wait till it gets to the 20-period moving average, bring my cost basis down there, and then scratch it. Or 3, if you're trying to give it some more room to run, because obviously if you keep it if you put your stop at a few ticks below, or like a close below the slow speed line, you might get stopped out more often. So then you might go ahead and say, well, I want mine below the 5-period. If you want to know my personal Rob Hoffman preference, it's the second one, which is go ahead, keep trying to make money on the trade through trailing up, trailing up, trailing up trades, okay, doing re-entries, trailing them up, and then the one that doesn't work and pulls back to the 20-period moving average, bring that cost basis down, and then move it up, okay? So do you make these trades with the senior uptrend in the daily? Keith, absolutely. You can go ahead and make those trades. That's ideally, that would be the same thing as having a senior uptrend on like the hourly chart or so. If you can get a senior uptrend in place, Keith, that's the best. That's the best, Keith. If you can get a senior uptrend, because then you're double dipping there. Okay. Yeah, Bill, I'm not going to explain how to use the cost basis calculator today. It definitely not. We can definitely do a class on it in the room. More than happy to do that. But, I mean, gang, we're not going to be able to do is turn this into a, 2-day or 3-day course. I could spend, numerous hours talking about things, lots of different variations and deviations here, but I do want to expose you to some things. And like I said, so what we'll do is you talk about that in the room, Bill. Be happy to. Okay. Can I define a senior uptrend? Yeah, let me just really quickly, I'm looking for 6 or more bars of air where, like in this case, the low of the bar is not touching the 20-period moving average. Okay. 6 or more bars where the low of the bar is not touching the 20-period moving average. Okay. All right. So, okay, Walter, great. No problem, Luis. Diverging above. Let's see. Okay, how many clean bars with all the moving averages diverging and above each other do you wait for speed line? If we're already in a trend and it's resuming back to the upside, it can just be 1 or 2 bars, Nick. Okay. The green line is the green line here, Alex, is the 18-period moving average. The black line is the 20-period exponential moving average. So the 18 and the 20 are close to each other there. And why do I do that? Because in a really strong trend, sometimes the market will only come down to the 18-period moving average and then bounce. Okay, so the 18s, kind of front runs the 20, and sometimes if I'm feeling more aggressive, I'll take my trades closer to the 18-period moving average than the 20. All right. Okay, let's go ahead and move on then to the next section here. And I think we got the questions there. Yeah, Lee, this was meant to denote conservative aggressive, so I should have taken that off there. That was based on the old thermometer risk entry. Because of the fact that the trade can involve no, Steve P. That's only for the speed lines. This formula is only for the speed lines, not the 18 or 20 period exponential. Those are straightforward there. Lee, so conservative aggressive, that's what that was meant to be off the old scale, because scaling may be required. That's if you choose option number 2, where I went and mentioned that option number 2, remember, for the exit strategy, can be if I want to go ahead and take initial trade, add in down here to bring my cost basis down, and then get out with the scratch. Well, if you do add-ins, I consider that to be conservative aggressive. Okay, that's why I label this conservative aggressive. All right, but all things being equal, these are some of my favorite trades. So let's go ahead and move on here then to the trend continuation 20 exponential moving average. What is it? It's a more what I consider to be conservative trend continuation trade off of the 20-period exponential moving average. When do I use it? I use it in trending environments. How do I identify it? I check for a bias in the background of at least 16, 18 bars back and look at multiple time frames. So really what I'm doing each day in the room, as you see, I'm looking at the bring it down to the intraday basis for a minute, my 5-minute, 15-minute, 30-minute, hourly, and daily charts, you know that I'm looking back several bars to see are we basically trending up, down, or sideways. Okay, that's what I do. From the screen is kind of blocked off on each chart, and then what I'm looking for is where that 20-period moving average starts and where does it end. I play connect the dots, and then I see are we basically trending up, sideways, or down. Okay, so that's how I'm checking for my bias. And where is my entry? My entry will be either at the 18 or 20 period moving average. Well, we just talked about what might be the difference, right? In a strongly trending market, why might I go in at the 18? Because in a strongly trending market, as people front run, they may never go and make it to the 20 period exponential moving average. Okay, so where is my exit? That's usually either fixed into a support or resistance level. So in other words, if I go ahead and I take the TC20 trade and it goes ahead and so it's bouncing off a moving average, goes back up, either I'll hold it till it hits a resistance level above, and I'm saying, well, it might stall out there, I'm just going to take my profit. Or again, what I've really been focusing on is put more money in my pocket pound for my consideration is the trailing. Okay, so you're going to see this word on pretty much every slide because I've been finding trailing to be most advantageous for my trading. Okay, it's just another one of the good things that came out of like my loss from July. Basically, I've just, a lot of good things have come out of that, and like I said, it's been a very exciting time for me from that perspective, because and just like in general, it's not how many times you get knocked down, it's how you get up, and I always seem to do a good job of getting up, and trailing has been one of the features I've added both to my small contract trading and my wealth building trading. And of course, as you can imagine, wealth building, that can add up fast. But even in small contract trade, you guys watched here recently, we played the video where you guys were here when we took those trades like with the 4 contracts and the 9 contracts, and I wrote them up for like 25, 30 ticks a piece and walked away with almost like 3,800 bucks between those trades alone, just trailing it. Okay. Where's my stop? On this, typically, for most people, it's going to be if it closes below the 20-period moving average. What you're looking to do with this trade is really have it come down, bounce off that 20, come down, boing, and go up and get you into a profit right away. If it goes and comes down, and then actually closes down below that rising 20-period moving average, you may have misjudged the quality of the move, the quality of the trend, or you may just be legitimately in a trend change. So for most traders, probably a close below the 20-period moving average will make more sense, unless you're willing to add in down below it, like let's say, for instance, the 35-period moving average, or if, let's say, you're trading off of the 15-minute 20-period moving average, maybe you'll add into the position at the 30-minute 20-period moving average. So use that as like a back-end scaling plan. So it really depends whether you're going to scale or just stop out. Okay, and I'm discussing both because we've got both sides of we've got both types of traders here, and people are just going to have to go ahead and get used to that. Because that's kind of how it is. The way I trail any instrument that you see me trade on an intraday basis here is based on velocity. You guys have watched me go ahead and move up. My orders, roughly, like for instance, when the market's spiking back up fast in my direction, I usually keep the trade within about 5 ticks or so of my price. So if I went ahead and I enter here, and then the market starts to spike up, I'll trail it, keep it within about 5 ticks. Why? Because I don't want to make the mistake I've done in the past myself, and that many of you keep doing. I keep hearing about it over and over again. You have a profit here, and then what you're ending up doing is you're watching it spike up here, and then you watch it come all the way right back down and turn your winner into a loser. And I've already done the survey here several times, and you guys said the same thing, that yes, most of you have been guilty of watching your winners turn into losers, and that's just a sickening feeling. Yeah, Nigel, appreciate you going and sharing that with us now. And like I said, don't worry, you're in very good company because a lot of people have done that, Nigel. So So the thing is that on an intraday basis, I'm looking for velocity. What do I call that concept when I'm looking for a trade to either be trailable, or I just take the initial profit, or I try to scratch? What's the concept that I've been teaching you? The three doors. Beautiful. Excellent, gang. You make me proud. Okay. Remember, door number 1, 2, and 3. Okay. Door number 1, 2, and 3 here. So door number 1, that's the trade where it comes down. In this case, it hits my 20-period exponential moving average, bounces right up, and then I trail it, trail it, trail it, trail it, trail it on up. Door number 2 is where it comes down, bounces, and just kind of stops there. Okay, then I'm looking to go ahead and basically just take my profit. It's not getting the momentum to trail, trail, trail. Door number 3, it comes down, hits my 20-period moving average in this example, and either goes up a few ticks, goes down a few ticks, or just stays sideways, doesn't do what I expect it to do, and then I scratch the trade. Exactly. Okay? So, all right, so let's go ahead and take a look now at some examples. Again, I'm holding questions till the end of each setup's time, gang. So if you're asking questions now, you'll have to repeat those. We are keeping the format to that so that we can set this up so that we can ultimately jump back to these questions through a menu system going forward, because we're trying to increase the usefulness and snazziness of replays down the road. All right, so here's some examples then. This I've tried to use, as you notice here, gang, different instruments. Here you're going to see the volatility index, short-term futures, the VXX, okay, for those of you that are familiar with that. So here's the examples, the daily chart. First of all, what do you see here? We need a trending market, right? Well, do I have a trending market here? Do my indicators down below say it's trending? Yes, they do. Okay, that's on the daily chart. All right, well, on the weekly chart here, are they also going ahead and trending down? And do I have a negative bias? Yes, I do. Okay, so what am I looking for? Here's just different examples on different time frames here for the VXX. I'm looking for retracements back up to the 20-period moving average. Okay, or the 18-period moving average. Remember what we said, when the market's really moving hard and fast, it may not get to the 20-period moving average. So here are some examples right here. Okay, here and here. Now, why do you think that I have these two X'd out right over here? Help me out there. Well, why would I have those two X? Those are TC20 trades. Very good. Very good. You make me proud. The skipping rock theory. Okay. For those of you that are, visiting today, do not understand what the skipping rock theory is. Basically, what we're looking at there is, let me just go ahead and draw that concept out for people so that they understand, because that's important. What happens is the more times something is hit, the more likely it is to go. Actually, I don't even need this one. Let's just use this. So picture water. We were all kids once, and hopefully had a good childhood and weren't abused children, and went ahead and were able to, skip rocks on water and play as kids. And what happened was that we were able to go ahead and throw that rock, hit the water, watch it have a really nice bounce off there, and then bounce and bounce and bounce until it eventually fell through. Okay. Well, so from my perspective, with my what I call skipping rock theory, basically the first bounce is always going to be the best. Technically any time after that, the risk is that it could go ahead and fall. Technically, if you throw the rock in too deep, even on the first bounce, it can sink right in. But if you've done a good job and you skip the rock across the water to the best bounce I'm usually looking for is going to be off of that first hit of the water. Okay, and then the second one, hopefully that one will work as well. But after that, it really starts to lose market energy, and the risk is high that it's going to sink to the bottom. Okay, well, so using that same concept here, the more times I hit that 20-period moving average, okay, the more times the market goes after that, the more risk that it's actually going to actually break through, okay, to the upside. Now, like here, we'd spent months here earlier this year going ahead and in a senior downtrend. Here we finally have one hit, and man, did that thing just smack right off of my level, didn't it? Okay. So that's great. Here, it hit for the first time in several weeks. Great. Smacked right off of it. Came back up here, got up to about the 18-period moving average. All right, it rolled over again, but then it didn't take very long for it to come right back up here again. Okay, so now it's the third time, didn't take very long, and it didn't bounce that far the last time either, did it? So now I'm going to be a lot more concerned that this thing could actually turn around. Well, guess what? From a swing trading perspective, that's more or less what it did, didn't it? Did it go down a little bit more? Well, yeah, down to here it did. So could you have made a little bit of money? Yes. But in the grand scheme, what was happening was the move to the downside was getting tired. Notice how it's sideways? Well, look what that correlates to in the exact same time frame down below, right? Okay. So basically, this thing was bottoming out at the time. The market wasn't going any lower. It was bottoming out here. We actually had positive divergences starting to kick in here in some ways, okay, where we were making higher lows, but you were making lower lows in price, but higher lows in momentum. Some big warning signs coming in there on top of going ahead and having multiple tests here. Okay, so basically the first two, especially the first one, all right, highest probability, second highest probability. From here, be very careful. That's why I have them X'd out. All right. So, but you can see some real nice examples there of that. Here's Bank of America shares. All right. And Bank of America here, you'll notice that it had the TC20 on the daily chart there. Let's try and get the arrow button back up. Okay, so had a trend down. Do we have the trend down? Yep, got the trend down on multiple different things. The weekly chart was pushing down nice. I get my TC20 trade. Okay, so basically, do I have my trend? Yeah, absolutely. I got my trend totally in place there. I have a retracement back to the 20-period moving average. So am I going to look for that first test of that? Yes. Okay, now, did it go ahead and work down below here as well? Well, basically it gapped up to that level, okay? So is it technically a TC20? Well, gapping up an overnight trade, not really. A gap up to that level compared to a spiking up where it actually moves there in the middle of the day. So you just have to understand this one is going to be more risky, and consider your stop parameters. If you're going to basically play outside the normal playing field, you have to understand that it's going to be different. Now, what is this kind of trade? Well, it's actually a spike trade, but we're going to talk more about those in later on in the presentation here. Okay. So let's just take a look here at one more example. And what you'll notice I did here was intentionally made less clean examples, okay, where we went ahead and had multiple hits of the 20-period moving average, okay. And so here on the weekly basis, it came down, closed there at the end of the week. Here, on the daily chart, we came down there and closed there at the beginning of, at the end of the day. So I'm intentionally giving you more sloppy examples for you to see. Like I said, I give you picture perfect, but the market is not picture perfect. If that's what you're looking for, give up your trading. give up your swing trading, give up your investing, because if you're looking for perfection these days, you're in trouble. So what I'm trying to give you is real world examples of what these things will look like in different formats. So here you can see we've got the nice rising trend. We've got on both sides here, bullish on both of these, and so we're getting pullbacks down. So you notice it didn't gap down and open at these. It gapped down and then continued to fall down to those rising supports. Okay. In this particular case, on the daily chart. On the weekly chart, it opened up and then traded down to it. On the daily chart, it gapped down and then came down to it. Okay. Then we went ahead and had other examples of it later in give me a second there. Kind of jump back there for a second. Let's get back up to the example. Here we go. All right, so it went ahead and then we have the second and then the third attempt. Let me ask you a question, gang. Based on something that I showed you, Lee, you're gold star for Lee. Is there any one of these that should be considered potentially to be X'd out? That's right, Sam. Exactly. So how about this one right here? Should that one be X'd out? How many say no? How many say yes? How many say no? Should I X that one out? Yes? Okay. For all of you that said yes, you are absolutely correct. Had you going there, friend? And the clapping goes on in the back. You went ahead and are all correct. For all of you that said yes, it should be because it's skipping rock theory, you're absolutely right. If you also identified, Katani, very appropriately, that we've lost our senior uptrend, that is also another reason to be very skeptical of that trade. So there's different reasons to go ahead and be concerned here that this trade right here is not. Did it touch the 20-period moving average? Yes, it did. Did it ultimately work out? Yes, it did. Let me ask you a question, gang, because I don't want to get I don't want to get too much into the cross analysis right now. But actually, what kind of trade should I have actually been looking at? I'll give you a hint. Over in this area, somewhere over here, what kind of trade should I be looking at? Excellent. Alan, Jay, and Trevor were the first three to respond. Lee's been answering a lot of things, so I'll give it to Lee too. So gold stars for you four. First four to answer there. Bottom line is speed line continuation trades. I've got trend. I've got trend. I've got the 3 above the 5. I should be looking at 3 speed line continuation trades. Okay. Very nice. Okay. So, so here, like I said, intentionally gave you a little more sloppy version of this, and I'm going to do that throughout this presentation to see, clean ones and then dirty ones. Because what happens if I croak tomorrow? You have to be able to learn to understand both. Okay. And like I said, we've got our comedian who's appeared on Comedy Central sitting right behind me, and if he doesn't make me laugh enough today, I may die tomorrow because these guys kept me here late last night, and I may not have any life left in me, and so you're going to only be left with what you've learned from me before I pass away, right? Jefferson, that means you got to, there's going to be a lot of people very upset with you if I croak here. The pressure's on. So Jefferson vows to make me laugh to make all things better. But let's go ahead and, is there questions on that I can answer for you on the TC20s? Okay. What can I go ahead and answer for you on the TC20s there? Yes. Okay. A couple things here. How are you setting your initial stop on the TC20 trade? Jim, just to repeat that, that's basically if you're not willing to scale, if you're not willing to scale in a trade, so let's say you're taking the trade off of the daily 20-period moving average and you're not willing to add in at the weekly 20-period moving average. So if you're not willing to add in, then basically the stop is effectively a close back above the 20-period moving average. Okay. So so in other words, you take this trade here and then it turns around and closes above the 20-period moving average. That's that's a problem. Okay. So the let's see. Since you only check the positions twice a day there, can you explain generally how you trail them up or down with your stop? Example, do you want to wait for the end of the day to move your stop? Yeah, I mean, really, the thing is that if you're really doing them from a swing trade perspective and you've done a good job of them working out, you're not really going to be worried about sitting there watching them throughout the intraday. The only situation that may go ahead and cause you to want to actually, but even here, I mean, think about let's take a look at this real quick. Give me a second. If you really think about it, remember we looked at the Swiss franc here? Even the Swiss franc, which went ahead and, so let's say you were doing speed line continuation trades, even this one, as it was going up, you could look at it at the end of each day, okay, and even this day, so if you would have came back before the close of the day, you could have sat there and said, whoa, you know what, maybe I'm just going to go ahead and close that position out or move that stop up dramatically, okay? So it's not like it's spiked up and then turned around in the middle of the day there. Okay, if you've got, the more profit you already have built into the trade, the more judicious you can be, the more you can look at it less and not go ahead and have to worry about micromanaging it. But if you've got a smaller profit target in there, then you can look at it in intraday. But I mean, how many times are you going to look at it intraday before you become an intraday trader that's pretending to be a swing trader? Okay, so that's something that you're going to go ahead and ask yourself there. Sam says, this is explaining a lot. Thanks for going over the detail of the trades. You're absolutely welcome. Let me go ahead, and the screen kind of started flying. Let me expand the screen because it started going by there a little bit. So Don, usually looking at the beginning of the day, the end of the day, if you can look at these as much as you feel comfortable. The only thing I want to say is, at some point though, don't fool yourself and say, well, I'm a swing trader. Really what you are is a glorified intraday trader that's holding a little bit longer. Yeah, everybody's laughing behind me, but it's true though. You know what I'm saying? So let's go ahead and go to the next question here. Don't you need a senior uptrend for the speed line continuation? No, Monty, you do not need a senior trend for a speed line continuation trade. That would be you're going to get a better reaction, a more powerful reaction, Monty, off of a speed line continuation trade if you got a nice senior uptrend below you, but it's not required. Nope. Let's see. Do not you mean the stop is 20-period exponential rather than? Well, it's okay. Right. It's Robert B. It's the 20-period exponential moving average. When I said 20-period moving average, I was referring to the 20-period exponential moving average for clarification's sake there. Okay. We're talking about two different types. Remember now, DJ, great question. If you're only looking at the swing trade at the open and the close, you won't miss the pullback to the 20-period moving average. Remember though, DJ, you're looking at a trade you're in at the open and the close. If you're not in the trade, so you're hunting for trades, then you're looking for intraday to get into a trade. So what we're really talking about is, are you going ahead and there's really two different things, pre-entry and post-entry. Pre-entry, well, you're looking throughout the day, every day, if you're kind of a glorified swing day trader, if you will, where you're trying to find your next swing opportunity. So then you're looking on an intraday basis. If you're already in the positioning, then you want to not micromanage. I mean, come on. You know what I'm saying? Does that make sense? If we're going ahead and in a trade, are you going to stare at that thing constantly? It's a multi-day or multi-week trade. How often are you going to look at a multi-week trade intraday? Does that make sense? Yeah. No, you're welcome, DJ. So there's there's a distinguishment here. Pre-trade, you're looking intraday for a trade. Post-entry, now you're managing it a little more, a little less. If this were an intraday trade, would I be staring at this trade throughout the fruition of the trade? Absolutely, right? That's what I do. If I'm on an intraday trade, I stare at it repeatedly. If I'm on an end-of-day, multi-week trade or even a week-long trade, then it's a different type of trade, and I'm not going to go ahead and stare at it and micromanage it as much. So hopefully that makes sense to everybody. John N., yeah, basically volume is not showing on here because the setups that I'm taking here go ahead and are really not volume dependent, okay? And I can make as big of a deal or a little of a deal as much people would like out of volume, but I'll tell you right now, for the actual entries that I'm taking here, okay, the only time volume would really become important to me in most of these trades is on the exits. If I go ahead, remember what I'm looking for, gang. Everybody tell me what I'm looking for when I see high volume bars. What's the core? I'm looking for a trend that's coming to that's been going up for a while, right? And then I'm looking for it to be a big up bar that closes 50% or lower down below, right? Well, if I see something like that, where we've been going up, and it spikes up, and then it comes back down 50%, I really don't care if it's high volume or low volume on a swing trade. Hopefully I've made enough money throughout this thing. I'm just going to say, you know what? I'm moving my stop right up there, or I'm taking a bunch of it off the table and then put my stop out there for the rest. I don't care what the volume down below would say. I'm just going to go ahead and look at calling it quits, because basically, remember what I'm looking for. The ideal trade is that 45-degree angle slowly bleeding up, right? We've all discussed that. 45-degree angle, small baby steps, continuing up, right? If I don't get those baby steps, and I'm all of a sudden starting to get wide-range bar activity, or wide-range bar activity that closes 50% off the high, now I'm going to start getting nervous. And so really part of it was just a space constraint, but part of it is that, I mean, in this part right here, the volume is going to probably be more light. And here it's going to be heavier, and here it's going to be light, and then up here it's probably going to be real heavy. I'll bet you if you pull up a volume chart, that's probably exactly what you're going to kind of see there. But for me, when I see a market that's been going, then pulls back way off the highs, I'm going to look at going ahead and wanting to exit that. If you want to put volume on there to see that in action, that's great, not a problem. Like I said, volume's great, but based on the kind of setups I'm taking here and how I'm managing them and my experience level, I don't have to have it on this particular chart to make that multi-swing trade day decision. Okay, so it's a nicety, not a necessity there. Okay. And in general, how many times do you trade the same instrument? Since you pull out a lot of trades using speed line continuations, TC20 in a trend that lasts for months, do you ever back off? Well, actually, if a TC20 that lasts for months, that's great. Then I'm just in a trade that's going ahead and making money. So, unless I've been stopped out somewhere along the way with a profit, that's fine. As far as speed line continuation trades, where you can do is what you do with those is you basically take those trades, okay, until they finally pull back to the 20-period moving average, or what you do is you can keep taking those over and over again or until such time, if you're you see the backup, the 20-period moving average is too far away for your comfort, okay, then maybe that's when you back off, but take the trades until the spread between the speed lines and the 20-period becomes too uncomfortable. So for instance, like my strategy is, I like to go and take it until it goes ahead and then doesn't work and pulls down to the 20-period moving average. Well, if all of a sudden I'm looking at that saying, wow, that's a few hundred ticks and I'm not willing to cover that, then okay, that's where I back off, but I take the trades till that time. Okay. So you could take that trade multiple times until it comes to an end, until the circumstances for taking that no longer exist. All right. There's a couple ways to go ahead and trail your stops on any of these trades. Basically, the one thing to keep in mind is, and here's just another fine example of that. If the trade is really working out well, gang, and doing what you expect it to do, right, how much of a pullback did this really have? I mean, really, it doesn't pull back very much. It's not pulling back very much. So if it's really doing what you expect it to do, in my opinion, there's no harm in going ahead and raising it. You can do a couple things. And like I said, this is going to depend on people's individual preferences. But what you can do is go ahead and put like today, we close here. You can go ahead and either put the stop out at the 50% of this previous bar. You can put the stop out, at the high of this previous bar here 2 bars ago. Okay, so the one thing you want to go ahead and do is basically not give back a bunch of that profit. So in other words, like you're sitting right here. Wow, you've had a nice run up the last several days. Do I really want to watch this thing go from here all the way back down to here? Do I want to wait till it gets all the way back down to the 20-period moving average? You guys might, because since some of you turn winners into losers, but I don't want to. Okay, so basically then looking at this and saying, well, all right, the bar closed here today. I'm going to put it, roughly my stop at either 50% of the range or the high of the previous day, or the close down below here, or 50% of the total profit that I made. So if I've gotten in here and it's been going up, lock it in at 50% of the profit. But part of it too will depend how many contracts you have. Can you take some off the table and let the rest run? Or if you have one contract, or let's say 100 shares of a stock, then you don't really have a whole lot to split up, do you? So if you got one contract or 100 shares of a stock, then you're just going to go, chances are you're doing that because you're a smaller lot trader, then just making small incremental gains will make more sense. Okay, so there's different ways to go ahead and do the trailing, and that's why this goes ahead. You're very welcome, Andre. That's why it goes ahead and makes sense to keep in mind what your profit targets are versus saying, well, my stop is going to be 2 times the average true range, so I'm going for a profit of X number of ticks here, but my stop is going to be all the way down here because that's 2 times the normal range. Well, does that necessarily make sense? And that's why I just kind of challenge people to give that some thought. Okay, so I'm pretty, from my perspective, I'm pretty tight-lipped, or not tight-lipped, tight to the vest, close to the vest, on handling these stops, trying to lock in the profits. Will there be times where I'm going to go ahead and take a trade, get stopped out with a small profit, and then it runs? Absolutely. And you know what? I'll take that any day. I'll take that any day over what a lot of you do, which is go ahead and try to turn a winner into a loser, or try to turn a winner into a big winner, and then turn your winner into a loser. And now you're sitting there saying, "Oh my gosh, I could have made this much money. I could have done this. I could have done that." So, the case of my loss in July was a perfect example. I had $3,000 profit on the board. My rule normally says, look, the trade's not working the way I wanted it to. I've got $3,000 profit on the board. Take the money and run. That's what my rule normally says for myself. I did that for 17 months straight, I took the money and ran, and I made money, didn't have a loser. I broke that rule and said, nope, I have $3,000 on the board. I want $10,000 on the board. I'm going for the bigger win. I had a loser, right? So be careful when you guys are sitting there trying so hard to eke out every cent out of every trade, okay? You're going to develop some real self-destructive behaviors, okay? How many of you would agree with that? You try to eke out every tick out of every trade, it's going to come back and bite you. Okay, lots of agreements behind me. Yep, there you go. Okay, yep. So, all right, so a lot of agreement there. All right, and so let's just go ahead and keep that in mind. So no harm in locking in your profits there. Different opportunities there. You can. And Mike B, I like that. I like your thinking. Mike B says, "Can I trail the stop by 50% of my profits every day?" Mike B, you're my hero. You know what? Anybody that's sitting there saying, they're going to make sure that they're locking in, part of that profit. And they're making the slow, steady, incremental gains. It's going up, and they want to make sure that they're locking in some profit each day. I think that's personally awesome. Okay, it's the people that say, well, gee, you know what? Because of that rule, you got stopped out and you missed this other move. Those are the same people that are going to go ahead and they're not going to be around for the long term to tell about it because they're going to go ahead and go for the big wins. Bad things are going to happen, and those are going to be the same type of people. Then what's going to happen? Okay, here it comes. You know it's coming, right? All right. So I went ahead and I go long here. It goes up. Yeah, go, go, go. Uh-oh. All of a sudden it comes back down, and now suddenly I turn my winner into a loser. I'm like, no, no, no. I'm like, go back up, get back up. It goes up a little bit. I'm like, yeah, that's what I'm talking about. Yeah. And it gets back up, and then all of a sudden it starts going back down. And going, no, 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 go back up here. I need to get back up here and make a profit. And now all of a sudden it's going down, and it's going down, and it's going down. I'm like, oh, my God. Oh, no. Oh, man, that was stupid. Please, just let it go back up to break even, and I'll just break even on the trade. I'll just break even. So goes up a little bit here. Thinking, yeah, go back to zero, and I'll just break even. Okay, that's my promise. That's my commitment. No, goes down. Next thing you know, you've gone ahead and turned a perfectly good winner. I don't care if it's $100 or $1,000 or $10,000. You've turned a perfectly good winner into a big loss there through your stupidity. Your stupidity, okay? And I can say that with authority because that's what I did in July, right? When I took my last loss, I had a $3,000 profit on the table. Trade wasn't working the way I wanted to, but I said, I don't care. I'm used to making I want $8,000 or $10,000 on this trade, okay? So, bottom line is, I told the market, oh, no. Today you're going to give me 8 to 10 on that particular trade, okay? And, well, Mark said, no, I'll give you 3. I said, no. You're going to give me 8 to 10, okay? And the market says, I'll show you, Rob, all right? Okay? Well, several of you have been there, done it, and bought the postcard where you told the market, no, she's going to give you this much money, and then she showed you, okay? Don't be the jerk for the tick, okay? So, lesson to the wise from a guy who's been there, done it, bought the postcard. Shouldn't be the Hallmark cards, it should be the Hoffman cards. Okay? I'm trying to give you the best, most honest information and what I feel in my heart about these things. Consult your registered financial representative, see how you feel about them, see if they make sense to you, but it's certainly what I'm thinking. Okay? So, great theory. I'm glad you like that rule. Don, I'm sorry you got that terrible advice in the past. I'm glad you like my honesty here. Okay. Andre says, I'm the perfect example. Since last Wednesday, I followed your rule on the trailing stop up, $2,250 in the past 4 days. First time for me with one contract. So congratulations, Andre. Let's see, do you ever take some profits on extreme extensions from 20-period moving average and speed lines? Take some profits on extreme extensions from, I'm not sure if you mean, so like, okay, so in other words, if Lawrence, are you saying that, okay, you've gone ahead and you did an entry here and then all of a sudden it spiked up real hard here and you say, wow, that was a pretty big move. You know what, I'm just going to go and lock in some of that profit because of the range? Is that what you mean, Lawrence? Yes, the answer is absolutely. Those are the ones where I say, whoa, that's working really hard, really fast. That's awesome. Trail, 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 trail. You see me do that, Lawrence, just on an intraday basis. It's like, whoa, they gave me everything I was looking for and more. Then I immediately go guns and try to lock in as much of that as possible. So the answer is yes. Okay. That's great, John, and congratulations. I'm glad. So, Bill, we talked about that earlier. Basically, if you're in a naked position, you are at risk with a gap down. Okay, and the if you're doing swing trading, you are at risk of gap downs. There are, the reality is that if you're in a naked position in like an equity, an ETF, a futures contract, you're at risk of a gap. So the only thing you can really do with that, Bill, is you can hedge with an option, to try to mitigate some of your risk. You can go ahead and, let's say, short Apple if you buy Microsoft, try to do a pair there, okay, kind of a hedge strategy. There's different things that you can do with those. I personally, I mean, in the volatility that we're having these days, individual equities, particularly, the lesser known ones, the ones that rise and fall, overnight, there's a lot of risk with those. And so the question is, you use those kind of ones in a retirement account. Boy, that's that's a pretty risky strategy there. If you're going ahead and looking at individual equities, you have to understand the risk of gap is much higher than, say, like a ETF. Now, the ETFs do gap. Let me be clear. I'm talking about the severity of the gap. XYZ, flavor of the day stock, goes and comes out with the prognosis that they've just found the cure for cancer, shoots up from $5 to $50. Okay, all of a sudden, so here you are a couple months later, you're going ahead and trading this thing, and next thing you know, they come out with a news announcement. You know what? The FDA denied our, what's what I'm looking for? The approval letter. And so all of a sudden it goes then and immediately drops down heavily. That's going to be more prevalent, more common, more likely to happen in lesser known companies, thinner traded companies. I mean, how often do you see Apple, gap down from $300 a share to $150 a share? You know what I'm saying? I mean, can Apple have a big gap? Yeah, it can have a gap. But is it more likely it's going to be some sort of catastrophic gap in something like Apple? Not as likely. So what we're talking about is degrees of probability, okay? And so there's ways to mitigate some of your risk either through option strategies, pairing, playing with the bigger instruments, or focusing on ETFs. Is a market ETF likely to go ahead and gap from whatever, is the market itself likely to gap from 10,000 to 5,000 the next morning? Well, no, we didn't even see that back in 9/11 days, did we? It's just it's not so am I safer with an ETF perhaps than an individual equity? For me personally, Rob Hoffman, my opinion is yes. You consult yourself and you're a registered financial representative to see what's right for you. But those would be a couple of my thoughts on mitigating risk there, Bill. Okay. No, you're very welcome. I appreciate all the comments. I'm glad it's good stuff. I'm glad that's helping a lot of different things. We still got a lot to go through here, gang. So fasten your seatbelt. You know, we enjoy the ride. We've got a lot more to go through. So I told you guys this wasn't going to be 4 hours. I mean, we all knew that, right? I mean, come on. That's kind of like a joke. That's, you know, that's like saying Rob can, like, you know, just like talk for 2 minutes and shut up. You know, it's like, it's just not going to happen, you know. So, but that's okay. That's what, you know, I think that's what a lot of you want and or need. So let's go ahead and actually, yeah, let's go ahead and take a quick break because we're going to get into some, you know, pretty heavy stuff here. Some newer material for some people here, like on the key reversals and that. So why don't we do this? Let's go ahead and take another one of those little, are we going to break for lunch? Wasn't planning on it, but we'll get through a couple of these other things and see if, you know, you guys are exhausted. But my answer right now is no. We gotta, you know, so sorry. But yeah, we're just going to kind of keep going because we've got a lot of people that are overseas and it's the middle of the night for them and everything too. You know, I want to be respectful of our student family all throughout the world, not just my little grumbling stomach here in the United States. So, but let's go ahead and do this. Let's go ahead and we will restart. Why don't I do this? Here, let's just make it like 11:40. I'll give you 18 minutes, gang. 11:40 Central Time. So you get 18 minutes. And so if you that for those of you in the United States that need a little food or something, run now. You get 18 minutes. All right. I'll see you guys in just a few minutes. Okay. Bye-bye. Okay, gang. Can everybody see and hear me okay? Great. All right. Well, what we're doing here is basically, being a long story short, I went ahead and I quickly wolfed down a sandwich. I kind of caught Sarah off guard. For those of you that have been here for the private mentoring, you know that Sarah makes a mean lunch, and well, I kind of said, hey, honey, we only got 18 minutes, and she's like, you're crazy. So in about 15 minutes, some of the guys are going to have to go downstairs. We may do a quick pause while they grab some stuff and bring it back up here. And then I'll deal with the ramifications from Sarah later because she likes to be a great hostess. So what we're going to do now is go ahead and get into the next segment of this, and that's going to go ahead and be trading key reversals. All right. So let's get right into this. So so I suppose it wasn't a bologna and white bread sandwich. Mine is going to be, I'm going to be eating dog food tonight. I'm in trouble. She's mad at me. You know, because for those of you that have been here for private entry, you know, she loves to make a wonderful lunch, get her all together for you, and I'm like, oh, honey, we got 18 minutes, and she's like, you're crazy. So anyways, the gang's going to have to go back downstairs in about 15 minutes just to grab some food and come right back up. So we may pause for a quick 5 minutes while they do that. But let's go ahead and move right into this. Trading key reversals up and down. And so what is it? It's a modified key reversal, which is basically my key reversal is designed to capture resumptions, whereas most key reversals are designed to call the top and the bottom of the market. Not very successfully a lot of times, but that's what they're designed to do. Mine is actually designed to catch a trend continuation. So I'm going to go ahead and show you how those look. And we'll talk about what a regular key reversal is. And then we'll also talk about what my key reversals are. So when do I use it? I use it earlier in trending environments. And this is, again, I want to emphasize, this is for swing trading, but also for intraday trading. I've specifically taken some trades here in the room based on some of these trades. So how do I calculate it? Well, the formula is this. For a key reversal up, the low of this bar is lower than the low of bar one bar ago, and yet the close is higher on this bar than the close one bar ago. And then the key reversal down is basically the opposite. The high is higher than the high one bar ago, and the close is less than the close one bar ago. Now, I will go ahead and show the images of what I'm talking about in just a moment. Okay, so right now I'm just reviewing the basics. Okay, so where is my entry? It's basically going to be the close of the key reversal bar. Okay, where is my exit? It again, trailing is my favorite on this. Especially these days. I've really become a big proponent, truth be told, of the trailing. Since July, it's put a great deal of money in my pocket, and I've just, like I said, been quite happy with it. So I'm just being very honest and sharing those, thoughts with you guys. Or at the next key support or resistance level above or below you. So if you're long a key reversal up, but you wait, it hits a pivot point above, you go ahead and close out, for instance. Whereas the stop could be a close past the 20-period exponential moving average, because in many cases I use these like speed line continuation trades. So it's very similar. If it's a failed speed line continuation trade, then I'm going to look at it very much like the 20-period moving average, which would be to add in to bring my cost basis down to scratch, or the close past it. Okay, are two key ones that we talked about from earlier. The other thing is knowing your backup plan and scaling and stop outs before you ever get into the trade, and watch and use the direction of the Hoffman trend and multi-time frame analysis tool. Okay, so with that being said, let's look at some examples of this, and we're going to be seeing lots of examples of this as we go forward, not just the 3 pages of examples now. So, you're going to see lots of examples, so don't worry. Let's go ahead and let me see if I can actually, I was going to try to blow that up and see if I could even get it bigger. I'm not sure if I can. I don't think. Let's see if I can. Give me just a second, gang. I just want to see if I can actually somehow make that even bigger. Zoom, 100% is as high as it goes to, huh? Okay. If anybody knows a super secret way to make it super bigger, let me know. Let's try this. Oh, there we go. That's kind of what I'm looking for. Perfect. All right. That's exactly what I was looking for. All right. So basically, what I'm looking for here, and does that show up on you guys' TV over there? Okay, good. Perfect. And let's see if we can zoom it in even just a hair more. I like that. That's perfect. Okay. Oops, if I don't move the screen. Now, can everybody see that on your screens okay? So I've kind of blown up the bars. Good. Okay, thought that would help there. Perfect. All right, so let's go ahead and take a look at this. Now, what I'm looking at here, so let's walk through this. For a key reversal up, okay, what I'm looking for is the low of the current bar, okay, there's the low, to be lower than the low 1 bar ago. The low of the current bar to be lower than the low 1 bar ago, and the close, okay, which is right here, to be higher than the close 1 bar ago. So lower low, higher close than the close 1 bar ago. Let's look at another example. This bar, I know it's hard to tell because this is scrunched, but on the actual chart you can see it. This low is lower than the low 1 bar ago, and the close of this bar is higher than the close 1 bar ago. This low is lower than the low 1 bar ago. This close is higher than the close 1 bar ago. Let's look at another example. This low is lower than the low 1 bar ago, but the close is higher than the close 1 bar ago. And finally, the low of this bar is lower than the low 1 bar ago, and the close is lower. I don't, everybody's mentioning bearish engulfing, bullish engulfing and that. Yes, they do, they can be bearish engulfing and bullish engulfing, but they do not have to be, okay? All right, and so the bottom line is they do not have to go ahead and be bullish and bearish engulfings. Okay, some of these happen to be examples of where they are, but like this one right here would not be. Okay, and really this one, you know, isn't necessarily. Some of these are full engulfings. Okay, but that's just coincidence. Okay, now let's go ahead and move on to another example here. And these are more long side examples, so the next one's going to be short side examples. All right, help me out here, gang. The low is lower than the low 1 bar ago, and the close is higher than the close 1 bar ago. That's a trading key reversal up. This is a Rob Hoffman setup. This is something that I created. It's not a full-blown key reversal that people use to try to catch tops and bottoms, which the market's littered with the dead bodies of people trying to do key reversals in an uptrend down and downtrend up. So I'm trying to focus on taking trades in the the direction of the continuation. So I use it like a lot of my stuff, completely different than a lot of people do. So here we have it again. The low is lower than the low 1 bar ago. The close is higher than the close 1 bar ago. By the way, what did that one also happen to be here? A TC20, exactly. Okay, here again, the low is lower than the low 1 bar ago. The close is higher than the close 1 bar ago. Okay, now let's go ahead and just look at those examples one more time for on the long side and make sure that things add up here. What do I need? I need the Hoffman trend and multi-time frame analysis in my favor to make this work. Okay. Okay, good. I'm long there, bull side there, so good. Hoffman trend is up, perfect. Okay. Here, let's go down below. Okay, right down below here, the multi-time frame analysis is good. The Hoffman trend is good. Okay, everybody with me there? So yes, again, I'm not going to really take questions right now. I'll answer this one. The question was, where is my entry? It's at the close of the key reversal bar. Okay. All right, let's go ahead now and look at the Key reversals down. Okay. Key reversal down. A key reversal down is going to be where a high of the current bar is higher than the high 1 bar ago, and the close of the current bar is lower than the close 1 bar ago. Let's look at another example. The high of the current bar is higher than the high 1 bar ago, and the close is lower than the close 1 bar ago. Look at another example. These are all weekly charts, by the way, gang. These are weekly charts, and then over here is daily charts. Okay? And then the high of the current bar is higher than the high 1 bar ago. The close is lower than the close 1 bar ago. Now, why do I have a question mark here? Who can tell me why I might be having a question mark there? Okay, a couple people saying skipping rock, but actually, and skipping rock it was not my major concern here, to be quite honest. The real issue is that the speed lines are starting to actually come up underneath of here. I like to consider these trades the highest probability when they are in the direction of the speed lines. Okay, so see right there, okay, 3 below the 5, below the 18 and 20, fantastic. 3 below the 5, below the 18 and below the 20, fantastic. Uh-oh, 3 on top of the 5, kind of crossing over, not so good. All right, let's go ahead and look over here at another example on the daily chart. Okay, so looking at that here, oops, that's not the right arrow. Let's get the arrow. All right, here we go, another example. The high is higher than the high 1 bar ago. The close is lower than the close 1 bar ago. And I got good speed line alignment. Okay, good stuff. The high is higher than the high 1 bar ago. The close is lower than the close 1 bar ago. Okay, good stuff. That's a key reversal down, but the speed lines are coming up. So can these be used? Can these be taken? Could they make money? They can. Are they as high a probability as this right here? Nope. But if I wait just a little bit longer, I might get myself a TC20 type trade. Okay? So bottom line is that these are, those are the 3 sets of examples there. Okay, so I want to blow those up to look at those a little bit closer for you. Now, so we'll take questions. Thora's question was, can a key reversal also be a speed line continuation trade? It is. I actually have several different types of speed line continuation trades. Thora, you've probably heard me refer to the fact that I have over 5 different types, and there's actually kind of informally a 6th type as well. So this is a form of speed line continuation trade in its best form. I certainly like to go ahead, and it does add firepower to the speed line continuation trade. It's another one of my speed line continuation trade type setups. Absolutely. So that's why I'm sharing that. And so the let's see, when do you take the trade after the second close? Okay, we answered that one. Keith says there was a great example on the Russell 2000 5 minutes ago. Well, I tell you what, let's just see if our friend Keith has gone ahead and already gotten that mastered, if you will. So what I'm going to do is I'm going to actually switch this to a 5-minute chart and 15-minute chart, which is how I kind of look at these on an intraday basis anyways. And let's go right on down to the Russell 2000 here. Let's scroll up. Okay, now actually I do not see a key reversal up or down. Over here I do. Over here I do, but this is not a true key reversal down the way Rob Hoffman just showed you how to use it, isn't it? Ah, see, perfect. Key says, nope, didn't close below, sorry, but good learning experience. Okay, so there's a couple things here. Like right here, this is a key reversal down, isn't it, gang? Okay, yeah, he says, yeah, that's the one, you're correct. But look what happened here. Two things. Key reversal down, went ahead, the speed lines were crossed, and look at my momentum here. Probably not the way I want to take a trade. If I've got the speed line continuation trade here, give me 1 second here, gang. Okay, so that was Hubert, and he says hello. So the basically here, if you take a speed line continuation trade, or in this case a key reversal down trade, when my Hoffman trend is still up, you're playing with fire. Okay, so same thing right here. This is a speed line continuation trade down, but and actually this is a full-blown key reversal down as well, for that matter. High is higher, the close is well below the low. But you're going ahead. The market is littered with dead bodies of people that take these on the way up in trends. So you got to be careful. Okay, they work sometimes, they don't work others. So I try to focus on a trading key reversal in the direction of the trend. So in this case, this is a key reversal down, but this is up and this is up, so I will not take that trade. The speed lines are up. So there's a host of reasons not to take that one. So these are not good setups right here. Okay, what I'm going to be looking for that kind of setup to go ahead and emerge, this is a 5-minute chart again, is I want my speed line continuations, and then I need it to make a lower low and then close above if I'm looking for the upside. Okay, so it's got to go ahead and match. All right, so let's go ahead and take a look here and see if there's any of them that do match. Okay, here's one right here. There's one right there. The high is higher than the high 1 bar ago. The low is lower than the low, or sorry, the close is lower than the close 1 bar ago, and I have the Hoffman trend and the multi-time frame indicators. Okay, so there's one right there on a 5-minute basis. Okay, so the there's different ways to go ahead and use these. Here's another one that's right here. Okay, the high is higher than the high 1 bar ago. The close is lower than the close 1 bar ago, and you can see the multi-time frame indicators and the Hoffman trend in place. Okay, so quality of trend is very important, and taking the trade in the direction of the trend. So it's exactly the opposite of the way originally key reversals were designed to be. They were actually designed to be trying to call tops and bottoms. Well, sometimes they do that, but in a strong trend, you get those signals, those false signals. They just keep firing off, and you keep going and entering those, and it can be pretty brutal. So the key is we need to make sure that we've got a good quality of trend if we're looking to short. Okay, I want to see this red, and I want to see red up here, so I want to see blood in the streets. If I'm looking to go long on a key reversal up, then I want to see blue, and blue, okay? And the speed line's trending up, and then I want to see one of those key reversal ups in that direction, okay? So let's see here. David, I'm not sure which one you're talking about now. I didn't get to see your question. To try to hunt down, because you guys know where you're pointing and looking at this. For me, it's going to be a little bit harder. Robert B., I trade this on the 5 and the 15-minute chart on an intraday basis, but on a swing trading basis, it's off the daily and or the weekly. It's a very flexible tool. It's one that I teach amongst many other things. Obviously, here in the private mentoring things, there's a lot of these different tools that we teach, and we're going to spend the rest of the day looking at all the different things we're covering here. We went late last night. We're going to be going late this evening, looking at a lot of these things, and going heavily into a lot of that stuff. So so the time frames are easily the 5 and the 15-minute chart, for instance. You can use it on the 30-minute, the 60-minute as well. I just typically use it on the 5 and the 15 because that's usually what I'm trading off of. Okay, so the let's see here. Trying to see where we catch up. Doesn't work as well, Trevor. That's why I don't go ahead and use that. That indicator as a replacement tool has not worked. That's why I actually scrubbed it. So it's kind of like the squeeze. It'll give you that kind of that 50-50. It's a little bit better than 50-50, but it won't work as well. So that's why I kind of use it, the way I do. And you're very welcome, Linda. Good, I'm glad you like that. Yes, remember now the backup on this manual is going to be the same way as the whatchamacallit, like the regular speed lines. What you can do is one of a couple of things. So, for instance, if I'm looking to go ahead and use a continuation to the downside, right? Well, what I can do here is I'm taking this trade with the expectation that it's going to keep going down. So what I can do is, thanks Seamus, I appreciate that, and hello to you. So I'm taking a key reversal down, okay, expecting it to continue down. What I can do, if I want to take a stop out at the if it closes above the 5-minute speed line, or the 5-period speed line, excuse me, I could take a trade there, or I can wait till it closes above the 20-period moving average, right? Or like what I said I like to do, which is actually option number 2, I like to go ahead and see the I like to see it come back to the 18-20 period moving average so I can add into the position, bring my cost basis up, and then scratch it. So it's just kind of like this. It's like this same concept as the speed line continuation trades. It is one of my 5 core speed line continuation type trade setups. Okay, and then so that's what we're going ahead and talking about. Jeff, whatever the cost basis is, to go ahead and get the cost basis up into here. We're going to do another session on the my scaling tool. I already have that tool available for you, Jeff, for free in the Trader Tools section, so you can play with it yourself to see what it takes to go ahead and move it up. But like for instance, if you're trying to move up 10 ticks, if you have 1 contract in, you got to move your cost basis up 10 ticks. That takes about 3 contracts. If you've got 1 contract in, you got to move it up 20 ticks. That takes about 6 contracts. Okay, so you can just go ahead and use that tool to figure that out for yourself. Okay, and exactly, see the last part of the small lot trading video, Jeff. If you watch the small lot trading video, like you should, it's the first video you were supposed to watch when you joined me. It's at the back end of the video. Okay. So, all right. No, Keith, volume is not really an issue on that setup. The pattern itself is. When using it on a 5 or 15, which chart would you like to see the reversal? Sam, the two charts are totally independent. There's setups on either one. I'll take a setup on a 5. I'll take a setup on a 15. I'll take the setup on the daily. I'll take a setup on the weekly from a swing trading perspective. So it's either or. Okay. Okay, are you talking about this one right here? Keith? Keith says the key reversal didn't work on this bar. Okay. Why didn't the key reversal work on that bar? This is exactly what I'm warning about, Keith. This right here. See, this is what your traditional trader does, Keith. They try to use full-blown key reversals, which is exactly what this is. They're using a key reversal up in a downtrend. They're trying to catch a bottom. That's what I'm warning against. Don't try to be a top catcher or bottom catcher. You can get your butt kicked. So that's what I'm saying. I do not take trading key reversals up in a downtrend. Okay. So, and what you can't see here, but I'll roll it up here. Notice up above, look at my indicators. Okay. I cannot take a trading key reversal up in a downtrend. I take trading key reversals down. I don't try to catch tops. I don't try to catch bottoms. Okay. So, yeah, no, you're welcome. And he says that's awesome learning things. So basically what we're talking about, this right here is traditional key reversal. Low makes the lower low, the high is way above, kind of engulfs the whole thing. That's trying to catch a bottom, and then you're supposed to go long. Well, we see how well that worked out. Basically, so what I'm saying is the key is I got to focus on, being in the trade, and I take my key reversals with the trend, and my key reversals are defined differently than a traditional key reversal. So this is a Rob Hoffman key reversal. Okay, so and that'll, yeah, exactly. That's right. Dr. Phil says, by the way, Dr. Phil, it won't be too long until you're out here next month, right? So it's coming fast. Dr. Phil says there were 4 key reversals that didn't work back-to-back for different reasons here. Now, let's take a look at those. Here's one right here. Well, we already talked about that with the speed lines. Then this one here didn't work. Well, why didn't that work? That's against the trend. What about this one? This is a key reversal down. Well, the speed lines, again, are on top. And then, of course, here is a key reversal up against the trend. Stay away from this. Okay? That's bad medicine. So, I've gone ahead and talked about how I want to see those trades play out. Okay? And so what I want to see is, now, does anybody see another key reversal on this chart that I'm pointing at right now? I do. Yeah, I can't wait too, Dr. Phil. I got a great group behind me. I got Simon in here with me, and Jefferson and Tristan and Bice and Gary. What's that? You guys are funny. The peanut gallery here. Okay, nope, not the doji. And Josiane, the reason why not the doji, okay, basically the reason why the doji won't work is because it's the same close as the previous bar, so it's not really a key reversal. But for all of you that pointed out this one right here, you're correct. Okay? If you pointed out this bar right here, that is a trading key reversal down. The high is higher than the high 1 bar ago. The close is lower than the close 1 bar ago. And we've got everything in alignment. So, a couple of people saying yay. So, nice job, Sam. So, Very good. All right. So, well, I think we're good there. And like I said, what we're going to do is I've got 3 more sets of indicators to go ahead and get through. And then we're going to go ahead and look at a whole bunch of examples of all these things combined. Let's see. Is there not one halfway between the first 2 circles? Okay. If you are referring to this one right here, Robert B., is that what you're referring to? Okay. Can someone help my friend Robert there explain why that is not a trading key reversal down? Okay, my peanut gallery behind me is too smart. All right. Fortunately, I don't think you guys were able to hear them. I don't know. The microphone's kind of sensitive. It's hard to say. Let's see if my gang out there in cyberspace who can't be here with me today got it. Okay. For all of you that are saying here it did not make a higher high, you are correct. It's got to be the definition. The high of the current bar is higher than the high 1 bar ago. And then the close is lower than the close 1 bar ago. So there was no higher high. Okay? All right, and if you're looking at this one right here, this high, you can't see because of the blue line here, but this one right here was basically equal or smaller than this high right here. So it's close. You can't see it because obviously it's dark there, but clearly you're starting to get the idea there. Okay. Yes, you can, but because that's more or less a 377 tick chart, Keith, in the middle of the day trading session is effectively a 5-minute chart. So yeah, you can, but I gotta say that most of my work is based off of minute charts, not the tick charts. But that being said, you can use it off of the tick charts. We looked at that during one of my last mentoring group there several weeks ago. We were looking at that together. Okay. Let's see. The double dojis after the question mark is a key reversal up by definition, isn't it? The double dojis after. Okay. Well, actually, okay, no, see, this is a higher high, but not a lower low. So that's not a key reversal down. It's a key reversal up. So the low is lower than the low 1 bar ago, but and the high is higher than the close. So that's a key reversal up, but you don't keep key reversals up against the indications. Okay. Not really, Trevor. There are still the same trailing out positions from my perspective. So the same way we kind of talked about them earlier. You talked about one example of using like a 50% of the previous day's profits to kind of lock in there a trail. There's an example there. So no, the profits are going to go ahead and then from the speed line continuation trade, just keep pulling it down right behind it. It's the same thing as a speed line continuation trade. So the concepts are, I try to make this look, what everybody wants, let's be honest, what everybody wants is, okay, you just buy here, you just sell here, and you're going to make your millions. The reality is there's some subjectivity in trading. If there wasn't, everybody would be millionaires if it's that easy, right? So what you have to do is go ahead and focus on what I try to do to make it as quote-unquote easy as possible is try to make sure that the concepts are more quote-unquote universal between the different time frames and that they have consistency and correlations over the different types of things. So just like this key reversal is really in the family of speed lines, okay? So that's what we can do to try to help out. And so one of the things is stop management technique on that too can be used the same way as a speed line continuation trade. Let's see. For intraday trading, do you use a market order to enter after the close of the key reversal bar? You know what? That's purely subjective, but technically, yeah. Usually, I'm going to use a market order unless I'm trying to put on a big position, Renee. Okay. So most of the time here in the live trading room, you're going to see me do stuff like that with, a market order, right there at the end. Trying to be the jerk for a tick. What can happen sometimes after a bar like a key reversal, the next one can gap down or gap up and run, and you go ahead and use a a limit order and just get missed. So if it's a small contract trade, one contract using a market order shouldn't be too big of a problem. If you're going to go and dump, if it's lunchtime and you're trying to put 10 contracts out there in the Russell 2000, using a market order might cause some slippage. You know what I'm saying? You're very welcome, Renee. And let's see, to be valid, should the entry only be taken when the trend is near 45 degrees up or down? No, that's not necessary. But if it is in that 45-degree trend, Larry, what you'll find is that it's more likely to just keep going a little bit longer. You know what I'm saying? That 45-degree angle is where we kind of get those, better trends. See, if you catch it earlier in a 45-degree angle trend, it can yield longer results. Remember, this was a weekly chart over here. Here's a daily chart, in that angle and earlier on in the trend, and led to several more days of movement to the downside. Okay. So 45-degree angle is great. It perhaps increases the likelihood of a continuation. We could be in that 45-degree mode, but it's not necessary. Okay. So let's see. Do you usually use a 5-minute or 1-minute chart? I usually use 5-minute and 15-minute charts actually for the majority of my entries, Keith. I have the hourly charts, which I use for like the speed line continuations, of course. And Rob, on the 6E 5-minute chart, you have a perfect example of key reversal not to take. All right, Andre, let's go ahead and go take a look of a perfect example of a trade not to take here. So let's go ahead and take a look there. All right, so right here is a great example of one that you can take, but is lower probability. Okay, that's this one right here. Okay, because the speed lines are coming up, that increases risk. Now, one of not to take would be this right here. This is a trading key reversal up, but it's in the the downtrend. So I don't want to take a key reversal up in a downtrend. I just don't. You can do those, and you can sit there if you're sitting on your perch right now saying, but that one worked. You're going to lose a lot of money in this business because I can show you anything. I mean, a broken clock is right twice a day, gang. You know what I'm saying? So what we're really talking about there is the consistency. So I'm not going to go ahead and take key reversals down in an uptrend, or sorry, key reversals up, I'm sorry, in a downtrend. All right, but now, where's this is where the lines get a little bit gray, is right here. If you take it against the speed lines, so far I've shown you most of them ultimately work out. And a lot of times a speed line, in the direction of the trend will ultimately work out, even if it's short term against the speed lines, but it's with the Hoffman trend and multi-time frame, it'll most often work. But there's more risk associated with a market that is potentially facing a short-term trend change. So from my perspective, I'm trying to go ahead and give you the more clean, the more higher probability ones, the ones that I like the most, okay, rather than showing you 500 different types of these, because this is the kind of stuff that I show in the mentoring, how to work with these things, because then there's a whole bunch of things you got to deal with as far as managing stops and such. So I'm trying to go ahead and show you a couple of the higher probability versions of these trades to focus on. Okay, if you guys want to bend and twist my rules, you can do so as you see fit. I tend to be a little bit more cautious and conservative than most of you, but in many cases, that's helped me be more successful. So when you break the rules, bend the rules, twist the rules, crush the rules, spit on them, kick them, bad things tend to happen, and that implies to me too. Okay, so word to the wise, my friends. Let's see, do you use that reversal as a warning of possible close above speedline coming thought? Speedline coming thought. Do you use the reversal as a warning of a possible close above the speedline coming, though? So, in other words, you're saying this right here, do I say that, hey, this might actually be getting ready to resume the trend to the downside? The earlier one. This means nothing to me. This one right here means nothing to me, John. That's just a no go, no do anything with. It doesn't tell me anything. That to try to go ahead and this doesn't. I don't get cute with this. This one though, here, where the speed line, I mean, in this case, this came right back down and basically closed at the speed line. Well, now I'm going to start looking at, see if this goes and resumes to the downside, because then, while I may not take the initial key reversal down, I may look at the speed line continuation trade on the next trade. So in other words, this will be a heads up. Well, all right, maybe I don't want to take the speed line the trend reversal this particular time, but what I'm going to do is I'm going to see if it keeps pushing down. Oh, it is pushing back down. It looks like it's resuming the trend. Hey, I've got myself back into a speed line continuation trade. So this serves as a warning that it might be getting ready to resume. But because I've got the speed lines out of whack, I won't take the trade here, but I can look at taking the trade once it gets back into alignment. Make sense? Yeah, you're very welcome, gang. Okay. All right. So let's go ahead then and actually kind of get back over here to the presentation then. So that's the trading key reversals, okay, in a nutshell there. And I mean, you have to understand that I spend, days, talking about some of these different concepts that we're hitting here. I'm literally spending days here in the private mentoring. So I'm trying to give you guys a decent synopsis here of these different things. Trying to show you some good examples, some dirty examples, some no trade examples, trying to show you a couple of different things there to help you guys out. So given the fact that, we're doing the best we can, with the time we have here, which, obviously we're going to be going for a while still. So let's go ahead and talk about the next setup, okay? And that's going to be setup number 4 here, and that's the fish hooks. Okay, so the fish hooks. What is a fish hook? It's a pullback opportunity in a trend. When do I use it? Trend trades for higher probability. Okay, and here's some graphic examples of what I'm looking for with trends. I like to see it have a nice little push up and a small pullback, nice push down, a small retracement. Now, the thing is, where's the entry? Well, it's usually at the close of the bar that hooks. Okay, kind of like the key reversal bar is at the close of the key reversal. All right. Of course, we're going to go through examples of this just like the other ones, so don't worry about that. And then where is my exit? Well, again, you see that word right there. You're seeing it a lot, and kind of getting back to some old basics, that put me on the map like I am, and so trailing is ideal, or at the next key support or resistance level. Where's my stop? Well, a slow bleed and price action back down below a 20-period moving average. That's always one that gets me nervous. So that's kind of, you know, a tried and true and old faithful. So key things to go ahead and remember here: know your backup plan and scale in stop out points, if any scale in plan, okay, and stop out points. Watch and use in the direction of the Hoffman trend and multi-time frame analysis. All right, so let's go ahead and look at those right now. Now, here's a little tip and trick for you to go ahead and identify fish hooks. What you can do if you're trying to identify fish hooks is actually switch your price screen from candlesticks to line charts. Everybody see what I did there? So you're seeing the line charts. Now, if you have multiple monitors, what you can do is set up your indicators, your charts, just like you have them on the regular screens. And, you know, and so basically you have a duplicate of your candlesticks in the, you know, in the line chart version, so that you can see the, you know, the fish hooks better. So let's show some good examples and not good examples of fish hooks. Well, here you can see I've already got a couple of nice examples. Isn't that a nice little fish hook? Doesn't that look real close to what I just showed you on the presentation just a moment again, you know, a moment ago? Okay, some real nice examples there. Right here, a real nice example. Now, wait a minute. Why do I have an X through this? It spiked up and it bent, right? Went and bent. There you go. Pawan, exactly. It didn't close below. It went ahead. That bar right there, okay, that bar went up and then it closed over and actually slightly up. Let's do that again. That bar went up and closed over. That's not a fish hook. I want this and this. Okay, didn't bend down, bent up. And then what about this one right here? Why isn't that a fish hook? That's right. It's exactly. It's too deep. Exactly. What we're looking at there, that's like a church steeple. Up and right back down. That's not a fish hook. Okay. So did it work out? Yes, it did work out, but that's not it. That's not it. This is a fish hook. Up. There they are right there. Up. 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 Those are nice fish hooks. These, too deep, too angly, too church steeply. Okay? So, now, key reversal, or sorry, fish hooks up, fish hooks down. Here's the best part. And this is one of the reasons why historically I haven't shown fish hooks as much, but I'm like, look, there's enough people that get it that it's worth going in and sharing with. But here's the biggest problem that I see people misuse fish hooks on, okay? And you've heard me talk about it many times in the room. If I'm going to take a fish hook up, that means I'm expecting the market to go where? Up or down? Higher, exactly. Well, then I want a long side bias trade, right, gang? So I want the multi-time frame analysis, and I want the Hoffman trend to be up. Okay? So here we are. I want to go long. I've got an upside fish hook. Well, I need the multi-time frame indicators and the Hoffman trend to be up. Okay, I want to take upside fish hooks in an upside market. Where I see people go wrong with these a lot of times is, and it happens almost daily for people, is there's a downside fish hook in an up market, and they're like, Rob, I see one of your fish hooks. Okay, the problem is a downside fish hook is betting that it's going to go down, and I don't want to bet it's going to go down against my indicators. Okay? Does that make sense, gang? So let's go ahead and now look at, this was the 30-year bond, by the way. I'm sure, I don't know if you guys are paying attention to what these are up on top, if you're kind of seeing what I'm showing. So I'm trying to show different examples of lots of different markets. These things work on these different markets, and so that's why I'm trying to share that with you. And so let's go ahead and take a look at another set of examples of it. All right, so here's another example. Yeah, and this is Wynn Resorts, so I'm using an equity this time. And I only did that purely for the purpose of showing you guys, ETFs, equities, futures, showing you the gamut there. All right, so we've got a couple of different indicators here. This right here, by the way, is almost more of a crooked finger, which you're going to learn in the next segment. And so what I do is I kind of put this one in later, and I'm like, well, I showed the crooked finger, I'll go ahead and put it in there. So, but this one right here, and this one right here, and this one right here are actually the fish hooks, okay? So here again, these are fish hooks up with a up bias, and then up and up bias. Oh wait, I got one more fish hook right here. Is that not a beautiful fish hook? I mean, isn't that is a sweet looking fish hook? Yes, it is. That's a sweet looking fish hook right there. That is a sweet looking fish hook. Okay. Oh yeah. It's a sweet looking fish hook to the short side in an uptrend. Oh no, that's not going to work. That's not going to work. So it's not in the direction. So this is where I'm going to go ahead and get the email or the message in the room there from people that say, hey, Rob, I got this awesome fish hook there. I'm like, yeah, but that's against the trend. And then inevitably what they're going to say is, but it worked out. And I'm like, yep, and a broken clock is right twice a day. So what I want to focus on there with you, gang, is that I'm focusing on the probabilities, and playing against the trend is, I want buy signals in an uptrend. I do it pretty much the opposite of what a lot of people do. They're looking for trying to catch tops and trying to catch bottoms, like with the key reversals and stuff like that. So the that's what we're kind of looking at there. That's right. If it's a 12-hour analog clock, Walter, if it's a military time, then maybe it's only going to be right once a day. There's one in every crowd. Note to self. We find out who that Walter guy is. Just kidding, Walter. So the okay, well, that's a whole nother direction. Question, what I'm doing is, when you say adding, I'm entering a trade. I'm entering a trade here, and then I'll trail and trail and trail until it stops me out. Okay, I enter trades in, but I don't add to my position. I do not add to my position as it's going up. And it's funny, we just had a whole conversation on that last night. I showed the whole reason why not. To make a long story short, the bottom line is, so I put one contract in here, I put one contract in here, adding to my winner, put another contract in here, bring my cost basis up around here, and then all of a sudden it rolls over. Suddenly now I've got 3 contracts out there and the market's moving against me, and I'd start turning my nice little winner into a big loser. And it goes on from there. So make a long story short, no, I'm not adding to the position every time I go ahead and get a new fish hook, unless I'm still in from the original fish hook down here, and this one never stopped me out. Then I have the ability to consider adding into that one too, but I'm going to keep my stop a lot tighter then on that to make sure that the whole position remains a winner. Okay, but typically this is one entry and not quote-unquote adding to the winner. It's take the profits, then move to the next trade. Okay, so the this is the okay, Christopher, we haven't even gotten to this yet. We're going to be talking about this in a few minutes. These are stochastics. Okay, so we haven't gotten to those yet. The Dr. Phil, seem to be particularly effective when hook closes at speed line. Yes, basically. You're welcome, Christopher. That is correct, Dr. Phil. The whole key is that I'm trying to go ahead and get these pullback trades in the direction of the trend, but that the strength is so strong there that it's holding the the speed lines there. So I'm getting the setups at the speed lines in the direction of the indicators. That's what makes it so beautiful. Yep. Okay. Don, that probably answers your question. Does it make a difference that it occurs at the fish hook or the 20-period moving average or versus the speed lines? From my perspective, having it at the speed lines is even better than having it at the 20-period moving average. Can I take it if it's at the 20-period moving average? Yes, I can. Is it better if it's at the speed lines? I think it's better. It's a nicer profit opportunity, more energy in the market, more likely it's going to push right back into my direction, so on and so forth. Okay. All right. So let's just go ahead, and I kind of got off track there. You guys got me answering questions before I was done. Let me just go and go to the one other example here. This example right here actually is one of the ones I was telling you about that came up from like the Investor Business Daily scan that I was showing you how to use earlier. And yeah, I think I did a great job of going ahead, and here I've got my fish hook, nice beautiful fish hook. Got nice beautiful trend with the fish hook. Here I got another beautiful fish hook, okay, and this went up. And in case you're wondering, I mean, if you look at like what the profit is on these equities, so this closed here at like the 33.50 mark, and what you don't see here is this actually spiked up. I believe this spiked up to around the $38 area, if I recall. So not bad for a couple of days. We don't see it because it's a line chart, but I believe this spiked up actually. So, and then of course over the next several days from the weekly fish hook, this actually went on even up into the 40s, and then after that went up even beyond that. Now I would have been stopped out long before that, but the point is that this here went ahead and nice little trades there using that methodology. Okay, so that's the fish hooks. I already kind of did the Q&A on it while we were actually in the middle of that one, so I kind of messed that one up. Sorry, I meant to try to keep questions towards the end. By the way, just for a little tidbit here, I'm about to introduce you to something called crooked fingers. And the crooked fingers, this is a great crooked finger right here. Okay. So we're going to talk about those in just a few moments on the next slides. But this right here was another, great example. We're going to look at charts, a whole bunch of examples of a lot of these kind of commingled on the same charts in a minute. But here's just a nice little example where you had a daily and a fish hook and a crooked finger on the same daily chart within several days of each other. So it's kind of neat to see some of these things kind of pop up and reemerge and so on and so forth. All right, so let's go ahead, and also just one reminder I wanted to share with you that the ACTG, that was one of those that came off of the Investor Business Daily scan, so for free. All right, let's go ahead and move on to crooked fingers since we kind of did the Q&A in the middle of that one. What is it? It's a pullback opportunity and a trend again. When do I use it? Just like the fish hook, it's a trend in the middle of a trend for higher probability. And what does it look like? Well, it looks, kind of like a bent knuckle. All right. Just take your knuckles there, and you can kind of see it bends over, and then you get your finger. Kind of do that with your fingers. And so this is what a long side one looks like. Now, one of the ways to tell if you've got a good one is often when you get the third bar. So this is a 3-bar type event, okay? And what happens is, so here's bar number 1, bar number 2, bar number 3. Now, one of the ways to tell if you got a pretty good crooked finger on your hands is if you draw a line from the third bar's close to the first bar's close, do they kind of make a little rooftop? Do they kind of close the gap there or make like a little steeple, little rooftop? Okay, so like right here, close here on the bar number 3 is where it closed. Here's where bar number 1 closed. If I draw that horizontally across, will I be able to connect it? That's a pretty good fish hook, or sorry, crooked finger. That's how I kind of determine those. So where's my entry? The close of the third bar. Now how's that different than a fish hook? The fish hook's on the close of the second bar, exactly. Very good. Where's my exit? Usually looking for the trailing stops there. Where's my stop? Again, the slow bleed below the 20-period moving average, unless you're going to use the technique like I've been talking to you about, which is, like I said, wait till it gets to the 20-period moving average, bring my cost basis and up or down so that I can go ahead and scratch it. Key points to remember. Know your backup plan and scaling if there is going to be one. Otherwise, know your stop out before you take the trade. Also, watch and use in the direction of the Hoffman trend in the multi-time frame analysis. Okay, so let's look at different types of, and this is the agricultural ETF. Okay, so let's go ahead and look at examples of these. Now, why do I have this one and this one question marked? Why do I have question marks there? Okay. All right. Just making sure enough people answered. I know enough people got the concept there. And the answer is that the third bar in both these cases closed lower. If I draw my little line across, okay, and actually I drew that pretty poor. Let's go ahead and do that again. If I draw my line across, it's below the knuckle here. If I draw my line here across, it's nicely below the knuckle here. But if I go ahead and draw my line across here, I got a nice rooftop. Even here, I got a nice rooftop. Exactly. I can't make a good roof on this one or this one. Okay? So that's just, it's a guideline I use. Hey, look, did they work? Yes, they did. Absolutely. But what I'm trying to do is, because I see people come up with the freakiest things when they try to say, hey, Rob, I think I got a crooked finger. It's like, yeah, only if that crooked finger went through Hurricane Katrina. It's amazing some of the things that people will, kind of, pull up there. And so, we'll see, you know what I'm saying? It's like I'll see things all over the place. I'm like, what is that? It's like, well, that's a crooked finger. I'm like, not on my fingers. So exactly, that's right. It's a crooked finger after a bar fight. Exactly. It's like a, finger within a finger and a finger. It's a Suzy Q or something. So the, the point is there that try to keep it simple, give you some guidelines to work with. Okay, if I can draw it across and make a nice little church steeple, then it's probably higher quality. If it's down below the close of the first bar, it's going to be a little sloppier. Do they work? Yes, they can work, no doubt about it, even if they're a little sloppy. You'll probably actually see more sloppy ones than you will good, high-quality ones. But the reason why I'm trying to show you this is for exactly the reasons I outlined earlier. I want you to know what a picture-perfect one looks like, okay, what the higher quality ones look like, but I also want you to know how you might see them in the real world, and also how, because they're not going to be the true perfect, picture-perfect ones, that these ones may lead to a situation where you are faced with a, well, it's really good, I like everything I see down below, but it's just not perfect. Am I willing to take it anyways because overall, it seems to match the general characteristics as defined by our rules over here. So here's, some nice examples of what they look like, okay? So let's go ahead and take a look at some more examples over here. All right, now here I've got a question mark, and that's because this one is lower than the close of the first bar. Here I've got a question mark, and that's because the close of bar number 3 is higher than this one. Because remember, this is a fish or crooked finger down. So did they work? Yes, they did. But this is the picture perfect. This is the model citizen right here. Okay? That's the gold prize winner. All right? So I just want to make sure that people understand that. Yeah, Rich, if you did that, that's exactly right. Now, you'll notice down below, you could get rid of the RSI. Okay, if you went ahead and did it like this, where you kept your price bars along the lines of this. So if you made your price bars line charts, technically you could get rid of the get rid of the RSI if you're using the line charts. The only thing is there is still a time and a place, Rich, where you can use the RSI for swing trades. And in fact, that's kind of, like looking at one of those things here is, are we below the 50 line? Okay, then I got more of a bias to the short side. Are we above the 50 line? Then I got more of a bias to the upside. So the RSI can still be used from a swing trading perspective, more as kind of a bullish bearish barometer on the the 50 level. You'll lose that if you take that off. If you really are compelled to, if you find something else that would be more meaningful in that spot. So, but to check for crooked fingers and fish hooks, yeah, I mean you can just use a line chart, which is why I showed it. So then you could theoretically get rid of the RSI. Okay. And now Trevor's asking a question here, and gang, you tell me what you think about this. Trades with crooked fingers, fish hooks, key reversals, heading into pivots. Okay, so I'm about to go ahead and take a long side trade. Yeah, you're welcome, Rich. I'm about to take a long side trade, and I got a pivot, 5 ticks above me, but I got a great long side signal. What do you think about that? Okay. Well, the short answer is what everybody here basically said. You're taking a trade right into known resistance. Yeah, exactly. Trade a pass or trade smaller, or lock that sucker in really fast and basically scalp it for a tick or two. If you're taking a trade into a known support or resistance level, are you really following your rules for room to grow? I mean, let's just think about what we said here just a moment ago on our examples. Were you looking to trail it or at the next support resistance level? Well, if your next support resistance level is right on top of you, you're basically taking risk knowing you're going to try to get into that thing for like 1 or 2 ticks or so. So, the yeah. So basically, yeah, resistance is what it is. It's a roadblock, exactly, Vaughn. So support and resistance, they're going to be a barrier. And if it's going to be right above or right below you, it might be better to go ahead and wait to, see if it's going to actually be able to break above that. But I wouldn't then at that point be taking the trade to go ahead and see if it's any longer a crooked finger. For instance, if I go ahead and I take so let's say this is a pivot point right here. So I've got this great setup and I've got the resistance here. Well, if it breaks above right up here, am I going to take that trade then long still because there was a crooked finger down here, gang? Or because a new fresh speed line continuation trade or fish hook or something else came in here to encourage me to take a fresh trade? Yeah, I'm not going to take it because it's an old signal down here that had to use up its energy to break this. I'm going to take that trade because of a new signal that comes up above once it's broken. Okay? But taking a trade right below, taking a long right below resistance, taking a short right above support, you get what you ask for on that. If there's not a lot of room to grow and you're trying to go for the big win, things may not work out the way you were hoping for. Okay, so we've gone ahead and looked at a couple more examples here. Let's look at just two more examples of this right now. All right, are those both good examples of crooked fingers there, gang, or are those not good examples? Good examples or not good examples? Okay, gang behind me is all spoken. Giving a chance for more people to answer. Okay, and the example, the answer, gang, is they are good. Absolutely, that is a model citizen right there. Beautiful little rooftop there going across. Right here, beautiful little rooftop going across. Okay, model citizens, excellent trades. All right, on both of those 30-year bond crooked fingers. I've got the Hoffman trend. I've got the multi-time frame analysis. I've got them over here. And both of these did end up having nice little rallies before they ended up going and pulling back. Okay, and then guess what they became next? Some fishhook trades in there, right? Okay, here we're concentrating on crooked fingers, so I didn't highlight them, but there's the fishhooks. Okay. All right. Now let's go ahead and cover stochastic spikes. What is a stochastic spike? It is a short-term stochastic spike against the trend. Okay. When do I use it? I use it in a trending environment. How do I calculate it? It's the percent K4, percent K1, and percent K, actually, last one should be percent D1. So this should be K1, K4, K1, D1 is what that should be. You'll see it when you pull up your stochastic indicator there. It will go and show you. In fact, let me just do that real quick for you. I'll pull up eSignal. We'll put a little chart together right now in front of you and show you how that looks, since this is something new for many of you as well. So I told you there'd be lots of new stuff, gang. So people that missed it, that's crying shame for them. All right, let's go ahead and so what I'm going to do is I'm going to take this here, and can everybody see the blank chart on the screen? I'm going to right-click, go to Basic Studies, go down here to Stochastic. This is how I'm doing on eSignal. Okay. Now, then what I'm going to do is I'm going to go in here, change the settings, and I'm going to change that to, see, percent K4, percent K1, and percent D1. Okay. Now I like to make this a nice thick indicator, and I'll change this to blue. Okay. And voila, there's my indicator. Okay, that's how I do that. So let's go ahead now, armed with that, kind of get back to where we were. And so it's the 411. Okay, and that's the last one's supposed to be a percent K or D there. In fact, let me just go ahead and actually change that right now. I don't like the inaccuracies. Let's keep. Okay, there we go. So where's my entry? All right, it's the close of the spike bar. Ideally either above 80 or below 20. That's the one that I'm going to focus on the most today. I have lots of different entries with these, but that's primarily what we're going to be focusing on today. Where is my exit? Trailing or at or next support resistance level. So bottom line is typically trailing, otherwise at the next support resistance level. So before anybody asks, Trevor, if we're at a key support or a key resistance level, I'm not going to want to take a long, near resistance. I'm not going to want to take a short near support. And then where's my stop? It's going to be a close past the present preset stop loss number. So I'll show you what that means. So it's a little different type of stop on this. Know your backup plan and scale in and stop out points. Okay. The watch and use in direction of your Hoffman trend and multi-time frame indicators. So let's go ahead and take a look at this here and see what this means. And then we'll kind of take questions at the end there. So what I'm looking for, okay, what I'm looking for here is basically what these are. These help me identify very short-term blips against the predominant trend, okay? And so what I'm looking for here is for my indicators to go ahead, give me the signals that I've got those trends in place. And again, this now is Baidu, by the way, for those of you that were wondering. So I'm showing different equity instrument here. And so what we're looking at now is, so this is different than speed line trades and everything else. And this is one off my bookshelves. I shouldn't call it bookshelves. It's one from my book. From my notes way back in the 90s, what I ended up doing is, as I was getting ready to write this book here, I was pulling together a year's worth of notes, and it's only one of those, if I'd only remember 10% of what I've forgotten, or people could remember 10% of what I've forgotten. And so what I've been doing here in my wealth building account is I've been taking those trades, making sure that it still works the same way it did back in the 90s. So and it's like, here's another one that I want to show people because it has been working very nice. And so, we're going to be using it in the room. And so I want to kind of introduce it to people. Actually, there's a whole bunch of my tools, but I'm not sharing everything here, especially all at once, in the room. So we're going to be kind of focusing on these things. There's lots of different entry types with this. The one that I'm just going to focus on today is basically the where I've got the MTFs and the HT, the Hoffman trend and multi-time frame together, and I'm getting a pullback down below the 20 or above the 80. Those are the primary ones. Okay, so you see here in this case I've got long side market. So if I've got long side market, where do I want the stochastic spikes, the little Hoffman spikes there, to go ahead and push down to? I want it to push down to exactly under 20, spike on down here, okay? Exactly. You guys got it. So I see that, basically what they are. And again, this is a daily chart. This is a weekly chart. So you can see the concept in full use on a swing trading basis. But I'll tell you, like I said, I've been trading it live in my real live wealth building account, on an intraday basis. So here again, another concept of mine that's transferable across the time frames, and nice little aha moments for people. So here you see we got the uptrend coming in place. We get a spike down below 20. Here, uptrend in place, spike below 20. Here, uptrend in place, spike down below 20, okay? The higher that it comes from up above to down below, generally the more likely it is to go ahead and push back up. So yes, I'm going long at the close of the spike bar. Going long at the close of the spike bar. So that's right here, going long. Right here, going long. Right here, going long. The close of the spike bar. Okay? Okay? Jerry, that's a nice coincidence. It's nice to have that. That goes back to a more macro level. Remember what I said was I'd like to have the RSI above 50. That's kind of a nice little bias indicator. Same thing, if the RSI is above 50, that's a nice little bias indicator as well. But like I said, for the people that wanted to dump that, then you want to make sure you because they can't get the fish hooks or don't need the fish hooks or crooked fingers because they're going to use line charts up here, then it can give you more space on the chart. Okay? That's right. Only looking to go with the trend, Keith. Exactly. Only looking to go with the trend. I am not going to go ahead. So you'll notice here, like the spikes were like right here. This one, see how it spiked from down below, gang, up to here? I'm not going to short that. No shorts in the long market. It's the spike down in the long market where I'm looking for the long entry. Okay? Spike down in the long entry. Now, the reason why this has got a question mark, well, you guys tell me why it's got a question mark. No, this one's not counter trend. This one's not counter trend. It's not below the 20. That's right. It's not below the 20. There you go. Very good. Okay? So now there's a whole bunch of types of trades associated with these. There's what I call my hockey stick, my W's and M's. There's a lot of my Hoffman phase. There's a whole bunch of trades that go along with these. I'm just trying to keep it real simple for the purpose of this group here. And so let's see. Rob, the Russell 2000 price movement moves quite okay. You know what? I'm going to take questions at the end of this. Let me just keep on track here, and I'll take questions at the end here. All right. So here we are again, and so are we in an uptrend or a downtrend? Okay, we're in an uptrend. So do I want to take shorts when it spikes up because we're in an uptrend? No, I want to take long spikes to the downside. Okay. By the way, again, this is gold on a weekly chart. Okay. So the spike down in the uptrend. Okay. Now, okay, both of these really, this one right here is pretty much, this is at the 20 line, so I allowed this one to go ahead and stay, okay? This one here, though, is not, okay? This one here is, this one here is, okay? So, and as you can see, this is trading right up to our current time frame for gold. So, bottom line is stochastic spikes in the direction of the multi-time frame indicators, the Hoffman trend. You get the pullback down below 20. I'm looking for a long side trade. Trevor, yeah, I've actually said that like 3 or 4 times here. Let me go ahead and finish answering, looking at the last chart here, and then we'll go ahead and go through those questions. Okay, so the British pound. Okay, this is the British pound. This is a weekly chart. Okay, so British pound weekly chart. We've got the trend, the multi-time frame analysis, and we got the spike up to the 80s. Okay, Here we got the trend. I'm sorry, the trend, the multi-time frame indicators, and we've got the spike up there again. And then you can see the subsequent weekly chart activity right here and right here. Okay, and they had pretty good moves down after that for both of those. Okay, this is the British pound, and then over here you've got the spike. Same thing, it's a downtrend, so I'm looking for a spike up to short, spike up to short. Okay, Hank, you're very welcome. You'd be surprised, Hank, if you saw the material that I have. So that's why we end up, even like last night here for our mentoring group, we went into the evening, and we're going to be going into the evening again here tonight too. So in part because of the class, but to expound on a lot of these things because there's so many different techniques and variations for these. I'm just trying to show you a couple of basic ones. So right here, the bottom line is now you've seen short side and long side examples of the stochastic spike. Bottom line, trend and multi-time frame indicators in the directions. So let's go ahead and answer the question about intraday trades. I don't know if everybody heard me say this a couple of times over, but I've gone ahead and I just want to make sure you guys all understand. I've been using this. Did everybody understand that I've been using this live intraday in my real live wealth building account on the side, practicing these to make sure that they're still as good as they used to be. Because they were going to be part of my book, and I'm like, well, maybe I can introduce some of this stuff back into the live trading room. And it's like, well, before I do that, I want to make sure that I can make money with them. And if I can make money with them, then I'll go ahead and I'll introduce them to the group. Okay. So the bottom line is that what we're going to, I'm quite happy with that. So I wanted to go ahead and share this, and we'll be using those in the the room here, going forward. So I got a lot of great material. You guys should see all the stuff that I've written over the years. Over the years, I got a mountain of documents and stuff that I've created over the years. It's amazing how much I've forgotten over the years. But so as I'm getting my book together, I'm like, wow, that's a good idea. I should go back and do that, and this, and the other. So anyways, I wanted to kind of show you some different ideas and suggestions for that. Now, what we're going to do is, so we've just kind of covered the speed line continuation trades, trend continuation 20 trades, date trade. Oh, let me just go back and talk about one more thing about stops on those. So the difference between these with the stops, can you use the 20-period moving average and all that? Yes, you can. But I think for a small lot trader, what they really need to focus on this, now in the interest of disclosure, I haven't been stopped out on a single one of those stochastic trades that I've taken here recently as I was going ahead and using them. I also didn't have to add in a whole bunch of contracts either. But nonetheless, what I think for a small lot trader, because if you do get yourself where you get a spike or a runaway market, because those will happen occasionally, what you might want to do is use a numerical value. So in other words, if I go short at the close of this bar here, I may say, well, okay, I'll give this 10 ticks or 12 ticks, whatever your stop out point is, to go ahead and actually stop and reverse back down. Okay, can you use an add-in strategy? Yep, you can. And in my wealth building account, and perhaps even in the small lot account, I'll use some add-in strategy as well. But for these, just because depending on where you take it in relation to how far the market's gone down, gang, you know what I'm saying? It's one thing like here, the market went down from $1.62 down to $1.48, right? So we dropped 14 cents on the British pound in a month. Well, what can that lead to? That could lead to some pretty huge snapback rallies, right? So what you may want to do is in a situation where you've gone real far. You're not earlier in the trend, you're late in the trend. You've been going, for several bars. Then what you may want to do is just put a numerical stop in, rather if you've got a small lot account in particular, rather than going ahead and trying to say, well, I'll add in back at the 20-period moving average. Because if you've been going down for a long time, the distance between that point and the 20-period moving average could be extensive. And so for a small lot trader, the distance may not make sense. So just putting a numerical stop like you would on any other trade, might make sense. Or exactly, JC, going ahead and just wait until it gets up to the 20-period moving average, and guess what? Taking a TC20 trade. Okay. So that's one thing to go ahead and keep in mind there. When using the Hoffman trend multi-time frame analysis, do you use only positive or negative, or do you also look at which way it's trending? I think what you're referring to there is going to be, like in this case, for instance. Jim, what you're talking about is this, where, okay, it's down, but it's actually going back to the upside, okay? Now, really, from my perspective, is if I go ahead, Jim, and I see that like the weekly chart is just, brutally down, and each week is down, 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 and I see a couple of day reversal on this, I'm going to be more inclined to actually look for this. How many times, Jim, have you heard me refer to the whole reversal, going back to the zero line and reversing back to the downside? That's actually one of the most powerful trading signals out there. By the way, you've heard it many times, exactly. By the way, you guys want to see something neat when it comes to that? Can I show you something neat? Who wants to see something neat? All right, a couple of people, everybody behind me wants to see something neat. What do you got right here? What is that? How about I go ahead and I just zoom that right in for you? Let's see if you can see it now. Okay, I just showed you the rollover from the zero line, right? Look at that big fat key reversal, trading key reversal down after that rollover, James. Okay, so it had the reversal, the Hoffman trend had the reversal, okay, and then you went ahead and had the trading key reversal down. And then, of course, that was in the middle of this. That's a sweet signal right there, okay? So getting back to that, as we're looking at it, what we're talking about then is when I see that the overall direction is down on the higher time frame, so that'd be the equivalent of a 5-minute chart, and then this is the 15-minute chart, or the daily and the weekly, for instance. Okay, so the daily may be up for a few days, but the weekly is still down. I'm rather than trying to take a long side trade here against a whole bunch of stuff coming down on top of me and still having a negative overall bias, I'd rather wait till that sucker rolls right back over. It gives me fresh, sweet sell signals, and take it in the direction of the trend and watch that thing plow. Okay? Yep, you bet. All right. Yep, you're very welcome. Okay. Any other questions on that? And then we'll go ahead and get into some more goodies here. You know what? The Stoke. Try a 4 and a 1 then maybe for TradeStation, Daryl. I'll have to see if somebody can help me. I mean, this is already part of your level 1 and level 2 indicators. So any of you that have my level 1 and level 2 indicators, you should have them for TradeStation. You should already have access to this. Okay. If you have my level 1 and level 2 indicators, this indicator is already part of your package. It's already programmed for you. So anybody who has my level 1 and level 2 should already have this. Okay? That's my standard setting, exactly. The whole reason that was there, like I said, was from work of mine. There's a whole bunch of work that I can do with these. Okay? And I'm showing you one example of one tool and technique today, and more or less what I've been using, like I said, privately in the wealth building account. And then now, after we close out this webinar today, I'm going to be going back and sitting with the, my mentoring students, and I'll spend the rest of the day on these topics and many, many more. So the red and blue, if you're talking about, Tom, if you're talking about these, because those are not part of the level 1 and level 2. These are the level 3 custom indicators. They're not actually going to be available for another week and a half. It's the 22nd of September. We're almost there. So the level 3 indicators are only about a week and a couple days away. So the all right, and let's go ahead, and I think we've got the questions there. So let's go ahead, and that's correct. That's exactly right, Rich G. Under the trading room tools section. Say that 3 times real fast. All right. Well, let's do this. Let's go ahead. And so we just reviewed speed in brief, speed line continuation, trend continuation, trading key reversals, fish hooks, crooked fingers, stochastic spikes. And what we're going to go ahead and do is take a, let's see here, it's about 1:18. Let's go to, why don't we do this? Let's go to 1:30, so about 11 minutes, okay? And let's go for about 11 minutes here, take an 11-minute break, and then we're going to start going through all sorts of other stuff. Fasten your seatbelts, gang. So we're going to keep on pushing through here today, and let's just have a great day of it. So I'm going to go ahead and let's just go and stop for a few minutes here, and we'll pick right back up in a few minutes. Let me just put the little note up there, and we'll call it 1:30 Central, and just keep on plowing away. Okay? You are very welcome. We'll see you here in about 10 minutes, gang. Okay, gang, can everybody see and hear me okay? All right, fantastic. Okay, well, had to run around the house with a chicken, like a chicken with my head cut off, getting all the computers activated again for the recording stuff. So let's go ahead and pick right up on it again. And what's this? Rob Hoffman, Bruce Lee of trading. That's funny. Good. Well, I'm glad you guys are, loving it. I hope you don't mind that we're, obviously, I mean, come on. I mean, if any of you have been with me for any length of time, I mean, when can I possibly do a 4-hour webinar anymore, right? So I guess you pretty much all knew you were in for a long one today. So we're just going to keep plowing away and moving right along there. So yeah, that's right. We planned ahead. Exactly, Monty. You've been around long enough. So um, and good. I'm glad you guys are enjoying it. Rob, this has been super, super. Let's go another 8 hours. That's great. Well, I probably will be going 8 more hours with my group behind me. We've got, I said, got a long, great day, with my student family, here for the mentoring today. So it's going to be another long one tonight. All right, let's go ahead. So here comes the fun part. Let's look at several examples to drive home the learning and the memory retention. That's right, the Hoffman Marathon. You got it. And only 20 more, huh, Trevor? 20 more hours. So let's go ahead and get in here. So yes, as far as the speed line, continuation trades, I'm looking at those. I've been trading those in the afternoon as well here recently. Basically, just going ahead, like I said, for a host of reasons. Obviously, for wealth generation, and recently we've had lots of ugliness, of course, in the morning session, and some pretty high-risk stuff taking place, and then it seems like it's been smoothing out a little bit. Like when I did that special 3-day public event here like a week or so ago, it was brutal. It was just ugly, in the morning session, and then it smoothed out, and then it's like all the real money was being made in the afternoon. So, yeah, I've been doing a lot of afternoon stuff recently. That's no doubt about it. But no, it's not just in the Russell, but mainly the Russell recently. But I mean, now that the Euro is coming on board and livening up, it's very possible that a lot of my work is going to flip over to the Euro. Okay, so and Huey, yep, you are very, very welcome. I'm glad you're enjoying it. So let's go ahead and play putting together all the pieces. Okay, and so what we're going to look at right now is we've got price line, and so here, and now all these charts are going to be daily and weekly charts again because the theme here is swing trading, but I want to mention that, like I said, this is my work that, yes, it came out of my, equity trading, particularly in the 90s, but then, as you know and see, a lot of this work is exactly what's transcended into my intraday work here, and that's why I tried so hard to make sure people understand that. So this isn't just a swing trader course. It's not just an intraday trader course. It's for both, mindsets. So let's look at some different examples here, and we got several different examples. We're not going to really fly through them. We're just going to kind of go through them. And starting here with price line on the weekly charts will constantly be on the left, and the daily charts will be on the right. Okay, and so what we're looking at first of all, you can kind of see themes that I have drawn out here, trying to show what's going on down below with the various indicators. The one thing that I'm seeing here is the Hoffman trend. And the momentum indicators, of course, are very bullish here. So am I going to be looking for long side trades, or am I going to be looking for short side trades? Going to be looking for those long side trades. Okay, and so a couple things that we have here in these circles. What are these types of trades that I have circled for you? I've got 4 of them here. What do I have circled? This circle, this circle, this circle, and that circle. Okay, for all of you that said key reversals up, you are absolutely correct. The low is lower than the low 1 bar ago, and the close is above the previous close. Low, lower, close above. Low, lower, close above. Low, lower, close above. Lots of key reversals in the direction there, okay? And then we have the stochastic spike, okay? So we got stochastic spikes down here. And then we go ahead and we come over here and we have a stochastic spike as well up here. Now, for those of you, again, that were debating the whole RSI concept, just remember that one of the key reasons I have that RSI there is because of the fact that I'm just trying to see an overall bias. Am I above the 50 or below the 50? Okay, so here again, we've got the stochastic spike, okay, and we've got the overall bullish theme, and so the spike down, looking for the pop back up, okay. Here we've got the spike down, looking for the pop back up. What do we have right here? What are these two little circles? Trading key reversals, exactly, okay. Key reversals up. Now, the same thing here, stochastic spike. Now over here, there's a trading key reversal, but the key reversal it's a key reversal up, but the key reversal is actually down, taking the trade. You can't see it, but the close is below the speed lines. You know, I want to take key reversals up with a close above water, not below water. So here, it's hard to see it in there. That's all right. I'll just go ahead and kind of circle that area. It's hard to see it, but that key reversal is closing under the speed lines. Okay. Well, okay, is it a key reversal up? Yes, it is. All right. But the fact is, the simple fact is there that it's a key reversal up, but it's below the speed lines. And remember, in many ways, a key reversal trade is effectively one of the classes of a speed line continuation trade, which means in English that I want to take longs ideally above the speed lines, not below them. Okay, let's go ahead and look at some more examples here. Here's research in motion. Okay, and exactly, you need the pattern as well as the occurrence in the right place. That is correct, you bet. So nice work, Tom. All right, and that's right, Trevor, they were out of alignment. Okay, so let's go ahead and take a look at research in motion. What do I have right here, gang? What's this? Well, let's see. Is that really a key reversal down? Okay, I've got my multi-time frame analysis to the downside. I've got my trend to the downside. I've got the 3 below the 5, below the 18 and 20 there, and it's a high is higher than the previous high, and the close is below the previous close. By golly, for all of you that said you have a key reversal down, you were correct. Nice job. Okay. So I'm teasing you a little bit because I'm trying to get you to think. I'm trying not to just lead you into the answer. I want you to actually think, is it or isn't it? Okay. So right down here, what kind of opportunity is this right down in this area here? What kind of trades can you get in this area here? Speed line continuation trades. Exactly. Very nice. Okay, you go ahead. You've got your multi-time frame analysis. You've got the trend. You've got everything in place there. So we're looking for 3 and 5 period short opportunities. Okay, nice job. All right, what do we have up over here? Okay, well, there's a couple things. We have the Hoffman fade, which we didn't talk much about today. We talked about that in the room, but we have the Hoffman fade here. We've got a stochastic spike over here. And then we've got this area right here where it basically, so this is one of those, and I intentionally wanted to go ahead and show this here because basically it ended up, it went past the 20-period moving average slightly, created actually an extra sell signal, got the spike in place, and was still bearish in the backdrop here on both the daily chart, and that's what this is. This is a daily chart. And then you can see over here, so here's May, and then you've got this over here on the weekly chart. So it goes ahead and has a pop-up, gets a spike, goes ahead and hits resistance, stops at the 35-period moving average, and then goes ahead and starts to push right back down again. Comes back over here, spikes back up again, okay, Everybody see that? Spikes right back up here. And then we go ahead and have it pop down again. What does it do over here? Spikes back up. Now this time, though, it spikes back up and stops around the 75 level, not the 80 level. Okay? So I just want to show you the difference there, how, as we're looking at the same time frames, looks better off the weekly chart. There are types of trades that can be taken in this area. But then some of them here, so here's a less than 100% desirable. It's 75 level instead of the 80 level. Okay, so going ahead and just trying to show you different examples of what these can look like. Both the perfect and the not so perfect. Okay. All right, let's go ahead and look at more examples here. All right, what do we have here? Well, we got a whole bunch of stuff, don't we? We've got, wrong tool. Let's go ahead and get the right tool in there. We've got the trend in place. Okay, we've got the trend in place. We get a spike down to the 20 level. What should I be looking to do? That's right, stochastic spike, looking for long side opportunities. And this is a weekly chart. Okay, so then we go ahead, we have it again, stochastic spike, great opportunities. Hopefully just one of these ideas that I've shared with you will go ahead and more than pay for the room over the next several weeks or months. Okay, so there'll be a lot more to share as we go forward. So here we came down to the 50% level on the weekly RSI and came right back up. What did we do? We pulled back, okay, to the rising trend, had another spike down, and then it popped up. Okay, there's a spike. So we had spike, spike, spike. Okay, we had other spikes in here as well, but just highlighting a couple of examples here. All right, TC20 trades, that's correct, exactly. So lots of things going on in here. Now, so that was the weekly version. Now here's the daily version. Okay. What do we have on the daily? Now this is a little bit hard to tell what this is here, but I believe this was a situation where the close was actually higher than the previous bar's close. At a minimum, it was a speed line continuation trade, but if I recall correctly, it was also a higher close there. Okay, so it'd be a trading key reversal up as well, but it was definitely also a a speed line continuation trade, as was all this right through here, right? I mean, that's just beautiful. That's what we're looking for. We're looking for a push up, a pullback, and a resumption, and that's our go signal, getting back in alignment there when you still have the trend in place, okay? These are different types of what I call hockey sticks, different types of trades. We're not going to talk about those much today, but we'll maybe at some point we'll talk about them in the room or so. Here we had the 50% crossover, so this was more in a bearish mode, and it crossed back above the 50% level. That's why I said for those of you looking at dumping the RSI, it's something you might want to think about. That actually, keeping it, especially for the swing trading perspective, it's a bias indicator that I'm looking at. All right, so the bottom line here is then this is a great area of opportunity. What I'm looking for, where we get the speed line continuation trades, the upside, it pulls back. I get a hockey stick type trade. I got my indicators firing off, and then it resumes back to the upside, and there's some great entry opportunities right in this area, as you'll continue to see like in the live trading room there. Okay. All right, let's go ahead and look at some more. All right, this is corn. Okay. The RSI is just a 21-period RSI there, Thora. And Jim, always start on a simulator. Absolutely, because it's amazing, Jim, just like I was telling you about the and then we'll hold all the other questions till the end here, gang. But it's amazing how people will, just like with the fish hooks, Jim, I was mentioning earlier, people want to take a short side fish hook in a long side market, and they'll be like, Rob, I took one of your fish hooks and it looks so good, and I can't believe I lost money. Can you tell me what I did wrong? And I'm looking at it, it's like it's a short side fish hook in a a beautiful rampaging uptrend. Like, well, that was a sell fish hook in a long side market, wrong setup. I'm like, oh. So yeah, it helps for people to use things in a simulator environment for a while till they, figure out their flaws, the error of their ways. You know what I'm saying, Jim? So let's go ahead and look at some more examples here. You're welcome. So here, of course, we've got the momentum time frame indicators, multi-time frame indicators in the trend. We got the spike. Okay, we've got spikes down below here multiple times, hockey sticks and spikes down below. Meanwhile, we've got the nice trends in place, the speed lines. We've got the speed lines in place here and here. Again, the overall trend is to the upside. So you can see several different examples of these in action, even on the weekly chart. Then we go over here. We see the same thing on corn on the daily chart. Okay, here and here, here. Okay, lots of spikes. Then we go ahead and we have the speed line continuation trades. All good stuff right there. Okay. So again, that was corn. Now we got the 30-year bond. Let's look at some different examples of that there. Okay. So we had this nice uptrend in the background here, and then we get the stochastic spike. Okay, good stuff. Push back up. Same thing over here. Okay, here it's resuming the uptrend here, and then we get the stochastic spike. Okay, and then we go ahead and as we're over here, I believe this one right here, the reason why that was circled was because of the speed line continuation trades. See what happened? It started pushing back in the direction to the uptrend there, pull back a little bit, and then started to go up. That's one of my favorite types of trades. Those are the ones that they go and then they just start shooting off. That's very similar to like the day where I was taking those 4 and 9 contract trades where I got in, they started spiking up there. Okay. Now as we move over to the 5-minute charts, okay, we see speed line trades here, beautiful long side environment. We got the railroad tracking, the 3 above the 5 and the 18 and the 20, nice railroad tracking. What kind of indication do we have here? Oh, wait a minute, what do we have here, gang? What do we have here? This red bar right here. Let's do that. Let's go ahead and blow that bar up and see if you guys can see that there. Not sure if there we go. Okay. It's a trading key reversal down in an up market. Who is the first person that said that? Okay. All right. Well, I see Trevor, Jay, Tom, Jack. Okay. Nice job. So those of you that identified me. Okay. All of you that said it. Okay. Me. You're like me. Hold on a second, gang. Guys are going to make me choke over here. Good thing I got 5 guys behind me to perform the Heimlich. And that was great. So basically, yes, this bar right here, that is a trading key reversal down. So fortunately, that means I can short this right about here, right? So I got a trading key reversal down, so I take the short right on the close of this bar. That is absolutely not true. That is a key reversal down in an uptrend. I stay as far away from that as possible and go ahead and look right to the very next bar, which is a gorgeous key reversal up. The low is lower than the previous bar. The close is above the close of the previous close, and it is all stars in alignment. Okay? That's what we're looking for. And that very next bar jumped up a couple hundred ticks actually on that daily chart. So Good stuff there. Okay, and that's the or several ticks. I'm sorry, on the 30-year bond. So good stuff. And then we end up going ahead and back here having another stochastic spike over here. So all good stuff. Okay. And this ended up being a trading key reversal here, but it was below the speed lines, so I don't like to go and take trading key reversals that close below the speed lines. I want to take trading key reversals that close above the speed lines if I'm looking to go long. Below the speed lines, if it's a key reversal down and I'm looking to short. Okay. All right, let's go ahead and what do we have here? Okay, then you're buying. Okay, there's a couple questions here. I'm not sure if I understand, but let's see. Let's take a look. I guess I'll try to answer those real quick on this screen. Isn't it also a fish hook? Don, which one are we talking about over here? If you're talking about over here, that being a fish hook on the this one. Not sure if he's referring to third in an up market. Third. Okay, unfortunately, I'm not able to find third in an up market there. Key reversal down in an up market, is it also a fish hook? It's actually a little bit steep. It's a little bit steep there. See that angle? It's really borderline. I mean, basically what that is, that thing's going up like this, and it's coming right back down like this. You see it? Everybody, I'm talking about this right here. That came back down about 50% of the first bar. So that's a pretty deep cut. Remember, we really want to see it kind of stay up there in the top quadrant, Don. So this one's a little bit suspect. I'm sorry, this one right here is a little suspect. That's over 50% retracement. Okay. So the stochastic spike on a 5-minute, don't go into the trade if under the 20 period until the close of the bar. If under the 20 period, well, if I'm looking to go long, and so I'm not quite sure, Keith. So for a stochastic spike on this 5-minute, don't go into the trade if under the 20 period until the close of the bar. So we get a stochastic spike, and oh, I see what you're saying. I see what you're saying. Basically, is if it pulls back for a TC20, but it's also a stochastic spike, maybe wait till the close of the bar to take the long. And yeah, that's perfectly fine. Again, the best ones for these are ideally if you can get those spikes to happen higher, closer to speed line level, that's better. But yeah, if you get them on the 20-period moving average, certainly taking the trade there, you could take the trade in the middle at the TC20, make it a TC20 trade, or you could wait to see how far and how low this thing closes from the stochastic spike perspective and then enter your trade. So part of that's going to be personal preference in that particular case. But if you can get a trade that's retracing to the 20-period moving average for the first time and a stochastic spike, that's a fairly good probability trade. You can see you had the senior uptrend in the bonds, right, on the daily chart here, and it finally has this virgin touch of the 20-period moving average after all this time, and a stochastic spike. That's a pretty good gig. Okay. All right, so we can go back and look at gold in just a little bit there, Ava, when we're finished with these. Is the next green bar engulfing? By the way, Mark or Mike, you got all caps on there, so you might want to take those off. The next bar, yes, basically this bar is engulfing. This bar is engulfing here, might be. The last example, Not sure which example we're talking about, but if you're talking about right here, where would I have bought? The buy is straightforward. I go ahead and look to buy at the close of this bar, the way it's being taught today. Okay. There's other entry opportunities on how to go ahead and do more sophisticated entries, waiting for the next bar and how to place those. But for the purpose of today, we're going to go ahead and keep it real straightforward and simple. Close of this bar is what I'm looking for. Okay. All right. So let's go ahead and keep moving on here then. You're welcome. All right, so this is UUP. This is the power shares, the U.S. dollar index. Okay, UUP. So the let's take a look at a couple of things we have here. All right. Well, first of all, I got a great fish hook right here, long side fish hook, right, gang? Jack B, yes to everybody but you. Yeah, we need to catch up on the phone anyways, Jack. Okay, so that's a fish hook in a downtrend. Wrong way. Nice job, gang. You're absolutely correct. Okay? No trade. That's a long side fish hook in a downtrend. Okay, that's not going to work. All right, well, what about this little circle up here? Okay. In fact, let's just do this. You guys help me out here. Let's zoom this in and help me make sense of this. Okay. How about this circle right up here? What is going on with that circle right here? Is that a setup, a valid setup, anything going on at all? Okay. Now, two things here. A little bit of a trick question, a little bit of critical thinking. All right, this bar is a trading key reversal down, and the overall trend is down. However, you are above the speed line, so there's danger there. There's danger there because you are above the speed line. What makes more sense is to wait. So this puts you on alert and says, good stuff, I like it. But it's not quite there yet. Okay, but I like the overall theme here. Give me another sell signal and I'm good to go. All right, well, look, the market did not disappoint, did it? You didn't have to go ahead and wait too awful long. This is a weekly basis, so 5-6 weeks later, it went ahead and gave us then exactly what we were looking for. And what did we end up having here? A key reversal down. The high is higher than the high 1 bar ago, and it closes down below those beautiful little speed lines where you got the 3, the 5, then the 18, and the 20 there. Okay, so it basically went, did the 0 line rollover, and that's exactly what we're looking for. So you get your notice here. Oh, wait a minute, I got the rising speed line. You know what? Now we're going to be careful on that. We're not going to go ahead and take that trade. Okay. So, but I'm going to watch. I'm going to watch. Come on, baby. Give me a key reversal. Give me a good trade here. Give me something. Let's get the speed lines rocking again. No, no speed lines rocking again. No key reversal. Come on, come on. Bam, there it is. Okay, and then it gives us that beautiful fresh sell signal, a really nice key reversal down, and it went ahead and got the 3 below the 5, below the 20 there. Okay, so that's what we're looking for right there. Then that fired it back off again. And then if for some reason you missed that because you're just skeptical, whatever the case may be, that's okay. The market gave you another key reversal down in the direction of the trend a few weeks after that. Okay, and then it gave you another trading key reversal down back in the direction of that. Once again, a few weeks after that, in case you missed that one, and you missed that one, well, by God, it did it again for you right here. Okay? So, I mean, how many messages from the market can you miss? You know, at least it was forgiving enough to go ahead and push you right back in, right? Well, now what do we have? Here it is again, another trading key reversal down. Okay, but this one's at the speed lines here. Okay, so that's a little bit of, that's a problem, right? Okay, so what do we have here? Nothing. What do we have here? Key reversal down, but it's at the speed line. So at this point, we stop. There's nothing else there. Yeah, here you got a TC20 trade is basically about the only thing you got to work with there. But frankly, like I said, the way this was starting to come up on top of this with the speed line crosses, if this gapped up and opened there, you know, Robert, I'd be looking at that like, I might just pass on that one. So here the speed lines stink. Okay, no more trades. But there were several trades on the way down this fateful journey. Okay, now then it went ahead and got sloppy and sideways, as you can see there. Okay, so I just want to show you the difference between the higher quality and the lower on that. Now that was the weekly version. Let's go ahead and go over here to the dailies here, and you can see that this is you know, pretty sloppy. Okay, so this is what's it was happening then when it started to go sideways. So from my perspective, is there anything to do with this? Okay, and the short answer is no. The only thing you could even hope to do with this is maybe take a stochastic spike. Okay, if the overall trend is to the downside and you get a pop up, you can look to take a stochastic spike trade. But other than that, this is pretty much a mess. So you can see the higher quality versus the lower quality trades as I'm showing them to you. Hopefully they're starting to stand out to you. Okay. So the here we've got the M pattern Stokes. We've got hockey stick Stokes. You got the Stokes spikes. So there's little things going on there in different places, hockey stick spikes, the different little things going on there, but like I said, too advanced for today's discussion point here in the group here, because we have to spend hours on it. So that's what I'll be doing when we're, you know, done here today with our stuff, back with the group behind me. So so here's another example. Now here's the Russell 2000, and here's a weekly chart and a daily chart. All right, let's go ahead and see what we have here. Well, first of all, what's this right here? What's this bar right here? This is a handful today. Well, you know, I want to make it a good time and a great learning experience there. So I'm glad you're enjoying it, Dale. Okay. That is a key reversal up. You are correct. All right, what is this right here? Speedline continuation trades. I heard the audience behind me. Nice job. Okay, what is this right here? This is a lower low than this bar right here. Okay, key reversal up, and it closed above the speed lines. That's correct. It is a key reversal up. Okay, what is this right here? Okay, TC20 trade. Anything else? Yeah, basically it's a speedline continuation trade, or it's a TC20 trade. The spike didn't quite get down below the 20 down here. Okay. This is nothing, by the way, here. That was me accidentally drawing a blip as I was working on these at 2 a.m. Then this right here, okay, this whole area here, speed line continuation trade. So again, you see the Hoffman trend, multi-time frame indicators. All right, so I've got the different types of tools that I'm looking to trade with that. Then here, I've got the speed line continuation trades on the way up here. What's this right here? What's this bar right here? It's a doji. Okay. Is it anything else? Yeah, you better believe it, gang. That's a key reversal up, my friends. Take a look at that. The low is lower than the low 1 bar ago. The close is higher than the close 1 bar ago, and we are above the speed lines, and we are multi-time frame analysis go, and we are Hoffman trend go. That is a key reversal up, gang. Okay. All right. Very good. And then right down here, you get the stochastic spike. Now this closed just shy of the 20. But a dirty stochastic spike. Like I said, there's lots of variations of these. So I'm trying to show you the more clean ones and then slightly dirty ones. And that's what this is. Here's slightly dirty. Here's a little bit more of a clean one. Right back here. Okay, stochastic spike. All right. So you're getting the gist of it here. Okay, let's go ahead and take a look again now at these charts here. This is research in motion. Research in motion, whole bunch of stuff going on here. First of all, what's this bar right here? Absolutely, that is a trading key reversal down, okay, in the direction of the downtrend, and this beautiful rollover as well. I mean, those are the kind of things you live for. When I see those on an intraday basis, it's like, sweet, okay? You know, you get the rollover back up by the 0 line, get the continuation, you get the key reversal down, the speed lines in alignment. That's good stuff, okay? Now, right down here and right down here, I got two key reversals up. Key reversal up, key reversal up. I've got X's through them, though. Why is that? That's right. They are in a downtrend. Okay, that doesn't jive. Okay, buys in a sell territory, no dice. Okay, let's go ahead and look at what we got here. Let's, well, first of all, before we zoom in, what do we have here? Okay, on the daily, we get back to the 0 line, start to roll back over. Again, I love that kind of trade. We get a Hoffman fade down here, which we didn't talk about today too much, but trying to put some different types of things you've learned over time together. What do we have right here, here, and here? Well, we got stochastic spikes, right? Yeah, are they in the direction of the right trend? I'm looking at spikes up against my downtrend, so I'm looking at short. Yep, that jives, that ties. That's what I'm looking for. Okay. All right, now, but I've got this right here, and I've got this right here. These are both X'd out, but this one's 0. Why is that? Let's go ahead and take a look at that a little bit closer, because does that make any sense? Well, let's see. Okay. Yeah, and I believe this one, as I recall, was a little bit of an illusion, or I was, or actually what this was here, I can't remember if there was one of these, my late night stupors, that where it looked more like this was a key reversal down. This was more of a speed line continuation trade, is what this was. Remember, this whole market was down, research in motion. It popped up and then pushed back down over here. So it kind of looks like a key reversal down, but it was really meant to be a speed line continuation trade, the resumption, okay? This market had been coming down, coming down, coming down, spiked up to here. So you see the speed lines crossed over here, but then they went back into alignment here. So this is meant to denote the beginning of the speed line continuation trade, but then it had a key reversal up here and a key reversal up over here, but those were against the trend. So the only trade there really is in this situation is the speed line continuation trades here, okay, and here, speed line continuation trades. No key reversal here, no key reversal there. Those are X's, no go, okay? So widen that back out again and take a look at that. Like I said, heavy downtrend here. You had the spike up, and then so that killed the speed lines initially, but then they got back into alignment here. Okay. So that's good stuff. Okay. I'm not sure. Are you referring to this bar right here, Manuel? Actually, that bar didn't get higher than this bar, so it's not a key reversal. Let's go ahead and take a look at that for you. This bar here and this bar here were not, this one actually didn't make it higher. Came close, but it didn't actually make it higher. Okay. Otherwise, if it had gone just a tick or two higher, then it would have qualified. Okay. All right, let's go ahead and keep on going. So I think you guys are doing overall very well considering the amount of material I'm throwing at you today. But we've been waiting for 10 months plus for this, so I'm like, well, let's go ahead and do this here. So good. I'm glad it's fun for you too. And so here we go. Now we've got potash here on a weekly and daily basis. So potash goes ahead. Do we have an uptrend in the background? Yes, we do. And we have a stochastic spike. Okay, looking for a long side trade. Okay. Yeah, we go ahead and still have the long side bias here. And we have the spike down coming from way up above down to here. Those are the ones you usually like the most. So these are more of the, what types of trades are these? These are more sideways. These are more of the 24-hour type trades. Remember what I was telling you earlier, gang, about the multi-day, multi-week trades versus like the overnight? So for overnight trades, I don't need as much of a trend. For the multi-week holds, I need more trend, okay? But when I'm looking for a one-day trade where like I get a stochastic spike, and so I'm just looking to ride it through the next day, then I don't have to worry about it being a good quality, non-sloppy trend, okay? I don't have to worry as much, I should say. So the key there is if I get the stochastic spikes and I'm looking just to ride it through the next day's trading activity, then the quality of the trend in the recent background won't be as relevant to me as long as it's overall directionally in the way I'm looking to trade. Okay, but it won't have to be that beautiful, crisp, clean, type of trade that we see like right over here. Okay, it can be a little bit more dirty. All right, so it's one of the few times you're going to hear me say it's okay for you guys to be dirty. So, and so as far as over here, what we see on the daily chart side is we have the, this is more of a hockey stick type stochastic. Again, we're not going to be able to talk about those much today. Fell a little bit shy of the 20, but it's, again, another variation of the stochastic spike. Okay, over here, this trade is X'd out. Well, wait a minute. That's an M spike stochastic spike. Why would I have a problem with that? What's the malfunction there, gang? Okay, it's an up spike. The Hoffman trend is down. The multi-time frame is down. What's the malfunction there? Yeah, M for murder. I mean that's all good. The speed lines, exactly. The speed lines are really up there. Okay, so you start seeing something like that, start wondering if this might be the beginning of a short-term reversal. So the yeah, basically the key reversal up the key reversal up, okay, Keith, is when the low of the current bar is lower than the low 1 bar ago, and the close of the current bar is higher than the close. So the low to low is lower, but the close is higher. Low to low is lower, but the close is higher. That's a key reversal up. So it goes lower, faking people out, and then it turns around and says, ha, gotcha, and closes up and wipes those people out and back in the direction of the trend. That's more likely. Effectively, what are you getting there, gang? In English, what is that? When it goes lower than the previous lows and then turns right back around, what is it basically? It's a gotcha, a shakeout. Perfect. That's exactly right. It's a shakeout. Okay? It's just, you know, trying to run people's stops and then turn right around and go back in the direction of the predominant trend. Okay? So, exactly. All right. Let's go ahead and kill that there. Let's keep going here. All right, here's another example. This is Goldman Sachs. Gotta love Goldman Sachs. So let's take a look at Goldman Sachs. All right, as far as Goldman Sachs, what do we have here, gang? This is a weekly chart of Goldman Sachs earlier this year. Okay, high is higher than the previous high, and the close is below the close 1 bar ago. That is a key reversal down. Yes, it is. Okay, Hoffman trend and multi-time frame analysis, both tie. That is a key reversal down. Then what do we get over here and over here? We get the Hoffman spikes, right? Okay, we got the trend down again on those, and we get the spikes. All right. So very good. Now, over here, these are just different variations of spikes. Again, we're not going to go too much into those today, but you know, the Hoffman fade type spikes and such, M pattern spikes. And then here, this is a fish hook down in the direction of the overall downtrend here, just showing up on the RSI. Okay. And this right here is basically, it's a key reversal down, and I drew it because the close basically closed right down there where the speed lines were. So what's the other thing we can do for there? We could wait for the next sell signal if we want to go ahead and do that. But so again, nice, clean, solid examples and dirty examples for you to take a look at both. Okay. Look, volume is, the question is volume as important on swing trades or intraday trades? I mean, the reality is volume is, to me, there's really only one time that I use volume, and that's really during volume spikes. Okay, huge volume spikes where we get a big move, and so if the market's been going up, 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 and all of a sudden has a big spike in volume and closes like 50% off the low. So like for instance, let's say the market's been going up here the last several bars, and all of a sudden it gets a big volume spike, you know, on this bar here, and this is closing 50% off the high. I'm going to be worried that maybe it's reversing. Or if we've been going down, 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 we get a big spike in volume, it closes 50% off the low, I'm going to worry that maybe we'll start to put in a bottom. Okay, but other than that, I mean, people use different volume in different ways, and I'm quite familiar with that. I assure you, I'm quite familiar. But in the end, if you took the volume off my screen, would I go ahead and still be able to make the kind of money that I do? The short-term answer is yes, and I know some of you volume aficionados won't like that answer, but it's the honest answer. So what's really important here is the quality of these trends, and but volume has a place. Identifying areas of accumulation and distribution, but everything in between on the trends really, so what? The volume dries up. Okay, so now we just got a slow 45-degree ascent or descent on lower volume. Okay, great. So what I'm really most interested in is where there's the super spikes at the top or the bottom. So a slow bleed is good too. Yeah, you better believe it's good. A slow bleed is really, that's where the real gravy is made in a trend. The volume comes in typically at the end of trends, right? Or at least the short-term end of trends, where accumulation starts to come in, distribution starts to come in, and so the bottom line is, if you're looking or feeling like you needed a whole bunch of volume information today, the short answer is I don't really think I do. And so it's not a political statement on volume. All this is to go ahead and, I mean, for those of you that have been around me for a long time, you already know that I've worked with somebody who uses volume in the past, and how did I go ahead and actually use the volume? If you recall, I actually use my indicators directly the opposite of what the volume indicators were showing on that other person's information. Does everybody remember? That's in my video too, my advanced trading strategies video. So actually, when that system was showing signs of strength or signs of weakness, my system was actually taking trades on the exact opposite side. So the point is that, and Lance said that also, exactly. So the bottom line is, and I'm a real trader, I trade real money and so on and so forth. So I'm just going ahead and putting it out there the way I see this. Can volume be used? Yep, volume can be used, but only and I've always said that, volume, I only use the volume in very specific circumstances, not every single bar. You see what I'm saying? So the really tops and bottoms are where volume means the most to me, okay, where the market's been trending for a while and then we get huge spikes in volume. That's where it's the most meaningful to me, only to identify areas of accumulation and distribution, exactly, but not like every single bar to bar. Okay, it really kind of what it really kind of reminds me of is pit trading. People start to try to create a mysticism around pit trading, and we had this big long discussion about that yesterday. If you put this in perspective, like let me show you something real quick, and then we'll kind of get back on task. Does anybody know? From a volume perspective, let me pull up some other charts here real quick. Give me just a moment. All right, does anybody know from a volume perspective how many contracts are traded in the pit versus like the E-mini? How many, hey, thanks a lot, Sam, appreciate it. How many contracts does it take in the E-mini to equal one big S&P? Wow, there's answers all over the place there. Okay, maybe we'll go ahead and resume this conversation because the answers are all over the place, so I'm not sure if you guys will get the point. Let's do this. I'll go in, we'll talk about that in the live trading room. I've got some real interesting things to go ahead and show you guys as some eye-openers, but does anybody realize that most of the volume is now done in the E-mini versus the big S&P? Exactly. The point is the dollars in the pit are very small overall, like compared to the S&P. Most people are saying they realize that? Yeah. Maybe I'll show you some charts here tomorrow or so. We'll go back and have this conversation to make sure that so we'll just, no worries, Max. You didn't do anything wrong. people just need to go ahead and be aware of this. People think that the pit is the, oh gosh, I got to know what's going on in the pit, got to know what's on in the pit, and boy, do I got some rude awakenings for you. We just had a really great discussion on this yesterday. First of all, for those of you that don't know, yeah, the crossover was a long time ago, exactly, Lawrence. Even Vanessa, who's down in the pit, she's in our room. I mean, the action's not the pit. I mean, a lot of these traders are leaving the pits. Everybody thinks, ooh, I got to listen into what's going on in the pit. Oh, the magic's all down there. Oh, that's where it's all done. That's where all the volume's at and everything else. Well, I got news for everybody. The reality is, okay, and the dirty little secret is, a lot of the people in the pits are sitting there wondering, oh, where's that big order coming in on those S&Ps? Who is that? Who is that? Is that Goldman Sachs? Who is that putting that order in? Okay, the volume is done. A lot of the volume is done now in the S&Ps, in the E-minis versus the big contract. And I just I was going to show you. We looked at it yesterday. It was like 1/24th of the volume on a couple of the recent volatile days. 1/24th. There was 24 times more volume done. Basically, in the I believe it was 24 times is what it came out to be. More volume in the S&P E-mini compared to the big S&P, and yet everybody just wants to go ahead and know what's going on in the pit. I'm like, are you kidding me? Do you realize that the pit is not the driving force anymore? And it's kind of like that dirty little secret, but everybody thinks whether it's because of nostalgia or because of whatever, because of the bill of goods you're sold from people that are in the pits these days selling services. If you notice, there's more and more of those coming out. These people, they're like hanging up their badges, it seems like, as traders, and now selling services from the pit, saying, hey, we're in the pit, we give you the inside track, blah, blah, blah. But take a look at the volume, gang. Take a look at the volume. Is the volume done in the pit, or is the volume done in the S&P E-mini? Has anybody actually looked at that and seen how much more is in the S&P E-mini than there is in the pit itself? So, and like when Vanessa was up here, we were talking about this, in front of the rest of the people that were here for the mentoring group, and even she said, yeah, it's kind of like this. The people in the pit are sitting there wondering, who is that? Who's got that big order out there in the S&Ps? Who is that sticking it to us? And even back in the day when the pit was vibrant, what did people do when they had a big order to work? So if Goldman Sachs has got this huge order to work, did Goldman Sachs send all of their orders to the one guy in the pit that everybody knows works with Goldman Sachs? Nope, they sure didn't. They went ahead and distributed it. They spread it out amongst different people so that people didn't know who was going ahead and working the orders. So, I hate to break the bubble. You know what I'm saying? I mean, I kind of feel like a jerk for saying, sorry, there's no Santa Claus here. But, I mean, the reality is, what I'm telling you is the truth. So, I just think the advantage is, people need to understand that, a lot of these things that they're looking at for their guidance, they just don't really realize that, the pits are kind of a dying place, and a lot of these on-floor traders are moving off-floor, and a lot of them that are in the floor are like, who is that? Who's putting that big order out there in the E-minis? Goldman Sachs and a lot of these other big companies these days, are they going to the campuses? Are they going to Harvard, Yale, and all the different campuses to go and say, wow, I think that person over there would be a great candidate to go ahead and cold call mama and papa, for their money? Or are they going and hiring supercomputer users and programmers and, people that they can use to develop computerized tools, out there? Which is it? Yeah, they're going to get the programmers and that. Exactly. Exactly. So, so that's what you have to understand, is that it's about a computer game these days, if you will. Not just a, okay, wow, the pit's so great, we're going to dump all of our size in the pits. Okay, so I guess I've gone ahead and harped on that point enough, but what I would just say is, for anybody that doesn't get what I mean, take a look at the SP pound F volume versus the ES pound F volume. Okay, and it could be very illuminating, for you. And so Lawrence says the irony is that the S&P Mini was constructed to feed the pit, but now all the volume power is all in the Mini S&P, so not in the pit. You're right on, Rob. So absolutely, and gang, I've trained people who have gone ahead and moved off floor, okay? And they've told me, that's not just marketing BS. You guys know I don't BS you. I'll just tell you the way it is. I've worked with people in Downers Grove, Illinois that went ahead, and these people are moving off floor. They're at this, for lack of a better word, trading arcade down in Downers Grove there, and they've moved off floor. I've gone down, and for those of you that have been with me for a long time know I've done multiple presentations to those groups down there, and the reality is that they've moved off floor for a reason, and they've said there isn't an advantage. Vanessa, who's in there in the pit, talks about many of the same very things here. She was just up at my house here a couple weeks ago and gave me that really wild and crazy gift she gave me, and Sarah, and she's awesome. But the point is, I'm hearing it from the people who are coming off the pit, coming out of the pits. You could see it in the volume itself that the pits are kind of drying up. So for those of you that are buying services to get direct access to the pit, just kind of keep a couple of those thoughts in mind and see how that relates to your trading. Okay, so moving on then about volume, in closing on the subject, for most of what we're looking at here, from day to day in the middle of a trend, the types of trades we're taking with key reversals, speed line continuations, volume will not be a factor. If anything, I actually want to see lighter volume than heavier volume. I want to see that nobody's listening, nobody's caring about what's going on as this thing is dropping. So if anything, I'd like to go ahead and see the pushing down with volume here. Then all of a sudden it goes quiet here, and then has a big drop, and then all the volume comes back in down here again. That would make sense. Okay, so but from bar to bar, is volume as important to me? No, not as bar to bar as some people would have you, think is necessary. So I hope everybody doesn't mind my honesty and my candor about it. But I'm just trying to go ahead and just, I guess, tell it like it is from my perspective, my story, me as a real trader, not just selling a service, but going ahead and being a real trader. As you guys know, I trade very real and very large amounts of money, and I'm just trying to put it in perspective and frame it up for you. So I guess I'll leave it at that. Okay, so going ahead and we'll go and push on to a couple more examples here, and then we'll wrap up here in just a few minutes. Basically, what we're going to do, no, Dave, you'll have to watch the video because we actually, you'll see a couple of them right here, but we've been explaining a lot of that stuff throughout the session. We've been going at this for many, many hours, so I'll try to give you, the synopsis. What I'm looking for here is I'm looking for a sell signal in my Hoffman trend in my multi-time frame indicator, so these two guys being on sells, okay, and then I'm going ahead and getting a big stochastic pop. Okay, so which is basically a short-term retracement against my prevailing trend, and then I'm looking to take, in this case, a short side trade. Okay, so here you see I got sell signals, and then I look for the stochastic pop. Okay, so I'm basically, it's not showing up. Okay, here, let's go ahead and try that again. No worries, I'll be happy to repeat that. So basically what's happening is we got sell signal. Okay, sell signal, sell signal, sell signal. So the multi-time frame and Hoffman trend indicators are giving sell side signals, and then I'm looking for stochastic pop-ups, okay, which is basically short-term retracements right there. So short-term retracements against the prevailing trend. Okay, those are what I'm looking for, for short side type trades. Okay, that's the kind of the Hoffman's spike there, the stochastic spike. And then also what we're looking for here, these are speed line continuation trades. This right here, in addition, is what? This whole area, speed line continuation trades primarily. I believe this was a key reversal down. It's hard to see with the thing being so small here, but I think when I drew it is also a key reversal down. But it was definitely a lot of speed line continuation trades. Here, this is definitely a key reversal down. High is higher than the previous high, and the close is below the close 1 bar ago, and that's in the direction of the trend below the speed lines. That is a bona fide, and this is Google, by the way, for those of you who didn't know, weekly and daily charts. Okay, and so bona fide Google trade there. Here, this right here is another key reversal down, right? Now this one, though, is above the speed line, so you want to use more caution on that one like we talked about earlier. This one here, key reversal down, but use caution. Okay, so I'm pointing those out because I want you to understand what they look like for the ones that are good versus the ones that are more cautious. Remember, I told you I was going to show you the clean ones and the dirty ones. Okay, even though the dirty ones often work, I want you to understand which ones are dirty. So as you're going ahead and looking at your risk assessment, maybe you'll look to pass on the ones that are a little bit more risky. Okay, if you're trying to keep your probabilities higher, if you're a smaller lot trader, can't add in, maybe sticking with the highest probability clean ones make the most sense. Okay, skipping rock is always a risk on any particular trade, Stephen H. It's always a risk on any particular trade, but usually the ones that involve moving average strikes are going to be the bigger deal versus the ones that are like speed line continuation trades. The ones like ones hitting 20 period moving averages, 35 period moving averages, hitting pivot points, things that are hitting. That's going to go ahead and be where skipping rock is going to be most prevalent and warning. Okay, so you know what, Wally? For me, it's just called stochastic. So I'm not sure if it's going to be fast or fast or slow on some of the other platforms. I'll have to see. I mean, these were already included as defaults for a lot of people. I'm not sure if the level 1 and level 2 are available for the toss user. I thought they were, but I'm not sure everybody can answer that. So I gave the settings anyways for them. So we'll have to see if we can figure out what if it's fast or slow for those of you that aren't using mine. But just see how they work. Everybody gets hung up on the magic bullet. This is as much a concept as anything. So go ahead and see. Put your slow one on. Put your fast one on. And use those periods I gave that will allow you to, whether it's a 4 or whether it's a 4-1. It looks like Infinity used the slow stoke as the basis for mine. Okay. Yes, David, real fast, the clean setup is basically, like in this case, I get a key reversal down, and it closes below the speed lines. Okay, so I've got nothing holding me back from going, David. Here, this is a key reversal down, but it closes at a rising speed line. So potentially this could provide support, which is not exactly what I want to have happen when I'm going ahead and trying to go short. Okay, so a clean setup in this case for like the key reversals is where it closes down below the 3 and the 5, and there's nothing but air below me to go down. A dirty one is I get the setup, but I got the stochastics right below me. Okay? So can we call this webinar Hoffman Gets Dirty? That's great. Well, like I said, you know what? The choices are you can go ahead and have somebody who's just going to blow a bunch of smoke up your butt and give you these wonderful picture-perfect Pollyanna setups, and basically just show you, oh yeah, these are so fun and these are always going to look identical to this. Or you can say, look, okay, here's what picture perfect looks like, but then here's also variations of what you're going to see in the real world, okay? Because if you don't learn how to see the differences, it's going to be harder for you to gauge the risk in the particular trade, and understanding when not to use something or when it's more risky to use something, I think is part of becoming a better trader. So that's why I'm taking the time and energy to instill that upon you there. Okay, sorry, you mentioned the 3 and the 5. Did you say this was moving average of the close or the pivot? It's, Tom, I guess it's the high-low close divided by 3. High-low close divided by 3. Okay, for the 3 and the 5. So yes, it's right. Your formula right there. It's the looks about right. It's listed, Tom, right there in the trading room tool section as well. Okay. You see where some weekly options can set and develop. Yes, Michael, that's basically what we're, Mel, like I said, one of my very long-term student family members here, he basically trades using my work with options only for the most part. I mean, he's not really more of a futures trader. He uses he uses my biases on gold, my biases on the stock market, biases on individual instruments, and then he goes ahead and then formulates his options plan based on my thoughts on the future side of it. Okay, and good. I'm glad you guys are enjoying this. So we're going to go ahead and we're going to actually wrap up in a few minutes here. I just want to show a few more examples. So basically here, what this is meant to go ahead and show right here is more speed line continuation areas. Speed line continuation areas. See, you got the nice green bias here. You're holding above the speed lines. You got a key reversal up here and then more speed lines. These are always my favorite right here, gang. As a reminder, these are the favorite types where we get the speed lines, then it gets a pullback, gets a dip. In this case, what else do we have down here? You guessed it, stochastic spike. Okay. And then we push right back on the direction, and that's where I always get the most excited. Okay, then all through here, we've got a lot of speed line continuation, and this was just meant to denote this, a kind of hand-drawn circle was just meant to denote the whole bias here: green, green, blue, blue, couple of spikes in the middle there, and then down here, same thing. We had the backdrop of the rising market, and then we had a hockey stick version of the stochastic spike. That was in gold, by the way, in the gold ETF. Again, just showing you lots of different examples on different things. Now we've got FCX, okay, and FCX here. What do you got? Well, you've got this really nice rounding. I love this. I've talked to you guys about this repeatedly in the Hoffman trend. Love nothing more than to see that little cradle there, okay, where it cradles down, comes down, then starts to revive back in the direction. You get that, you get this gorgeous speed line continuation trade formation setting up. Then you get a beautiful stochastic spike. Okay, all good stuff. Here, get a couple of my hockey stick versions of the stochastic spikes. All right. And then here, oop, hey, I got a great stochastic spike sell, right? Nope. Remember, that's a stochastic spike up. This is an uptrend. I don't want to short an uptrend. Okay, so staying with the trend and taking them in the direction. Okay. All right, here we got the FAS, the financial ETF there, financial bear ETF. What do we have here? Okay, we got some great spiking here. First of all, we got that nice trend in the backdrop here. Okay, the bias is negative. We've got a nice stochastic spike, which is also a Hoffman fade, for those of you that are familiar with my Hoffman fade work. Okay, nice Hoffman fade that becomes a stochastic spike. Gotta love that. That's a weekly FAS. A couple more stochastic spikes for your review. See, it all boils down to the Hoffman trend and the multi-time frame indicators all going ahead and being down. If the RSI is below the 50, so you got a nice bias to the downside there as well. Everything's a nice bias to the downside. Okay, so the bottom line is that's what we're looking for here. Is yes, it's a 3 times. Tom says it right up there. It's kind of hard for you to see. But it's up there, so it's leveraged. So that's what we're looking at here on these stochastic spikes. Just again, just want to kind of show another ETF there. Okay, here's another ETF, the agricultural. So note here, putting all the pieces together once again, what do we have? Okay, we've got the multi-time frame indicators, we've got the Hoffman trend, we got a beautiful stochastic spike, right? RSI is above the 50 line, good stuff. Okay, so there's different types of spikes. There's ones that can go to the 50 level. We're not going to talk about those today, but thrown enough at you here with just these ones here. That's plenty of information for today to focus on as we've been going, hours over the original. Hopefully you guys have enjoyed all the things we've thrown at you here. Then we got the hockey stick version over here, and a key reversal up, although it did not close above the fast speed line, but it did close above the slow. So then you have a decision to make. Well, it's basically there. It's biased to the upside on the daily and the weekly. I got a key reversal up. Do I wait till it starts trading above the fast speed line and then go ahead and take my entry, or do I want to take my entry early there? Okay. This was excellent. Jaya, you're very welcome there. And let's take a look at crude oil. Okay, crude oil here. We've got a couple things. Okay, we've got a key reversal up in the right trend, closing right at the speed lines there. You've got the key reversal up here again. Okay, closing right at the speed lines with the bias to the upside. All right, so you've got, and then you've got speed line continuation trades that continue to come in over here. Okay, so then over here, that's on the weekly crude oil. Then on the daily crude oil, you've got right here a key reversal up with the bias to the upside. If everybody can see, that's a lower low, higher close. Okay, on the daily. Then you've got another, and that one did close above the speed lines. This one here closed right at the speed lines. So again, it's beautifully biased to the upside, got a stochastic spike, a lot of things in its favor, but it went ahead and it closed right at the speed line, so you can go ahead and wait for the thing to start trading above the speed lines for entry, or if you're going to try to be more aggressive, just taking it when it closes here. Again, that would be more of a dirty entry versus a clean entry. Here's a clean entry with air above. This is a dirty entry being right at speed line resistance. Okay, and then this is a stochastic spike, beautiful uptrend still, and a spike down below. Okay. Bert, I'm not sure exactly. Mel is a superior, in my opinion, options trader. He's come in here and done a lot of live stuff. So I'm not sure. He would have to talk with you. He's done it in the past. He's done multiple presentations here in the past, back before John Hubert and I merged. Did a lot of things to share the option strategies with people and how he looks at them. So he would have to go ahead and speak exactly how. Yeah, it'd be a question for later. Probably just, I said bringing Mel back up here. I'm sure he'd be willing to come up and speak. He's, used to speak pretty regularly, and then of course, obviously with the merger here, we just kind of got focused on so many other things. But I'm sure he'd be happy to share his wisdom on the options trading, how he uses my work with his, anytime there. So. the Caterpillar here. This is weekly charts, and a couple things going on here. We've got the key reversals. We've got the speed line continuation trades. We got the stochastic spikes, the Hoffman fade versions of the stochastic spikes, the regular full version of the stochastic spikes, key reversals. Lots of nice things taking place there in Caterpillar. Then here we get the hockey stick version of the stochastic spike. I get a nice clean version there of a key reversal up right over here. Like I said, green, green, only pulls back to the 50% level on this particular stochastic spike and then fires right back off into a trading key reversal up right there, gang. You know, and a clean one at that, right above the daily chart, and then, you know, takes right off on the very next bar on Caterpillar. So lots of good things there. Okay. And then we've got good old Bank of America. Here's a weekly, and then we've got the couple things here on the Bank of America. We've got key reversal down. Let me actually just highlight those. This is a key reversal down in the direction of that trend, right? So is that a clean key reversal down? Oh, you better believe it. Okay, closes nicely below those speed lines in the direction of my multi-time frame indicators and Hoffman trend. Nice clean entry there. Then we get a nice clean stochastic spike. Okay. Then we move over to the weekly charts, and we go ahead and we get the speed line continuation trade, stochastic spikes, the speed line continuation trades. Remember what I like to see? I like to see that nice speed line continuation trade. Then it kind of crosses over and then goes back into the direction and builds up the momentum to the downside again. I love those. Those are the best. Okay. And then we get a Hoffman fade stochastic spike here again. Okay. And the RSI stayed below the 50, you know, this entire time there. Another nice bearish sign as well. Okay. So again, for those of you that are thinking, well, I can do away with the RSI, I'd just like to show you that I do still think there's some value there. Then we have the Swiss franc. Now, the Swiss franc is something that we've gone ahead and had as well. The Swiss franc, we talked about this a lot earlier in the year, how this was looking so good from a swing trading perspective. You guys heard me say over and over and over again, I said like the Aussie dollar, the Swiss franc, these were ones that were good from an overnight longer term hold perspective, but not on the intraday trading perspective. How many times did I say that over and over and over again? Okay. Well, here we got the buy side here on the multi-time frame indicators, the Hoffman trend. We went ahead and had a key reversal up here, and we went ahead and over here we had the Hoffman spike, the hockey stick version of the spike, true spike, almost a true spike. This one fell just shy, okay, but you can see the overall bias again. Okay, then you had a trading key reversal up as well on this, and that closed above the speed line, so a clean version of that, and then it went and took off. But now here's where we're looking when we're seeing. Then we go from a nice 45-degree angle to parabolic. That's where I'm looking to dump and unload on these things. Okay. So that's what we talked about there. So that's where volume, if I see a chart like this, or especially even on the intraday basis, where we go from these little itty-bitty bars, those beautiful little 45-degree angle bars, to all of a sudden a big honking bar, I'm going to be looking to exit if I'm in a swing trade. Or like what I actually did, as you guys recall here, what did I do to that? I shorted it, right? So I went short there because we were up over 1,000 ticks, 10 cents, on the Swissy, which is just monumentally beyond the normal for that, okay? So, which is a huge sell signal if I'm long. That's the big blow-off. The climb, the climb, the climb, blow-off. Yeah, I was really happy with that execution that day too, exactly, Chris. So here again then, we had the long side bias, we get the stochastic spikes, the Hoffman fade spikes back there, okay? Key reversal up, you guys can see that as well. Key reversal up, it's a clean one as well with the price closing above the speed line, so there's air there, and then speed line continuation trades. So just trying to put a lot of these different concepts together. And then we talked about like the euro in trading, like the one-day overnight type trades. That's where those spikes come in when there's less of a trend. Remember, we talked about that just a little bit ago. If you're looking to take a one-night overnight trade, you're not going to need as much of that clean, beautiful trend that we've been looking at on most of these charts. A dirtier trend, if we're looking for a one-night overnight hold on like a stochastic spike, it can be more valid. One thing you want to do is butt it up against what's happening on the bigger time frames. So here we have like the euro on the weekly chart, and the euro here had the beautiful multi-time frame, also went ahead and had the Hoffman trend, and then it went ahead and had the speed lines and the RSI, everything kind of in order here, and you just see it kind of traded along those, so nice speed line continuation trades. Okay, so two different concepts there, kind of wanted to share with you, and of course a stochastic spike as well. Okay. And then the euro, looking at the euro again here, I had a couple of those up here. So the with the euro here, we had again the nice trend. Okay. And then what I did over here was put up the daily chart, and I had multiple. You see here, got a trading key reversal up. Here we 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 got a stochastic spike. Here we got a stochastic spike. Here we got a stochastic spike with a Hoffman fade. Okay, everybody with me? Okay, trying to go ahead and really just drive home lots of competency through repetition here. Okay, British pound. Okay, the British pound. We've got then the Hoffman spike with a hockey stick. Beautiful trend on the multi-time frame. Beautiful on the Hoffman trend. Okay, then here we got this great key reversal down. Okay, here it's a key reversal down. Here it's a key reversal down. Here it's a key reversal down. All very clean on those three right there. Okay, all very clean on those three key reversals down. Can everybody see that okay? So we had the nice trends in place. Then we had the key reversal down below the speed lines, key reversal down below the speed lines, key reversal down below the speed lines. Okay? And then, of course, some Hoffman spikes there. All right. Well, there you have it, gang. I thank you very much, Linda. I appreciate those really nice comments. For all of you, I see a lot of you going ahead and posting a lot of really nice comments. Jay says, Rob, you're awesome. I've never come across any teacher or mentor who has shared so much of their knowledge so freely, and goes on to say some more things. That's really nice, Jay. Appreciate that. So the you guys are all very welcome there. And is there a couple last-minute questions there? I know we kind of went over. Let's see, 7 hours. So even with breaks, we've probably gone about 6 hours here. If nothing else, what we can do is we can just answer more questions as you guys have a chance to stew on some of this tonight. You guys are really you're all very welcome. What I need to do, it's 3 o'clock in the afternoon Central Time here, and basically what's going to happen now is I've got my student family here, my mentoring students, and we're going to be spending the evening going ahead and exploring these things and obviously many more things deeper. To those of you that posted the comments about why you have a lot of tools in your toolbox and knowledge. I've been doing this for many, many years, as you guys know, and there's so much I have to teach, and I try to do as much of that as possible during the private mentoring sessions, and then, of course, obviously in the room, focus on a lot of different tools and techniques as well. So, yeah, I mean, we've got a lot of neat stuff there to share and talk about and do and work with together as we go forward as a student family in the live trading room, and I'm glad you guys are here. And so what we'll do is yeah, the level 3 indicators, the Hoffman trend and the multi-time frame, should be available for the top 5 uh, platforms next week. It's like TradeStation, eSignal, Infinity, Ninja. I think I'm missing one somewhere. But so that's all. That's good. And Dr. Phil, you're very welcome. Like I said, I wish you and the gang were here with this group. I got a great group behind me. They're a lot of nice guys. But Dr. Phil, when you and Tom and everybody come out here next month, it's going to be awesome. So can't wait till you guys are here. It's a lot of fun. I love having you guys in my home. It's a lot of fun. Sarah, of course, is like the world's greatest hostess of the mostest, except I'm in trouble with her because I sprung the lunch on her. But that's okay. I'll make it up to her. And you guys, what we'll do then is thanks for spending these 6+ hours of actual learning time with me. It looks like most of you are saying thanks and really awesome and everything else, and that's great. I think you guys are great too. My best video yet, well, thank you. I appreciate that. I've tried to put a lot of effort into these. I tried to make this one more organized so that we can create menu systems so it'll be easier for you guys to go back and click buttons and fast forward, or jump, I should say, not fast forward, jump to the right areas to like pick up on learning concepts over and over again. And so hopefully that's really going to go ahead and help you guys a lot there. Okay, so. And well, great. Well, listen, thanks so much, everybody. I appreciate that. Thanks to my group behind me too, because they've been great and patient in learning and taking a lot of notes behind us. And now we've got a whole nother evening full of work this evening. So, you guys take care. And I will look forward to seeing you guys tomorrow morning. Of course, the Euro had a 2-bar break. Here this past Friday, and we had a little bit of a retracement today, of course, in the Euro. That's expected, and so now I'm looking forward to seeing if that can give us some great trading as we go into the remainder of the week. It's certainly going to be one of my key focuses now will be the Euro. Still, of course, watch Old Faithful Russell and a couple of other ones, but going to be looking across multiple markets now. It's not just going to be one-sided. The Euro is really going to be a big focus for my trading as we go forward after that 2-bar break. So looking forward to going ahead and having a great time of it with you, and you guys have been as great as you're saying I've been to you, so I really appreciate that. So let's go ahead and reflect on all the learning you guys have had, try to compilate your notes, and then tomorrow morning in the room we can maybe do some follow-up questions, but tomorrow morning it's going to be back to trading, we'll add in those notes and answer questions then between trading opportunities. Okay, so good night. Take care to all of you, and I look forward to seeing each and every one of you tomorrow morning. Thanks so much, everybody. You guys take care too. Bye-bye.